fourth edition of the We Are in Macroeconomics and Finance Conference. And we are really happy to have Soledad Núñez to give the opening speech. She has a PhD from the University of Minnesota. She's been at the bank for many, many years. And since last week, she's Deputy Governor of Bank of Spain. So thank you very much for being here. I know that your schedule must be hectic these weeks. So thanks a lot for being here with us today. Thanks.
For the celebration of this fourth We Are in Macroeconomics and Finance Conference. To tell the truth, it was planned that I was presenting this conference anyway. But before I was as a member of the board of Banco de España. But then last week, I became Deputy Governor, and for me, it's real an honor still to present this and to give even more category to this conference. But the problem, I mean, is a good news. I am Deputy Governor. The bad news is that it has some drawbacks, and the drawbacks is that my agenda has become crazy. So I'm gonna be really, really brief, because I have to be in 10 minutes in another place. So, life. This conference, well, as you know, not only focuses on macroeconomics and finance, but the idea, and this is very important, is to emphasize the active participation of women in this field. The We Are in initiative is not only about research, but also to foster robust community on female economists and encourage the rich exchange of ideas and networking. In academia and central banking, there is still much to be done to improve diversity. A lot. For instance, only 1/3 of economists at the Federal Reserve are women. At this side of the Atlantic, the situation is not so different, as the European Central Bank women account for 42% of experts and only 30% of managers. I don't know about BIS, but probably it will be the same. No? At Banco de España, female representation rose from 32% in 2000 to 51% in 2003, though women in management roles remain lower at 43%, and this is including the very, very low level of management, the 43%. If we go a little ahead, higher is much lower. And also these are very general figures, but when we talk about women in macroeconomics and finance, particularly in finance, figures are much lower. Research shows that women in economics also face tougher standards for publication and conference acceptance. And this is academic work done in this respect. No? Why diversity is so important and inclusion. Beyond fairness, it's a question of fairness, it leads to greater efficiency. And this is also that evidence suggests that diverse perspectives foster a productivity premium and enhance decision-making with organizations. The challenges we face today, climate change, technological transitions, geopolitical tensions, and more, require the contribution of female economists. Without their insights, without our insights, we risk developing biased views of these issues. Even like this conference provide an essential platform, events like this conference provide an essential platform for female economics to share their voices, empowering them, and what is really important, expanding the boundaries of what we can achieve when inclusivity is prioritized. This conference is an example of what we can do, and I think it could cheer up young female economists to specialize in these fields, in macroeconomics and finance. Looking ahead to the next 2 days, we are going to research only relevant topics, and I'm very sorry that I cannot attend because it's true. I've seen the agenda, and they are really, really nice, appealing papers to be presented. The topics are artificial intelligence and policy making, international finance, supply chains, climate risk, credit and financial intermediation, redistributive effects of inflation. I'm particularly excited to welcome the 3 PhD students, I don't know where they are, but who will present their work in the poster session. These promising researchers bring fresh perspectives, and this will be an excellent opportunity for them to receive valuable feedback from senior figures. I would like to thank Elaine and CEPR, Catherine, that is not, I think that she's sick, no? She's sick, she cannot come in. And Fiorella de Fiore from the BIS and Beatriz González from Banco de España. Especially Hélène and Fiorella, I want to thank you very much because you are a leading example in these areas. You have been an exception for years and years. Well, you are young still, but but it's true. I mean, whenever there was an event, one of the two, and with three or more than are over, you were present there always because. And I also want to recognize the support teams for CEPR at Banco de España, whose hard work has. Beatriz, you will be also a leading example, but you are very young still. I also want to recognize the support from CEPR and Banco de España, whose hard work has made this conference possible. And of course, a special thanks to all participants for being here and contributing your expertise and passion. Together, we are shaping the future of macroeconomics and finance. Take that into account. With that, and officially, I declare the fourth We Are in Macroeconomics and Finance Conference open. Let's make the most of the next 2 days and continue pushing the boundaries of our field. We are in, we will more of us in, and will remain in, because we are in to stay. And thank you very much. Enjoy Madrid and have a nice conference.
Well,
Thank you.
So much for taking the time.
We are in.
No, I mean, I just wanted to, to really congratulate you because we don't have many women in high-level policy making. We're fortunate that we have a few in the room right now. So this is amazing, but this is quite new.
Yeah.
And so that, that should inspire a lot of young generations. Some of them are with us. And as you recall the numbers are not good. And they don't, I mean, they do go up like at a snail pace. But it's really at a snail pace. So
slowly.
There's a lot more to do. So thank you so much. And also for the Bank of Spain, etc.
Okay, thank you.
Thank you.
so then we'll begin the first session. So if the chair wants to come, and then the first presenter and discussant. So please bring your name tags so we can have them on the table. And also, like, just some logistics. So you can present sitting, or we have like one of these microphones if you prefer to stand. So this is up to you, whatever you prefer. So yeah, welcome again, and thank you very much.
Beatriz, es Kenza, ¿verdad? Kenza, la de Kenza.
Sí. Okay. Hi. Control. Up here in pointer, so sit or stand, whatever you want.
Okay.
And well, also, you press already the button, but whenever you're going to stop talking, just you have to switch it off, because otherwise the other person.
Okay. Okay, I try sitting. We'll see. Okay, well, thank you very much for including this paper in the conference. So I joint work with Elio Bolliger and Margaret Davenport. Sorry.
Before you start,
Yes. Okay.
I think we should just go around the room and introduce ourselves. And we still have a couple of minutes to do that. So I think we should do it now so that everybody knows each other. So why don't you start? Because
Okay, so I'm Beatriz González. I'm from Banco de España. I'm one of the organizers of the conference, and well, I met most of you yesterday, so we are really happy to have all of you here, and thank you very much for coming. Well, I work on macro from dynamics. I'm really happy to talk about these 2 days, and well, welcome everyone again.
Hi all, welcome. I'm Fiorella De Fiore. I'm at the BIS. I worked 20 years at the ECB before moving to the BIS, where I was head of monetary policy. Now I'm a research advisor working on macro and monetary policy. Hi, my name is Eva Ortega. So I've been for a while at Banco de España. I'm heading macro modeling for many years. And now I'm a research coordinator here at Banco de España.
Hi, I'm Hélène Rey, and I'm at the London Business School. I do international macro and international finance, and I'm also vice president of CEPR.
Hi, I'm Vanya Stavrakova. I'm also at LBS. I do international finance and macro.
I'm Laura Bottazzi from Bologna University in Bocconi, and I mainly concentrate my research on international finance. And I did find that of the Italian here, I have been the professor of all Italian, I think, here. I'm old enough.
Hi, I'm Shebnem Kalem-Liolskan at Brown University. I work in international macro and international finance.
Hi, everyone. I'm Tabitha Kritinganga. I'm a professor of economics at the University of Nairobi, Kenya. I am the chair of the WTO Chairs Program, and I deal with international trade and policy. And right now, I'm doing research on women economics in leadership.
Hi, I'm Daria Finocchiaro. I work at the Bank of Sweden, the Riksbank. I work in monetary and macrofinance. I'm a proud member of the running club. We are in conference, so if you want to run in the morning, just let me know.
Yeah. Hi, I'm Claudia Foroni. I come from the ECB. I work mainly in empirical macro and time series econometrics.
Hi, I'm Costanza Tomaselli. I'm doing my PhD at Imperial College Business School. I mostly focus on corporate finance and environmental economics. Before my PhD, I used to work at the Treasury in the UK, so it's very nice to be back to a more policy setting.
Hello, I'm Cristina Cella from the Swedish Central Bank as well. I focus on corporate finance and banking, and lately I've developed an interest for climate, and therefore I work a lot with climate questions, also from a policy perspective. We are very engaged in that, and I'm very proud of it, to be a part of it, actually. Thanks.
Hi, I'm Andrea C. I'm currently at CEMFI. I work on macro finance and firm dynamics.
Hi, I'm Wentong Chen from Cornell University. I'm a PhD. I work on international finance and macro.
Hi, I'm Tanya Linta. I'm a PhD student at Toulouse School of Economics, and I do macro and monetary policy.
I'm Camelia Minoyu from the Atlanta Fed. I work on empirical banking, financial intermediation, a little bit of international finance as well. I'm actually a development economist by training. And during the global financial crisis, I became obsessed with banks because I understood nothing about them and wanted to understand about them. And I spent my whole life in policy institutions, always looking for that elusive research time. And I think I finally found it.
Hi everyone, my name is Vasio Annido. I'm at Base Business School. It used to be called CAS, for those who don't. I still have to say it, because most people wouldn't. So I'm currently at Base. My work is in empirical banking and in corporate finance. Yeah, I look forward to meeting many of you.
Hi, everybody. My name is Silvia Miranda Gruppino. I'm at the New York Fed now after many years at the Bank of England. I do empirical macro applied to many different settings, from international to macro to monetary policy.
Hello, everyone. I'm Luciana Juvenal, and I am now at the IMF. Before that, I was in the Fed of St. Louis, and I work on international macro.
Hi, I'm Isabelle Méjean. I'm at Sciences Po. I'm mostly working on international trade.
Hi, my name is Hae-Yun Jung. I'm at the New York Fed. I joined 3 years ago. I work on climate risk and international finance. Very excited to be here.
Hi, I'm Nina Boyarchenko, also at the New York Fed. I'm the head of macro finance and research there. And yeah, I guess I work on many areas in macro finance. Putting it.
Good morning, everyone. Chiara Scotti. I'm now at the Bank of Italy. I just started as deputy governor in February. Before that, I was for 2 decades at the Fed, Fed board in Washington, D.C., and the last year at the Dallas Fed. I used to work on empirical macro finance. Now my life has changed. I work on many things, which unfortunately really do not include research. So we'll see what the next few years will bring.
Hello, everyone. I'm Veronica Selesnyova from Paris Dauphine University. I do mostly energy finance and monetary policy.
Good morning, Petra Buresheva from CEPR, and I support Alain in organizing the Women in Economics activities.
Hi, I'm Desmina from CEPR. Yes, I sent a lot of emails.
I guess I can use this microphone, yeah? Okay. Hello, everyone. I'm Svetlana Nenova, Sveti for short. And I'm an economist at the Bank for International Settlements for 2 weeks now. My research interests are broadly international macro and international finance, also with a lot of applications to monetary economics.
Hi, I'm Marta Garcia. I'm working right now at the Bank of Spain. I just started like 2 weeks ago. So, so I work mainly in macro modeling, expectations. So I'm so happy to be the chair of this session, time series. Yeah.
So I'm Kenza Benima. I'm at HEC Lausanne, and I focus on international macro finance, imperfect information, if you can call that focus. But I'm very proud to present the first paper of this conference. So the paper. Shall I go? Okay. So the paper, well, it's called Granular Expectation Shocks and International Financial Contagion. And really it's going to be a paper linking expectations and investments into different countries. Oh, now it's not working anymore. Maybe I should. Okay. No, it's not. Okay, so this paper is focusing on one type of financial contagion. So in the literature, the focus has been on what has been called funding shocks. This typically happens when you have shocks to the investor base. And this generates typically spillovers from what is called core countries to peripheral countries, so typically north-south contagion. Now, here in this paper, we're going to focus on a channel that has been understudied, which is expectations. And as I will show you, actually, this leads to different kind of contagion. But first, you may ask, how can expectation shocks generate contagion? When we speak of contagion, we are thinking of, a shock that is happening to Brazil, for instance, that spillovers to Chile, for instance. And it's not a common shock to Brazil and Chile. Okay, so it's a specific shock to Brazil that spills over to Chile. So how can expectation shock generate contagion? So for this, you need frictions. So first, you need delegated investments. So you don't invest directly in Brazil and Chile. You invest in a fund, for instance, that then invest in Brazil and Chile. And then you need portfolio frictions, meaning that this fund will have, the allocation between Chile and Brazil is sticky. Okay, it does not adjust all the time. And this leads to what is called co-ownership spillovers. What is that? It happens when you have expectations about the fundamentals of a given country, let's say Brazil, spill over to other countries held in the same portfolio. How does this happen? Imagine you think that Brazil is doing poorly. So you want to get your money out of Brazil. So what you do, you take the money out of the fund, that invest in Brazil. But in this fund, there is also Chile. And if the portfolios are sticky, then this means that Chile is also going to go through capital flights. Okay. So whereas Chile is going well, you don't expect that Chile is going bad, but still the money goes out. So this has been called ownership spillovers. It has been introduced by a paper by Jocastira and co-authors. Here, so what we do in this paper, first, we build a model with delegated investment and sticky portfolios. And we ask two questions. When are there expectation-driven spillovers? The response is, well, portfolios are sticky, as I explained. But then you might ask then, okay, but when is that important? When is it important in the aggregate? Because, if, all these idiosyncratic expectation shocks that hit Brazil or wherever, if they are small and they spill over to Chile, it's not so bad. And if Brazil is a small share of the portfolio, also it's not so bad. But, okay, everything can wash out in the aggregate if you're talking of idiosyncratic shocks. But when portfolio shares are granular, then this does not wash out in the aggregate. So basically, this is a problem for Chile when Brazil is a big share of the portfolio. Okay, and then empirically, we are going to use a data set that links, on the one hand, investors' expectations. So here we're talking of fund managers. So for instance, also these funds that we are looking at, they are managed by big banks. So for instance, UBS has a fund, Latin American fund or a global fund or a global emerging fund, etc. So we have the expectations, the forecast of UBS about GDP growth in Brazil, Chile, etc., in many countries. And on the other hand, we have the mutual funds, so UBS, Latin America, etc. And we have the investments that go into these mutual funds and the funds country allocations. Okay, so we're going to link the expectations to these flows into the fund and also how it's allocated across countries. And then we're going to use this to identify the spillovers at the micro, so fund country level. And what is really key for the spillovers is actually the elasticity of investments to the expectations. So if you take Chile, what matters for the spillovers to Chile is the elasticity of the investment that go into the fund. Okay, so basically it's going to be the elasticity to the expectation about all the other countries in the portfolio. Okay, so we find that actually this elasticity is high. Okay, so basically, if you're an investor, you care about the GDP growth expectation on the whole portfolio, and this the elasticity to that expectation is high. Okay, and what we find is also that this elasticity is actually 2 to 3 times higher than the elasticity to the expectations about the country itself. So the elasticity of capital flows that go to Chile, they are not so elastic to the expectations about Chile, but they are elastic to the elasticity about the big countries in the portfolio. Okay, so this suggests a high degree of portfolio stickiness, right? Because it should be, if the portfolios were elastic, flexible, it would be the other way around. Okay, and then we're going to ask the quantitative question. So do spillovers matter in the aggregate? And you can suspect that, yes, they do, because actually portfolios are highly concentrated. So 10 countries account for 65% of the portfolios that are in our data set. What we're going to show is the volatility that is bad, the one that is not related to the country fundamental, is due to the granular residual of the portfolio level expectation. If I can translate it, what this means is that it depends on all the idiosyncratic shocks that hit the big countries that are in the countries with big portfolio share. So basically for Chile, there will be more extra volatility if there are other big countries. So if there are countries with big portfolio shares in the same portfolio that are hit by these idiosyncratic shocks. And then you measure this using the granular residual of the portfolio. And that actually accounts for 30% of the expectation, what we call the because you can reconstruct using our data and our estimates, you can reconstruct the capital flows that are due to expectations. And so from this expectation-driven capital flow, 30% is due to these spillovers, to these granular residuals. So it's quite big. Okay, so in a nutshell, we contribute to the literature on mutual fund transmission of shocks, where we provide direct evidence of this ownership spillover, which has been put forward but not identified in the literature before. We contribute to the literature on the elasticity of investments to expectations, but here in the novelty is the cross-country dimension. And then there is a literature on portfolio stickiness, but here the estimates are based on real individual expectations. Okay, so first I will present some evidence, and first on the elasticity of capital flows to expectations. So our data set, we combine EPFR, the EPFR data, which is a data set of mutual funds. We have the cross-country equity investments and the flows into the funds. And we combine this with consensus economics data. We have the GDP growth expectations of the fund managers. So our data set covers 2001, 2016. You know, if you take the overlap of these two data sets, you end up with 8 investors, so 8 big banks, typically, that manage 73 funds. And that covers 43 countries. And in the end, you know, if you have monthly data, so we have quite a lot of data. We have data on the expectations on a given country by one given investor. And we have the funds assets under management, so the total funds that are managed at the total money managed at the fund level. And then we have the country allocations within the fund. Okay. Okay, so this is how it works. So imagine that UBS, becomes, optimistic about a country. They're going to invest in a mutual fund, J, that manage that country, but that money can get in, other countries as well. Okay. Now, what we look at is really here. So imagine, UBS is optimistic about Brazil. We are going to measure the impact of that expectation on the investment in Brazil, in country K. So this is the elasticity we're looking at. But you see that there is a layer in between, which is the mutual fund. So it's not clear that this elasticity is going to be high if the fund is not flexible, if the fund does not reallocate between let's say, Brazil and Chile as a response to this expectation on a given country. Okay, so what we find here, so let me focus on the first 2 columns. It's simple. So here you have, okay, this regression, we have a lot of fixed effects that capture a lot of things. And in particular, we have fund time fixed effects. These capture all the funding shocks that happen. UBS has like a wealth shock. This is captured by the fixed effects. If there is, fluctuations in risk aversion, global risk, this is captured by the fixed effect. We also have country time fixed effects. This captures all the, local development at the country level. So really the identification here comes from the fact that 2 investors at a given time will have different expectation on the given country. Okay, so this tells you that if UBS is more optimistic than Goldman Sachs, they're going to, if they are 1%, they expect 1% more growth. They're going to increase. So if they expect 1% more growth in Chile, the investment to Chile is going to increase by 6%. Okay, 1% percentage point of growth. So it's not a lot. Now there is a lot of heterogeneity. If you take global emerging market funds, column 2, it's twice as high. Okay, so it's more elastic for emerging economies. Now, what is the elasticity of mutual funds asset to fund expectations? So now the question is, if a fund becomes more optimistic on the growth of a given portfolio, how are the flows going to react? And in fact, this is going to be higher. Okay. Now the elasticity is 15%. Okay. All right. So it's 3 times as large as the elasticity to the country. So this means that there is not a lot of flexibility in the portfolio. Now, in our model, we're going to have a model with so an investor that allocates weights between safe and mutual funds, and the mutual fund is going to allocate to reallocate the funds between different countries with the probability P. So P is the measure of flexibility of the portfolio. Okay. Now the question is, how does the investment into country A are going to react to return expectation on country A? If the portfolio is flexible, you invest in the mutual fund reallocates all the money is going to go to country A. But if the fund is sticky, then country B is also going to get some money. So that's the role that that is played by the flexibility. Okay, now if you look at, so A here is the investment of investor I into country K. So you have the elasticity to the country-specific expectation. It depends on P. The more flexible, the higher P, the higher the elasticity. Then you have the third line is a portfolio reallocation spillover. This is a natural spillover, if you wish, okay? Because, if you're optimistic on Brazil, you're also going to take some money from Chile because, they are close substitutes, okay? But this is not affected by the friction. But you have the second line, that depends on 1 minus P. This is a co-ownership spillover. And this depends on the expectation on the rest of the portfolio. So the flows to that country should not respond to the rest of the portfolio expectation in the absence of friction. Okay, so now what we do is that we collect these elasticities and we decompose capital flows into the part that is due to the own country expectation and to the portfolio expectation. So that's beta and delta. And now the question is, when is that inefficient? When is the delta lead to inefficiencies? Imagine that there are only global shocks. Well, then if all shocks are correlated, it doesn't matter. So this is why we need to decompose the expectation shocks into global component and local components. And then we can show that this, so I don't know if you see. No, in the middle, you have the expectation on the rest of the portfolio, RP. That can also be decomposed into a global component and into a granular component that is going to collect all the idiosyncratic shocks to the rest of the portfolio, but these are weighted by W, the share of each country in the portfolio. And in the end, when you decompose capital flows, there is an idiosyncratic component that depends on beta, the elasticity to own country expectation, on the global shocks, beta plus delta, and on gamma, the granular component, depends on delta, which is this co-ownership elasticity. And under some asymmetry assumption, we can show that the co-ownership spillovers bite only through the granular term. And second, the ratio between these elasticities that I showed you, the elasticity to the rest of to all the fund expectation, beta, to the own country expectation, delta, it's a measure of the frictions of the flexibility, the stickiness of the portfolio. Okay, now we can actually go back to the data and we can show that there is a direct mapping from the model to the data. And we can identify these 2 key parameters. Remember, beta is the elasticity of, you can look at, So A here, AKIJ, is the total funds that go to country K from investor I through the fund J. Okay. So we're going to combine all the layers of investment into the mutual fund and the allocation between countries. And then this is going to react to the own country expectation with elasticity beta, and to the rest of the portfolio with elasticity delta, which is going to only depend on the stickiness of the portfolio. And then with a bunch of fixed effects, in the end, well, now you can look at the last column. The own country expectation, still 5%, and the rest of the portfolio elasticity, 16%. Okay. So again, now we have a direct mapping. We can relate this. So this means that there is a lot of frictions and a lot of spillovers. Now, quantitative assessment, we're going to take this beta and delta and construct expectation-driven capital flows and decompose them into the part that is due to the idiosyncratic own country expectation. Okay, so basically, when you are optimistic on Chile specifically, okay, and then the part that is due to the global shocks, when you're optimistic about everybody, and then the part that comes from other countries in the portfolio. So, for instance, Brazil. Okay, okay. So we have these three terms: granular, global, and idiosyncratic. And they sum to the total capital flows. And now, well, the part that is interesting is to look at, how can we account for these expectation-driven capital flows. It's interesting to look at first the decomposition of expectations. The part that is due to the granular term, so the first column, is only 6%, so it's small. Most of the expectation is explained by idiosyncratic shocks, 75%. Okay. Now, if you look at the decomposition of capital flows and how they relate to this granular, global, and idiosyncratic, actually there is a much stronger share that is due to the granular component. Why? Because we have a high delta and a low beta. Because we have a high delta, the granular share is now 20% in the homogeneous case, and the idiosyncratic part is only 14%. So you would like to, the investment to Chile to react to that component, to this idiosyncratic component. But what it tells you is actually 20% of capital flows are due to, developments in Brazil, right? Okay, now, the last two rows, we actually take into account the heterogeneity. Okay, with the fact that in particular, global, emerging countries, the funds with emerging countries, they are more elastic. Yeah, so we take this into account. Actually, in that case, the granular component is even higher, 30%. And I don't talk about the last row because I don't have time, but I can show you just the decomposition here. It's the same type of data, of figures, but we just distinguish between advanced and small countries. So the above panels are advanced, and below you have emerging, and then left and right is large and small. Okay, the red is idiosyncratic. So the first panel here, expectations, it's what I said. Most of the expectations are explained by idiosyncratic components. But if you look, so just look at the last one here. Now you see the idiosyncratic component has shrunk when you explain capital flows. So expectation driven capital flows that is due to the granular component is the green one. You see. Now compared to expectation, it's much higher. And it's particularly high, actually, for small advanced economies in terms of, the proportion that is, proportion of capital flow that is explained. And for emerging, it's a bit less because there is a big part that is explained by global. But if you take away this global part, actually, the granular part is actually quite high as compared to idiosyncratic, for instance. So, bottom line, which are the countries that suffer from this? These are more of the small countries and emerging countries. Okay, who is the cause of this? Who are the sources of these spillovers? If you plot the contribution, with the average size of these countries in portfolios, in global portfolios, you have a very big correlation. And in fact, you know, so big countries that have big shares of portfolios contribute more to these spillovers. And what is interesting is that you don't only find G7 countries, you find also some BRIC countries. So you have Brazil, Russia, China that is there also, but Korea also, big emerging economies are also a source of these. So this is what's different from funding shock, is that you have a contribution also of large emerging economies. Okay, so I stop. Currency spillover matter at the fund and on the aggregate. The relative elasticity of capital flows to country level and portfolio level expectations implies a high level of portfolio stickiness, and 30% of the balance of expectation-driven capital flows are unrelated to the fundamentals. Okay, so I'll stop. Thank you.
Yeah, thank you so much. Perfect timing. Now it's time to the discussion. Yeah, sure. Yeah.
And hopefully my slides will appear.
Yeah.
I know. No magic.
You know. Well, you know, yeah.
Okay, perfect. It works. Thank you very much for inviting me to discuss this very interesting paper. I think Kenza did a fantastic job in presenting the results. My clicker stopped working after the first. Okay, that's not good.
It's.
Okay, shall we move over there?
Yeah, maybe.
Okay, no,
Yeah,
it's fine.
maybe it's more comfortable.
Okay. Okay, so thank you. Let's jump straight in without. No, definitely doesn't work. Okay, we'll do the clicking. So this paper really takes what's a fairly old question, a question about what drives equity market movement across countries. Is there such a thing such as actual contagion, or is it mostly common shocks that affect different countries heterogeneously? There's a big literature on this. The previous literature uses a lot of these push-pull shocks to explore country heterogeneity and understand this. I don't think that literature reaches a solid conclusion, but I think this paper takes a very interesting look at this question with very different new methodology and with different data, and combines both this data that relates expectations to investments with very clear portfolio choice-based decomposition of capital flows to get at that question. And I like that it's a global view. It's not the previous literature a lot of the time looks at this contagion in terms of emerging market to emerging market contagion. Here really they look at both contagion between advanced and emerging and within emerging markets. So with that in mind, I want to spend a little bit of time thinking about what are actually the two components that go into the identification and into the data. So there's two things going on. There's flow of information and flow of data. So flow of information, or I don't know if you like my term, but that's how I think of it, is there is some expectations and forecast that comes basically from a bank, say JP Morgan, issues, their economists say the Brazilian economy is going to grow, Colombian economy is not going to grow. Now, JP Morgan also manages many funds with different portfolio compositions. Some will have more exposure to Brazil, some will have more exposure to Colombia. And JP Morgan has clients like Kenza who will invest in those funds and decide which funds they invest in. Both here for the identification, both the clients or the end investor of in these funds and the fund managers are assumed to kind of receive information from the JP Morgan, but they don't receive any information from the forecast by Bank of America Merrill Lynch. that may be a reasonable thing to assume, but I really don't know how expectations are formed, whether they're formed in a similar way by retail investors, whether they're formed in a different way or versus fund managers. I'd like to have a bit more intuition of why that may be the case. I can think of stories why that's the case, but the paper doesn't really discuss why that comes about and why there's no kind of information cross spillovers as well. Then secondly, there is a flow of capital that's coming from the end investor into the fund and then from the different funds into Brazil and Colombia. And now depending on what the JP Morgan says is going to be Brazilian growth versus Colombian growth, the relative flows will be different based on that. Here again, the expectations of the, technically here, Cveti, me, can also invest in the JP Morgan fund, nothing stopping me, and be informed by the Bank of America Merrill Lynch forecast. So again, the flow, the link between the flow, the capital flow and the information flow here, I think needs to be a little bit clearer. And then the paper really has two empirical facts in the beginning to motivate the model. One is end investors' allocation into the equity mutual funds respond differently to heterogeneity in the growth expectations by these banks that make the growth forecasts. And that can be due to the common component in country expectations, and it can be due to the granular component across countries. And here I've highlighted that about maybe a third to a half of it is driven by country specific, or the granular component, whereas quite a bit still is driven by common components. So I thought this is interesting and takes us back to that debate on common shocks versus contagion. Now, okay, I'll leave you the highlights about things to think about in terms of control variables. But I think on the second part, I have a more substantial question where they look at how do the portfolio allocations to different countries, so kind of second leg of capital allocation, how does that change with respect to this dispersion in growth forecasts? And here, yes, they are lower, these responses of the fund managers to the different growth forecasts, but it's not clear to me that the interpretation of that is sticky portfolios. It could be that these funds have different mandates, so they cannot invest to the same degree in a particular segment of the market. It could be that for some reason, all funds here look to me like they just have more passive funds and ETFs, whereas the global emerging market funds have more leeway in terms of reallocating their portfolios. That's not necessarily a problem as long as the sample of funds you have is representative of the total the total sample of funds. But I think there needs to be some information about what are the funds in this sample, and can you really take the micro evidence to the macro here? Now, I think Kenza did a fantastic job of explaining what is the model-based decomposition of aggregate flows. This depends on these responses. The betas are the responses to idiosyncratic country shocks. The deltas are responses to the granular shocks, and you have also responses to more investor-level granular shocks. I really like the decomposition into co-ownership and portfolio reallocation. I think I wanted to just highlight here that this the model itself switches off any second-order effects from flows to prices and then back to investor wealth effects. And I don't know whether that would be important and where it would show up in the data, but it may be contaminating the data, to the results to some degree. Okay, I'll skip this one in the interest of, no, actually, this I think is quite important. Firstly, next one I'll skip. I think, so the way this is taken to the data is then by assuming that all funds have the same elasticities. So funds have the same elasticity, across all the funds they have the same elasticity to the idiosyncratic component of expectation. They have the same elasticity, disubstitution elasticity with respect to the granular component of country growth and expectations. And the data here that's shown from their regression table really speaks to there being a lot of heterogeneity. Even when you kind of look at fairly broad fund types, there is a lot of heterogeneity in these elasticities. And that clearly matters when you compare the variance that you get in capital flows for other country groups. When you have homogeneous elasticities of substitution, firstly, the size is quite small. Not only is it that the variance that you get from homogeneous elasticities is small for the granular component, but it's also small even with respect to shocks coming from the idiosyncratic term. So I think that's important, and the heterogeneity also is important for thinking about the representativeness of the result at the macro level for capital flows in aggregate. And I think you've started looking at kind of the sources, both granularity coming from the from the perspective of the receiver of the capital flows, which is this chart, and you show the scatter plots for the source of the shock, source of the capital flow. But I think there's more work to be done to kind of think about what is the heterogeneity in the spillovers from a given source to different types of issuers or different countries. I have some evidence here it's not on equities, but depending on what is the source of the shock, there is a lot of heterogeneity in terms of the country that experiences spillovers via portfolio rebalancing. So I think I really enjoyed the paper. It's very insightful. I like the approach and the new way of mapping data on expectations to flows. I really need more ways of thinking about these segmented channels of information dissemination between bank, fund, and end investor. And I need to know, to believe the results for the macro data, I need to know whether this subset of funds that you do observe, both expectations and investments, is representative of the whole fund universe. And I think it would be interesting going forward to explore more who contributes to whose capital flows, and thinking about, I think you have more time series data, so thinking about time variation in that. So during you know, you have nice episodes like nice episodes like the taper tantrum in there, so you can look at stressed versus non-stressed times. All right, thank you very much.
So now we have 10 minutes for more questions or to address these comments.
Should I respond first? Well, thank you. Great. I try to respond to the main points. Yes, your point about the flow of information is really well taken. And actually, I think you can think of, I mean, we call it, that's your other point about mandates, but okay, let's call it a friction for the moment. But we can think of this fund rigidity also as arising from information. What the evidence says is that when the UBS is optimistic about a group of countries, the fund receives more money, for sure. But then this money is not reallocated, you know, perfectly within the countries as a response to the individual expectation. So this is the evidence. Now, you can also think about that as information frictions as well. At least part of the, you know, you can think as, you know, this investor, me and you, has some different source of information, and one source is the information that comes from UBS. The other source of information, we can, you know, say that maybe part of it is controlled through the fixed effects, but that we identify the shock that comes from, you know, the advisor in the bank, you know. And how do capital flows react to the advisor, to this advice in particular. But yes, we should definitely discuss this more and talk about, where does the, money come from, and this flow of information is really, really important. The mandates, yes, definitely. There are active and passive funds, and that explains, what we call portfolio rigidity, portfolio friction is actually probably coming from passive funds. But whereas this is not a friction from the point of view of the investor, this becomes an issue for the countries, because it does create these spillovers. So what is optimal from the investor side is not necessary. This is how I think, about it. Now, how to make it better from the receiver side? We see that there is a lot of concentration. Maybe this concentration of portfolios is too high, because the rigidity is not enough. You need also the granularity. And if portfolios were less granular, it would be more of an issue. So maybe having shares that reflect more the GDP, or the market capitalization of the countries would be better than this concentration of portfolios. But yeah, you're right that it's not a friction from this point of view. And yes, it drives a lot of heterogeneity. This I completely agree. Some results I did not show you. What we have so far is the geographical heterogeneity. But we will receive new data where we have also the passive, the different mandates, so we will explore that as well. And in terms of representativeness, so for the moment, our sample ends in 2016, and we have extended it recently, and EPFR is much better in the recent years in terms of coverage, so we hope that we will have a more representative. But yeah, so I will stop here maybe to take a few more questions if there are any.
Just in terms of the broad picture, I think I understand your point about the lack of diversification within mutual funds. Maybe those are specialized, and thus there is this granular residual. What I don't really get is why you don't have diversification across mutual funds, which should matter in the aggregate. And this, maybe you talked about this, but I think I missed it.
Yes. Yes, very good question. Actually, we have to quantify this, actually, this point, because you have two types of granularity. You have if you take even the average share across funds is concentrated. And this is already a problem for aggregate shocks, aggregate expectation. And then you have another layer of granularity, which is the granularity of the funds themselves. So we plan also to decompose, the rule of idiosyncratic expectation shock at the fund level, and the granularity of the funds, and the granularity of because if you, yeah, I could have shown you, but they are concentrated even if you take the average across funds. Yes.
This is a very, very nice paper. I have two comments. One, actually want to go back to what I don't want to butcher the pronunciation of your name, but what she said, I have to work at it. But in terms of the fund mandate, so that's actually quite important. In fact, we have a similar paper to you with Mark Agyar and Geeta Gopinath. And when we were presenting in 2025, Vanya asked the same question to us to separate inactive and passive, active and passive funds. And we did that actually, and it took us some time to extend the data, as you say, EPFR match and the consensus expectation match. And that makes a big difference, which is again, what she said, what Vanya asked us. So that's important to look at. And the other thing is, so you started the presentation is, there's this funding shock view, and then there's the what about expectations. I love it. I think I fully agree that we need to be looking at both. But of course, there's also the possibility, and you treat them separate, right? And you say, okay, let me now go to that expectation route and try to understand. But they can be, of course, endogenous to each other, right? So I have a paper on 5 facts of the UIP joined with Liliana Varela, and this is exactly what we showed. Actually, the funding shock is going to be endogenous to expectations of the investors, and expectation of investors endogenous to I mean, not exactly fundamentals, but the way policy is conducted in the country. So policy uncertainty, basically. So in that sense, they can be related, and that would be an interesting avenue to extend.
Yeah, no, I fully agree. So we know from the literature on expectations that shocks to profitability at the firm level, for instance, it does affect the expectations. And I'm sure that it's the same at the bank level with the funding shocks. But we do control for that through the fixed effects. So we have fund time fixed effects. So if that, any shock at the fund level, if it's a source of endogeneity, this is going to be controlled for. And really, it's the identification comes from, a bank being more optimistic than another one on that country at that moment. Yes.
Very nice paper and very interesting. I mean, I'm biased. I love this research, as you're going to see later on. But just a few comments, and I'm sure we'll chat later more. So in terms of this P and frequency of rebalancing, I'm a bit curious whether the empirical estimates you get on P are consistent with the data. So you get that at monthly frequency, rebalancing in equity funds at about 50%, at quarterly it's 75%. So actually equity funds rebalance way more than fixed income funds. So that's one. Two, thinking about information propagation, kind of a little bit what Sveti was referring to. So if the final investors are responding to, let's say, consensus economics beliefs, the fact that the fund portfolio manager is not rebalancing could be because they're just not using the same expectations, right? So the step that is a bit missing for me is, are these forecasts, good of actual realizations? Clearly, the fund managers hopefully will be more sophisticated than the final retail investor who might just look at consensus economics and says, that's where I'm putting my money. Also contrasting actually behavior of final investors, how much are they looking at consensus economics versus lag performance? There is massive literature on lag performance. I mean, I have a laundry list of questions, I'll leave it at this.
Yeah.
Yeah. Also, I from time to time to take care of the exactly.
Okay, happy to talk.
Yeah. And that's your control of the content. Very strong primary, what you said, the information in the future, which is based on the past paper. So that account for that.
Okay. No, I will be happy to you tell me. Yes, so we compare to the existing data. This P, it's kind of consistent. The frequency is less than what you mentioned. It's yes, it's 25% per month. So every 4 months. Once every 4 months on average. But remember that here we're mixing a lot of different funds. And kind of want more to like delay the conclusion when we have more detailed, and also we can distinguish more clearly between passive and active funds.
May I say something just?
Sorry.
Last question.
Okay, move to the next.
I was before. Okay, fine. No problem.
But okay, sorry.
Come on, no problem. May I say something?
Yeah.
No, 2 seconds. 2 seconds. Let me go back for a second to Rigobon. Okay, it's an old literature. Okay, but we have learned a lot out of Roberto's paper. So one is there is a lot of interdependence between those countries. So I change expectation on one. I create a lot of because I know they're interdependent. And when he controlled for that, the only contagion was with Russia, and there was no spillover in reality. So it went through interdependence. The second lesson was the dimensionality of the shock. Okay, dimensionality of the shock matters a lot. Okay, so we have to control, because otherwise we have a bias in the estimates. Okay, we have to control for the dimensionality of the shock. An epsilon shock has a completely different effect than a big shock. And also when you do the decomposition, I wonder how many times you have to accept orthogonality among the components of the composition, and these orthogonality assumptions are very effective when you have to control and understand each component. And I was fast.
So these shocks by construction are orthogonal, I would say. And we also make sure that the granular shock, it has also when you take one country, the granular shock is also correlated because there is the idiosyncratic component of the country, and this we also take away. So we are able to, we make sure to reconstruct the true idiosyncratic component that is due to what we measure as idiosyncratic directly, and also the part that comes from granular. Because if you take Brazil, the granular component of the portfolios that have Brazil in them, well, they are driven by Brazil, so it's not really granular for Brazil. So this we take into account. Yeah.
Okay, maybe we should continue with the next presentation, and you can continue the discussion after that. Thank you so much. So now let's continue with Silvia Miranda. Yeah. So you can start. No, that's okay.
Can I help you with the microphone?
Maybe.
It's okay.
Yeah.
Sorry.
Now I'm a bit. Yeah, no, me too. But I didn't expect a lot of, hopefully not many people are watching. uh, there's a lot of that because they build up a lot.
No, I think that it's not gonna work like that, right?
I have it.
It's here. So
Yeah.
it's it needs to
Okay.
just
Okay.
maybe move the laptop like this, and then it.
Okay. All right. Okay. So thank you for having me in the program. I want to start by just thanking the organizer for putting together this event, which is really, really great. I couldn't make it last year and I really missed it. So thank you for putting me in the program this year. I'm presenting today a paper with my ex-colleague and good friend Ambrogio Cesabianchi, who's at the Bank of England. And because we are both at central banks, both disclaimers apply. I want to also add a mini disclaimer that the paper is actually very, very preliminary. This is also sort of a preemptive, how do you say, I don't know, asking forgiveness to the discussant because the paper is actually quite preliminary. But so, I really welcome comments and suggestions that you might have on how to take this forward. So the paper is titled Preliminary on the Aggregate Consequences of Belief Distortions. And what do we do in this paper in a nutshell is the following. We're going to try and empirically estimate the effect of belief distortions, which I'm going to define very precisely in a minute. And the way we do that is by exploiting information in appropriately timed forecast revisions, okay? For this exercise, we're going to use a particular data set of expectation. These are the IBES earning forecasts. Now, this is a data set that's actually quite popular and famous in finance, but not so much in empirical macro for some reason. This is a data set that collects analyst forecasts about earnings at the firm level. Okay, now our subscription only gives us the consensus of all the analysts that follow a particular firm. We don't have access to analyst level data, but we think it's not necessarily crucial for this application. The dataset covers publicly listed firms. We're going to focus on the US for this exercise, but like the dataset is actually much wider than that. And we're going to be able to track expectations at quarterly frequency. So it's quite a rich data set. The key feature of the data set that we are going to explore is the fact that the IBES forecasts are continuously updated. Okay, and so we are going to be able to track how expectations change over time. Just to visually show you what I mean, so imagine that we are at the beginning of the quarter. I'm going to use T for the quarter. Lower bar T is the beginning of the quarter. So say, imagine the reference quarter is Q2. Lower bar T is the 1st of April. At the beginning of the quarter, we're going to record the consensus. So we have a bunch of analysts that formulate an expectations about the firm's earning per share in relative to the second quarter. Then over time, this forecast changes, and it changes for a variety of reasons, but two of the main reasons are first, that there's new information that comes in about the firm, and so of course, analysts will update their forecast. But because we have access to a consensus, this can also change because new forecasters contribute their expectations. This goes on until we reach the end of the quarter, okay? And then at that point, we record again the expectation, the consensus expectation about the firm's Q2 earnings that is formulated at the end of the quarter. So this is the 30th of June now. And then after a few days or weeks, the firm will actually publish their realized earnings. Okay, so this is the setup that we have, and we have this for all the firms in the sample. Okay. Given these ingredients, let me tell you what the intuition is behind how we measure and identify these belief distortion shocks. First of all, let me give you a definition. So the belief distortion shocks that we have in mind have two main features. The first one is that they will affect the way in which analysts perceive the firm earnings. But the second feature is that they will not affect the earnings, the actually realized earnings. Okay, so if you have any demand shock, that demand shock will affect both the earnings and the perceived earnings. That's not what we're trying to identify. Really, what we are focusing here is on something that will change the perception of analysts about the earnings forecast, but without actually changing the earnings. Okay. To be able to measure and to identify this shock, if it even exists, we are going to use two expectational variables that we create using the IBES forecast. The first one is the within quarter forecast revision. So this measures the way in which analysts have revised their view of the firm's Q2 earnings from the 1st of April until the 30th of June. Okay, so how they've updated their expectation for within the quarter for the earnings of that same quarter. Okay, the second expectational variable that we construct is the the 1 quarter forecast error effectively, and it's defined relative to the expectations at the beginning of the quarter. So this is the error that the analysts make conditional on the expectation at the beginning of the quarter. Okay. We do this for all the firms. We collect this data for all the firms, and then we calculate these expectational variables. This is what these expectational variables look like in the cross-section. We construct also economy-wide aggregate quantities, which are in the charts the thick lines, whereas the shaded areas are effectively the cross-sectional dispersion across the firms, okay? And the economy-wide aggregates are constructed as in the 2 formulas at the top. They are simply a weighted average across firms with weights which are a function of the firm's assets. So basically, larger firms are weighted a bit more. One main takeaway from this chart is that if you look at the thick lines, they look actually quite similar. Okay, and this shouldn't really surprise anyone because given the definition of the 2 variables, these are the revision of expectation within a quarter, and the other one is the forecast error made at the same, effectively over the same time interval. Okay.
The forecast error, you use the realized error.
Yes. The different, okay, so given these 2, then we go into the identification. And this slide is the paper. This is the idea. If this doesn't work, then we can all go for coffee right now. But the idea is the following. So going back to the definition, so the definition had 2 legs. The first leg was that the shock affected the analyst perception of firms' earning. Okay. Using our expectational variable, what that means is that this will enter, if it exists, if it will enter the forecast revision. Okay, so the revision, the way in which people update their expectation within the quarter will be a function of what? The structural shocks that hit the economy within the quarter, which we call epsilon t, and this potential belief distortion shock, which we call omega t. The second leg of the definition is that these shocks do not affect the realized earnings, okay? And so if we then translate it into the expectational measures that we've calculated, then what this means is that effectively the forecast error will only be a function, conditional on expectations at the beginning of the quarter. It will be a function of the structural shocks that hit the economy within the quarter. Okay. Now, this definition has a very nice orthogonalization embedded in it. And this is effectively how we are going to identify the shocks. They don't have to be.
So then you come to the structural shock that impact this quarter. Lagged structural shocks can impact the T-1 quarter.
Sure.
No.
I'm happy to get questions, but this is all conditional. Remember, this is all conditional on the beginning of the quarter. So because the expectation, so I'm not comparing the forecast at the end of the quarter with the realized earnings. I'm comparing the forecast revision within the quarter with the forecast error made conditional on expectation at the beginning of the quarter. So it's like the world starts at the beginning of the quarter. Everything is conditional on that point. So you might have that this F lower bar T, does this work? Ah, very good. So you might have that this F lower bar T, which is the expectation at the beginning of the quarter, is not formed in a rational way. I'm not making any assumption on that. Whatever this is, it appears in both. So whatever it is.
Your forecast error can be a function of lagged structural shocks, which will be consistent with deviation from phi, which we know is it.
Yes, and it will be. Okay, so given this very nice triangularization, then what we do, we just set up a VAR, very, very simple. The VAR will have a vector of variables of interest, which we call XT, and then we append to the VAR the aggregate forecast error and the aggregate forecast revision. And then, it follows quite naturally from the definition that what we call the belief distortion shocks are innovations to the forecast error that are orthogonal to the forecast. Sorry, no, innovations to the forecast revision that are orthogonal to the forecast error, okay? One way to interpret this is a revision in expectation that is not accounted for by the information released in the time unit. Maybe this is a push, but it's one way to think about it. Okay? Okay, so this is the paper. Now, before I show you what the results of these impulse response functions are, I want to give you just a couple. Am I being too slow? Sorry. Okay. So before I show you the impulse response functions, I just want to give you a little bit more detail about this data and why, like on top of the fact that they have a very nice continuously updated structure, I just want to tell you a little bit more about the quality of the information that they capture, okay? And so the first thing that I want to show you is that they are actually very highly informative for firms' investment plans, okay? These are people that they are not the decision makers in the firm, okay? They're just analysts whose job it is to follow their stock analysts. This is people whose job it is to actually follow the firm. So to show this, we effectively replicate with our data a regression that was set up in a paper by Jen Aioli and co-authors a few years ago, where we basically, what we do is we regress at the firm level the year ahead investment on a bunch of firm level controls and the expectational variables, which are the XT, okay? And what this table shows you is that expectational variables are informative for firms' investment above and beyond standard controls. And the standard controls are things like current investment, asset growth, funding costs, and things like that. Okay, and the sign also makes sense. So for example, if we look at the sign that is associated to the forecast revision, what we see is that it's a positive coefficient in all the cases. What this is telling us is that typically when analysts upgrade their forecast, this is correlated with future investment growth, okay? So these are very informative forecasts. What this means is that these people are able to aggregate a lot of information that is relevant for the firm's prospect. I'm sorry, I'm always not looking at this side. But now, at the same time, however, even if these are very informative forecasts, these forecasts are subject to the same deviations from the full information rational expectation paradigm that have been documented in the literature for other forecasts, for other type of surveys. So, for example, we show that they tend to underreact to news. We show this by applying the setup of Koibion and Gornichenko to this data at the firm level. And what you see here, going back to the point that Vanya was making earlier, is that if you regress the ex post forecast error, so the future forecast error on the forecast revision, this is not the same forecast error that I mentioned before. So this is the forecast error that's made on conditional information at the end of the quarter. So it's in the future relative to the revision. These two things should be completely uncorrelated because they belong to separate points in time. And in fact, what we find, this confirms the results in Koibion and Gornichenko, that the coefficient of the regression not only is non-zero, but is also strongly positive. And what that means is that when these people receive information, they tend to upgrade their forecast in the right direction, but not enough effective. On the other hand, they also don't really seem to extrapolate. So again, the forecast error tend to be they tend to correlate with the actual realization in the future, but they don't seem to extrapolate. The extrapolation here would have a negative sign. So this just to tell you that these are high quality forecasts, very highly regarded, but at the same time, they do show, they have features that people have connected to failure of the full information rational expectation paradigm. And so there is some hope that we could potentially find the type of belief distortion maybe that we have in mind. Okay, so let me show you this impulse response functions finally. Let me just remind you very quickly of the setup. The X variables, these are aggregate investment the stock market index and the excess bond premium. Very simple. It's a quarterly VAR from 97 to 2018, just because this is the data that we have for matching with the credit spreads, but we're working on extending the data. The identification is, so I'm going to focus on a positive shock. So this is a positive innovation to the revision that is orthogonal to the forecast error. You can think of it as over-optimism, if it's easier. So this is people revising too much relative to the information in the time unit. And these are the impulse responses. Okay, and so what we see, so the revision is positive. This is by definition, by normalization, it's a positive innovation. But then the response of real investment of the stock market and the excess bond premium is clearly negative. Okay, how do we interpret this? So what you can, this is a shock that basically picks up a revision in expectation that is not accounted for by the information included in the contemporaneous forecast error. Okay, so it's orthogonal to the information in quarter T. This excess of over-optimism, so the way we think about it is that, like, when analysts are too optimistic, then they are negatively surprised by the fundamentals that realize, okay? And so effectively, this translates into a negative news, okay? Which you can see in the fall in investment, the fall in the stock market, and the rise in excess bond premium. And now, this is a very conservative type of ordering, because we order everything last, but in fact, even if we put the expectational variables first, we have exactly the same type of responses, provided that we order the forecast error before the forecast revision. Okay, so this orthogonality, but what this is telling you effectively is that it is sufficient to control for the forecast error to have that orthogonality. Okay. 5 minutes. Okay, very good. So let me just now give you, let me just say a couple more things on quite an important point. So if we go back to the timing of the elements that I discussed earlier, I mean, this is very much the same chart that I had before, but just sort of squished in 2 dimensions. Beginning of the quarter, expectations formed at the beginning of the quarter. End of the quarter, expectations formed at the end of the quarter, realized earnings. Now, in practice, the forecast revision that I've defined lives in the interval from lower bar T to upper bar T. Okay? The forecast error lives in a bit of a different window, which goes from lower bar T to upper bar T plus delta, which is the time at which the earnings are actually realized. Okay? Now, this could be a problem because it is possible that shocks that pertain to the quarter are actually revealed after, right? And if they are revealed in this interval here, then they will enter the forecast error, but not the forecast revision, and they would go into the thing that we are trying to identify, okay, with the negative sign. So this is potentially an issue, right? Now, the good thing, I suppose, is that we can actually measure exactly what happens at that point in time, okay? Because we have the forecast produced at the end of the quarter, and so we can construct what in the real-time forecasting literature is called a nowcast error. Okay, so it's the error that the analysts make conditional on the information that at the end of the quarter, which in theory should capture information that's released in that time interval. Okay, so what we do is for all the firms, we construct these nowcast errors, we aggregate again at the economy level, and then we put them in a slightly different VAR. This is a VAR that contains only variables whose realization is actually known at every point in time. In the previous VAR, I had also investment, I have the BP. These are variables whose realization is not known precisely at every point in time. This is the stock market, corporate bonds, and corporate bond spread, and the term spread. So these are all variables that of which we know the realization every day, okay? And then we look at what a positive innovation to the now-class error does. Okay, and in fact, what we see is that it doesn't seem that there's any systematically relevant information that is released in that little time interval. Okay, so I suppose this is a way of saying that it is potentially an issue, but in practice, it doesn't seem to be the case that in this late information has actually a lot of explanatory power. All right, so this was this concludes. So what we do in this paper is to define belief distortion shocks as shocks that affect analyst perceptions of firms' earnings, but do not affect earnings, the realized earnings. And we identify them using innovations in the forecast revision that are orthogonal to the forecast error. What we document is a systematic negative reaction to a positive innovation, which we interpret as a sort of over-optimism. It'd be nice to have a bit of a theoretical framework, but we're still not there. And what we think that the mechanism is that when forecasters are too optimistic, they effectively, what they do is they initiate a stream of negative forecast errors because their too optimistic expectations is too good relative to what the actual fundamentals are. And so this translates into negative future news. That's all I have. Thank you.
Thank you so much, Silvia. Very interesting work. So now it's time for the...
Okay, so first of all, let me thank the organizer for inviting me to discuss this super interesting paper. And well, since I come from the ECB, user disclaimers apply also for the discussant. Okay, so I will first try to summarize in words what Silvia Ambrogio tried to do in the paper, and then I will try to provide some, let's say, high-level comments that I got, curiosities that I got while reading the draft. So the paper is about beliefs distortion, and we know there is a lot of, there is a literature saying that belief distortions can have important consequences for the economic dynamics, but these are hard to measure empirically. And what the paper really nicely tried to do is exactly go on this hard part and to empirically characterize the beliefs distortions. How? Well, to correct me, Silvia, if I'm wrong, but what we are trying to do is to have a forecast revision and to disentangle within the forecast revision what is information and what is belief distortion. And to do that, there are essential elements that need to be to be considered for the analysis, and it's the timing of the forecast and the deviations. So it needs to be pervasive. How do Silvia and Ambrogio do this? Is by using a super nice set of data, which I was not very familiar with, and it's the IBES earning forecasts. The main findings that they find are that those survey data have the proper feature to distinguish the information from the belief distortions, and that the belief distortions have important consequences empirically tested for economic dynamics. So let me have the first comment on actually one of the last things that Silvia mentioned during the presentation, and it's the role of this late information. While I was reading the paper, it was nice. Silvia and Ambrogio do already a lot of tests, but I was left a bit with the feeling that this is the weak spot. So I think introducing also qualitative
a qualitative idea I was of what is the gap. I couldn't really figure out if it's a matter of days, of months, if there is really relevant information released in those days, or if there is really nothing. And then it also corroborates the point that, okay, it's true, we take the results from the VAR, there is the nowcast error is not important, because also there is no information relevant appearing in these days. So, related to this, I was wondering, is there any way to have also surveys that offer backcast to align the information? So are the earnings surveyed also after the end of the quarter, such that you can really align to the day in which they are released, or not? Because it could also be that they stop forecasting those. Then instead, you didn't spend too much time during the presentation in how you construct the measures at the aggregate level of belief distortion, but you use a lot of micro level information. So I was wondering if there is a way to also use this information at the micro level. So from my macro perspective, not to look only at the median or mean, but also at the distributions, because maybe this can help you. I don't know how, but to characterize the beliefs distortions and especially their impact on the macroeconomy. Now there is a lot of risk or literature on risks, on tails. So if the distributions of this distortion is skewed, can it give us an hint or some useful information that we can extract? And so partly related to this, I was wondering, what about inverting the order in which you build your measures? So first computing the belief distortion at firm level, and then aggregating those to obtain a measure at macro level, because from what I understood, you are doing kind of the opposite at the moment in constructing the measure. But again, it's just an extra type of information that, given the richness of the data set that you are using. And a third, and this is a comment from my practitioner point of view, is on the effects of macroeconomic developments. You take in you look now at investments. I think this impact of belief distortions on the macroeconomy is super interesting, and can it be expanded to other macro variables that we in a central bank, for example, are typically looking at? And also coming from a central bank environment in which many times we look at surveys, what about other surveys used in the macroeconomics? Is there a way to understand the beliefs distortions also in those that are maybe more standardly used in applied macro? Is there a way also in that sense to understand what is a belief distortion and what is not, despite I do understand there might be more timing issues that weaken the identification? I'm done, basically. It was very interesting to read the draft of the paper, and I hope it was useful comments.
Can I? Yeah. So thank you, Claudia. And again, sorry whether it's a bit of it, there's entire parts that are still missing in the paper. So thank you for going through it and for the comments, which are all very fair. I mean, these issues about the timing, I agree with you. It is sort of the weakest link. It's not something that we can do much about, in the sense that the timing of the forecast is what it is. And so what we try to do, what we have done at some point, is to do what you suggest and to sort of go forward in time and look at the backcast. But then the timing with the macro variables is all completely, so you win on one side, I suppose, while having to let go of some other properties. I guess it's something that we can still have in the paper just to, to sort of convince, maybe convince the reader that effectively is not such a big, deal. The question of how big the interval is, it's something that varies a lot actually across firms. So it's not, I don't know that I can give a unique answer. So it is possible that for some firms there might be big macro announcements, say for example, that happens. But if that is the case, then they should also affect, if they are shocks to fundamentals, then they should also affect the earnings. And so in some sense, I don't think that they would be picked up. But it's not clear, right? Because this is also depending on, every firm will have their own release dates. And so for some firms, this information will go in, for some other it won't. It's not clear, but it's something that we can explore a little bit further. I like the idea of the moments we haven't tried. It's something that we can explore. On inverting the ordering of the construction, this is also something that we've done, and in fact, it actually makes the estimates a lot more powerful. And so we thought, okay, let's leave it as no more power, but more precisely estimated, because of course you do the orthogonality at the firm level and then you aggregate, and so a lot of the idiosyncratic sort of washes out, but the results are very much consistent. On extending to other variables, absolutely can be done. On extending to other surveys, I don't. The honest answer is that I don't know, but I suppose it will have to depend on the timing of the survey. I mean, we use a lot this assumption on the timing on when exactly we record the expectation. So it's not clear to me that we can use any of the other surveys that have very specific release dates that happen typically in the middle of a quarter or in the middle of a month. So it's not clear that we could make the same timing assumptions. But thank you so much.
I might be one of the few people that actually work with the IBES data, looks like, from what you say. No, but I was thinking that one interesting thing that you have in the data, or features of the data that you could exploit, according to the accounting and the finance literature, could be the industry specialization of the forecaster or the analyst, and also, new entries of analysts, because that's all information that could be relevant in order, to kind of quantify beliefs. Then another thing I was thinking is that the literature is very clear that firms try to beat earning forecasts. So they watch quite closely what the analysts actually are doing. Will this impact your results?
Sorry, I'm just taking a note because then otherwise I forget everything. On the first point, we don't have, like, our subscription to the data, unfortunately, doesn't give us access to the analyst level. So I cannot see that. But maybe something that we can explore for a subset, if we buy the data for a subset of firms. This other point that you make is actually a bit more. So what you're saying is a bit more like a reverse causality in a sense, right? So what you're saying is the firms watch what the analysts do and they try to beat what the analysts do. And so if that's the case, then they will try that their realized earnings will be always better, or more systematically better than what the forecasts suggest. I'm not excluding that might be a possibility. In practice, from the chart that I showed you, like, you could see that the distribution of the forecast error actually goes from negative to positive in quite a symmetric way. And so I'm not saying that it's not an issue ever, but I don't think that it's a systematic issue in the sample. But this is something that we can probably look into a bit more. Thank you.
So let me go back to the IBS data. Okay, it may be that macro person, so don't know anything about it, but in finance, everybody uses IBS data. So the first part of the paper looks like a justification of the quality of IBS. I think you should put in the appendix because, I mean, everybody knows the quality of this data. Okay, you go to the Wharton,
Not
you
in
know,
macro,
you
though.
work the Wharton web, no, in Wharton web you get the IBS. It costs a lot, and you get the data. Okay, so at the same point that she had in terms of revision, who is entering into the pool, that might, of course, affect that. You could see whether that is the case. So I think it might be relevant. Also, since you start from microdata, why don't you exploit a little more the microdata and see the shock that determines, for example, the revision? It could be an announcement, innovation announcement that will affect earnings afterwards, okay? So can you disentangle what determines the revision? It could be a big shock, a small shock, a global shock, a technological, a sectoral shock. So you have to enter more, I'm sorry, into that, okay? But I think you have to exploit the characteristics, the originator of the data, which is wonderful from that point of view. And that makes your point even stronger. That's my feeling.
No, yes, it's a point absolutely well taken. This is the reason for why, I mean, we also merged it with Compustat and with another data set of firm level credit spreads, because the idea is to run the analysis at the firm level. I suppose we wanted to see first if it kind of, you know, if it kind of worked.
Or not,
Exactly. I'm being very, you know, very non-strategic here, but I suppose like we started with the aggregate,
in the reverse causality, because at the end, data should be the right one. So if you really want to beat the market, at the end, the market is going to beat you. And because you have to justify.
Yeah, but no, but absolutely, like this is definitely like exploring a bit more the heterogeneity across firms. Also, these are firms that belong to different sectors, so they might behave in a different way. So this is absolutely something that we want to explore. I suppose at this stage we are still sort of thinking about whether the identification makes sense. I guess, but it's absolutely a point well taken.
I'm struggling a little bit with the interpretation of measures of shock, which I think is trying to the direction of the bar. So we know that, so I understand and I identify that you're trying to differentiate deviation from full information and versus fractional situation. Everything is saying, these guys are one to finish 9 to 5. But we know that this deviation from higher measures correlate very strongly with lag observed variables, right? If the up variable can change at least 60-70% of these errors with lag observed from the multiple years. So you need to clean incredibly well your shock that you are capturing for any observables on the form, like lag observables on the form. Because think about it, like any model can have deviation from higher, and is still a function of the same aggregate shocks, which is more specific to aggregate shock, right? And they are going to show up in form level lag variables, in map variables, and then essentially the forecast is responding in a suboptimal way. So the only deviation from higher, unless you are reducing height of relief, which I think is what you're trying to capture, right? In a shock, if you want to call it shock. Because the fact that we have to invest and we find measurements investment is because the culture of lag investment,
I mean, yes and no, because the lag, there's an implicit lag. I mean, not implicit. There's an explicit lag. I mean, we can do it, but this is also in the agro. So if you think about it, sorry, do finish first.
Yeah, in a sense, for me to truly buy this as a shock, given that pretty much every single one of the regional fire focuses on is the same from level and average shocks we know, we're just responding to them differently. And for me to believe that you're capturing some exogenous belief of some investor that doesn't wash up, so you get a sense, right? Even if I believe which I do, that you can use in quite some different investors, why don't you aggregate them? You need to have something remaining in the aggregate. So that's one.
Exactly.
And so that's, usually there's a lot of discographic variation, and even in the forecast, you can plot it a bit, right? And cancel out the same data that you guess. So then you're getting a master average exclusive equation. There's an other component of deviation profile, orthogonal platform performance, variables, etc., which you don't really in the program. I'm just wondering if this is we're gonna get a lot of pushback from the quiz. We call this a shock.
Right, I mean, I suppose you can call it, I mean, it's a shock in the sense that it's an innovation, right, in the VAR. But let me just get back to that. So there's an assumption that we have to make when we do this, which is that at the firm level, effectively we have to assume a factor structure in this setup, right? Because what we do when we calculate all these expectational variables at the firm level is that we then aggregate them, right? We take this weighted average. Now, taking the weighted average is it's a way of taking a factor, right? Effectively. So we are excluding a lot of idiosyncratic movement there. Even so, and we get these two expectational variables that they are an aggregate across firms, right? So a lot of the cross-sectional variation is skilled, effectively. And then these are defined over very similar time interval and are put in a VAR which has lags in it.
Yeah, so you have two variables and two lags. I mean, to do it properly, you need to go from the essentially, you need to think about every information set of forecaster I when they did forecaster firm J. Clean all of the variables, the lags, right? Because that's what the deviation file the model shows up. I'm putting a different weight on this observed first specific level variable service to the rational weight that I should put in the model file. And that is a very different exercise than going so algorithm just cleaning for that investment, right? So we can truly believe that you're cleaning the Q1 collection. And then you can be very specific that a bunch of people have idiosyncratic beliefs that don't love shopping, which is possible, right? That they talk to each other, right? I believe that there is kind of.
I mean, this is also not necessary. I mean, in this setup, is not the idiosyncratic belief relative to a particular firm. This is aggregate, right? So this is it's a bit different to what you have in mind, I suppose.
Yeah, but you should look at it from there, right? So let's go to. I presume you're going to do it from there, which I think absolutely you should. I think you have to do this at one level. Anyway, you need to think about a model first, the deviation profile, which vast majority of them, there could be some idiosyncratic component, which I think is what we are trying to capture. And then you portray the people, yes, I'm cleaning all of the rest, right? The fact that they just have variables in the information set that they put the wrong weight on, and that's why I get the massive correlation of forecasters with that variables, which we know explains a lot. Right? And we don't get so.
I think that we should end
Yes, okay.
this session here. So thank you so much to all the presenters and discussants and all of you that taking part of this amazing session. So yeah, thank you.
So now it's the break. It's a bit far where the coffee is, so please follow us because the bank is a maze and it's easy to get lost. So be sure to follow us so we get you to the coffee and pastries. Yes, no problem. You can leave everything here. It's not a problem. Yes, thanks.
Claro, yo la estaba pillando, pero no sé que estaba ahí de fondo. Vale. Hola, hola, hola. Sí.
Because it was green. Oh, sorry, this is magical. Hi again. Good morning. My name is Belén Carreño. I'm a Reuters senior correspondent here in Spain, and a little bit overwhelmed for you ladies because I did not expect the audience to be such an expert, because you know that journalists, we didn't read mails until the end. So when Beatriz invited me to do this, I just thought it was another event that I have to moderate. I moderate a lot of events, but never so good as this one. So I'm a little bit overwhelmed. I do really thank Bank of Spain for inviting me. I understand that they know that I always advocate for gender to have much more presence, a bigger role in the Bank of Spain in this house. They know me because I sometimes protest in the middle of a press conference because there are no female panelists in the table. So I will say they invite me for this reason and not for my knowledge, which is very small in comparison with you ladies. So thank you again for this. We have an incredible panel here today. As you know, this is a panel discussion. It's a bit different, the format to the other format that you were holding with the papers and so on. So we will try to do this as vivid as possible. I'm going to introduce very, very shortly our panelists here, starting with Chiara Scotti. I hope to have pronounced it well. Okay. current deputy governor of the Bank of Italy. For almost 20 years, he worked for the Federal Reserve System. So it's a central banker here in the table, like for real. And then we have Helen Ray. She's Lord Bagri Professor of Economics at London Business School, and formerly she was Professor of Economics and International Affairs at Princeton University. And the very technical and impressive too, and I think I have here, sorry. Lilia Maliar is a professor of economics and chair of the economics department at the Graduate Center of the City University of New York, CUNY, and visiting fellow at the Hoover Institution, Stanford University. And she has introduced novel class of numerical methods, combining projection and stochastic simulation techniques. Very fancy in this, but we will try to understand more of this. I'm willing to. So I'm not going to hide. I have to tell you that 1 week ago, I didn't know one single word about how AI should apply to monetary policy. Now I saw that this is a super trendy, hot topic for you in the monetary policy. So I would love to start with our central bank person here in the table, Chiara. Well, asking if this is really happening, like if this is for real, if in a central bank as you, for example, Bank of Italy, or as far as you know, in the ECB, they are really already using these techniques and how they can like improve or they can affect sometimes with risks the current monetary policy. Thanks.
Well, thank you, first of all, for inviting me, and thank you for the question. So yes, the question is, the answer is, I think at the Bank of Italy, but everywhere around policy institutions, we are increasingly using artificial intelligence. And in general, I think that the numbers are just incredible around the world. And I want to just give a couple of numbers about how much spending on AI software is increasing over the years, because I think at least when I saw it, I was like, wow. So just to give you an idea, it will rise from 124 billions US dollars in 2022 to almost 300 billions by 2027. And it will grow, the part related to generative AI software will grow from 8% in 2023 to something like 35% of this share by 2027. So we're really talking like big numbers. And yes, central banks are using it all. They're using it in economic research, to try and take better decision about monetary policy. But we at the Central Bank of Italy, for example, we are using it also in other fields for regulation, so subtech, regtech, and all of that. And I can maybe go later into a little bit more details. Now, there are pros and cons, when you're using AI. And so I would like to point at least to a few of these. I'm sure that the audience here, knows a lot of that already. But in my experience, for example, there is still a little bit the issue of sort of the quality of what you get back. And, I was, years ago, I published a paper where I was using natural language processing, and we were trying to use different methodologies. And we ended up discovering that if you want to assess the sentiment of what the Fed says in newspapers or even on Twitter, you still need to use a dictionary that is able to understand a little bit better what really the Fed does. And so, what was out there, really didn't work. Since then, a lot of progress has been made. Another example is yesterday, there are many Italians, so I have to say this. Yesterday I was reading a newspaper, La Repubblica, and there was an article about OpenAI, the 01 version. And there is this guy who was mentioned, his name is Noam Brown. He happened to be my research assistant at the Fed back in the times. And then he decided that instead he wanted to do computer science. And actually the thing that he was trying to do was to write a computer code that would that was able to beat humans
in the game Texas Hold'em, like the poker game, which is not just a Beyonce song. You know, it's an actual you know, game that you play. But the difficulty is that when you have humans, you know, you cannot, like, a computer cannot understand if they're bluffing, what they're doing. So this is just to say that there is a lot that a computer still needs to understand before we get, you know, to the final line. There are issues related to privacy and security because you're using a large volume of data, and we all know about that. There is an issue with bias and fairness, and I want to mention it here because, you know, this is the appropriate place, but sometimes when you train on existing data, you know, old data where there were a lot of issues with biases, you know, the risk is that you carry those forward. There are issues about transparency and explainability of the models because they're considered a little bit like black boxes. There is a regulatory compliance, at least you know that in Europe now we are thinking about what we really have to do with the regulations related to AI. But there are also issues that are related to skill gaps and training that you need to do even at the central bank. You know, we were not born computer scientists, but now there are new skills that are needed. And so it requires, you know, new training, new learning, you know, day by day. And then finally, one last issue that I want to highlight is inequality. I think that we really need to look into this as well. I don't think, at least from what I had seen in the past, this is an issue that has been discussed a lot, but there is a paper at the Bank of Italy where the authors actually found that artificial intelligence can potentially increase inequality. And so these are just some of the things that as, you know, central banker, we are considering and looking at.
Thank you so much. Thank you so much. Precisely this last line, I think, is where Lilia could help us to understand more how to improve these models and how to improve, how to use the AI to avoid this kind of risk as inequality or to have a much better approach. So please, Lilia.
Hi, everyone. So thanks again to the organizers for organizing this session and inviting me. So my background is solving DSG models with global solution methods. And so we've developed some techniques, how to cast like DSG models into something that people in AI literature do, so how to write loss function, which methods to use. And we found that it does have some advantages. For example, central bankers are interested in inequality distributions and potential effects of monetary policy on different groups. And so these models would allow you to basically solve models where distribution is a state variable, right? So you don't need to make assumption only mean is important or variance is important, but you can really introduce into your model all the agents, like all population of your economy, and given kind of computational power given by AI and machine learning, so you can basically trace all the agents, right? And so in this respect, so we've seen that this type of approach could be useful to solve not only for equilibrium in Hank models, but also, for example, in like Ramsey type of problem with optimal monetary policy, right? So this was my kind of beginning with AI, and obviously, so you see so many wonderful applications in the other fields like self-driving cars, computer-side music, like handwriting recognition and so on. So you really think, oh, what can AI do for us, right? And so I think so it would be nice to learn all these techniques that exist and available, but at the same time we need to be mindful, know about their use, because many of them, they don't have any time aspect. You cannot really use them with time series data and so on, right? I am trying to use in kind of my research in other areas, like working with the data. And what I find that machine learning could be really useful if you care about like economic modeling, so you don't know about what variables are important or what model I need to kind of set up in order to resolve some issue, right? And so given that AI can work with lots of variables, you can really identify which variables are important without making any ad hoc assumptions, right? So you can, for example, take the whole data set without saying, oh, these 10 variables will be included in regression because they are important. So you can include all the variables, 6,000. We have this paper about the retirement and social security claimant decision in the US economy, where we included in our analysis 6,000 variables. Then we chose 20 the most important, and we compared the performance of our analysis to the standard model used by Social Security Administration, which is called MINT. And we had a huge increase in accuracy, which can be translated in billions and billions of dollars in savings in terms of you can predict better who is going to retire, right? Then other aspects, so you can, I've seen that it is maybe important also for macroeconomists and for policymakers. So sometimes you have limited data, right? And two opposite problems. One is limited data and one is too much data, right? So too much data, it's a big data. You can use all these AI techniques, right? Or you can use non-traditional data sets, like you can use, I don't know, so we mentioned sentiments, and so you can also do web crawling and social like Facebook and Instagram data and so on, right? But limited data could be also kind of an issue, especially if there is some new phenomenon you don't know, you don't have data. So my example would be, for example, electric vehicles. So in the European Union, there is a law that after 2035, all cars sold should be electric. So how do we predict the demand for this new product that never existed before? And for this, you can use a technique which is called transfer learning. So you collect some data, then you train the data, and then you predict the demand for the future. If you have data only for the US, you can have the same model and predict for Europe. So something that allows you to extend your possibilities, right? Another thing that I would like to mention is about nonlinearity, right? So we use often we like do linear analysis with linear regressions, and obviously in some cases policy should be more nuanced. So we do want to know should the policy be the same during expansion or recessions? Should it be applied to the same in the same way to different subpopulation groups and so on? In this case, AI is very useful. So first, everyone knows about neural networks or, for example, decision trees, right? So they allow you to identify nonlinear relationships in the data, right? But also we need to kind of take into account that those, they do not allow you to incorporate time aspects into the analysis. For that, what would be useful is so-called Bayesian neural networks that would allow you to work with finite, not very big, large time period, right? So up to, let's say, t. And also you can get not as many variables as neural network, standard neural network allows you to work with. And then there are plenty of techniques that will allow you to find interpretations for your findings, right? So you kind of use all those techniques to then deduce what your model should include, right? And this is like information derived from the data. And so techniques like Kolmogorov-Arnold neural network or Shapley values, they would do precisely this. So you will be able to discover your own kind of regularities from the data without like using standard econometric techniques, right? So this is what I know, so what I was looking at. So I'm sure there are plenty of other different things. So I hope we find them useful. Thank you.
Thank you so much. So Ellen worked previously in the Macroprudential French Authority. So I think maybe you could tell us if the AI is helping to really prevent new crises or to detect or even to tackle, if this is possible.
Thank you. So yes, I thought I'd draw on my experience on the French Macroprudential Authority for 10 years, during which there was no crisis.
Thanks to you.
Of course.
That's a good record to avoid it, no?
So now that I'm, not anymore in it, I'm not saying anything. It's, but I think macroprudential authorities and people in charge of systemic risk in general, I think it's a very good ground for the use of AI and machine learning tools. Because as we know, systemic risk is an extremely multidimensional object. So there are many, many variables, many models that have been developed by us economists in particular. But we never exactly know where to look. We never exactly know, the timing of financial crisis. And I think machine learning, which is, I would say a sub-branch of AI, because I don't know, I'm not an expert on all of AI, but I've practiced a few machine learning types model, are precisely useful to aggregate data when there is a lot of information out there and we don't exactly know how to put it together. So in that context, I was working with a bunch of co-authors, including Vanya here, on online aggregation in machine learning, which is about precisely having a very wide categories of models, including binary random forest, or you can take neural networks, or you can take human expert judgment or whatever, and trying to find out which ones were the best in real time, so out of sample forecast, to forecast systemic banking crisis. And I think by doing this research, I think I kind of learned that indeed this is very useful, because I think it's kind of outperformed essentially. In a way, asymptotically, it's by construction that it outperforms any model, because we can put any model in the set of models with which we do the prediction. So if there is a good model out there, then that model is going to be picked by the aggregation technique. The model aggregation technique can become a dominant model, so it will perform very well. But usually there's not one model. Usually it's really a combination of model, or it's a time-varying combination of model that is going to be actually the best out of sample predictor. And if this is the case, then this type of aggregation, pretty sophisticated aggregation methodology, will enable you to beat essentially anything which is out there. At least that's my strong feeling after having worked with those models. It is still the case that, of course, you need data. So and you're still building in that category of tools. You are still building with historical data. So there is the type of issues that actually Lilia started to mention, which is how do you deal in this type of aggregation techniques and this type of machine learning? How do you deal with things that are totally new, right? So can we transfer some of the learning that we had? For example, in financial stability, it would have to be with financial innovation. So we know that some types of financial innovation have had destabilizing effects in the past, but financial innovation is a concept, right? So then it's incarnated in different types of products over history. And so what we have to think about is how do we put in this type of models measures of financial innovation that will be informative, knowing that it's not going to be asset-backed mortgage securities next time around. It's going to be something we don't exactly know, but we would like to have that information in the predictor. So there's a type of issues like that, which I think are very interesting analytically to think about, and that are quite complicated. But my feeling is that we are not using enough at all these tools. So, even so, I can talk about the Banque de France. So I mean, there are people, using those tools a little bit, but I don't think it's very widespread in my experience. And also, I think we are not even at the very beginning at all in terms of thinking about how to use this tool to do optimal policy in a very kind of targeted and detailed way. So from that, I'm not the most expert in what is going on in other fields, but still I hear that in pharmaceutical industry, there are people who, and a lot of actually the cutting edge firm now, they are going to be testing new drugs by having models of specific types of organs, and by having aggregated a lot of data from many patients. Each patient is different from the other, but each patient can be a little bit like a synthetic control. You can reconstruct someone by doing some kind of doppelganger methodology, right? And then trying to see whether specific types of drugs will be useful for a specific patient, given the correlations, the patterns of these patients, or these organs to other organs that you might know. So exploiting this. And by doing that, I think that actually there's a lot of progress being made. Now, there's a lot of issue related to data privacy on those type of things. So obviously, this is a big issue for the European Union, by the way, because the way it's going, a lot of this progress in the medical field and the health industry are made outside of Europe because of data privacy issues. So here, I guess there's a long discussion to be had on that, which I'm not qualified to lead, but this is something very important. And also that crops up in the Draghi report and in other report on European productivity, which we should not discard. But if I try to transplant this in the field of central banking, or essentially policymaking in general, we are not even there, right? I mean, think about, tax policy. It's also very complicated. Financial regulation, right? We don't have this type of models in which we could tweak this policy tool or that policy tool and have some kind of idea of what it generates in the system given all the second round effects, etc. When we do stress testing for financial stability, we are very bad at thinking about second round effects and all the spillovers that we may generate. So I think we just don't have the models yet, and other fields do, right? So I think we are very late. And so I think that's definitely something we have to look at in a lot more detail. Then I just want to finish by saying, on the one hand, I do think that, and so I do think we should really be inspired by, medicine and all that, and try to think about, to use it not only for the process of data analysis, which is the type of stuff I was talking about with model aggregation, but also the policy tool simulations. Okay, so I think that's very important. Then the issue, besides data issues that I already talked about, is, well, when we do that, and you are on a macroprudential authority, okay, and imagine we have this kind of better kind of information coming in, and also possibly policy advice coming from these AI tools that we may be using, then there are two types of reactions from policymakers. So there are policymakers who think, that's great, and then they are going to try to appropriate them to themselves, and they are going to try to use that in their own. Ultimately, there's going to be judgment. You're not going to have a blind policymakers applying whatever. Of course not. There's going to be judgment, but you can go with the. You can get yourself fed from the AI and try to do something with that, and maybe obviously also do some additional kind of probing of the data, testing, talking, etc. Obviously, and then you have the other position which you encounter, which is, this is far too opaque. I don't know what's in there, so I just don't trust it. And if a policymaker doesn't trust it, then it's not gonna sell it. It's not gonna do it, right? Especially for policy measures which are politically very sensitive. I think real estate policy measures, real estate stabilities and stuff like that. Politically super hard. If you just don't trust whatever information is being fed to you, it's not going to go anywhere. So I think that's something to think about as well. And maybe it's also because we are so not advanced in the field of economics and finance with those tools that, it's not in the mind of people that it could be useful. I'm not sure people understand weather models, and yet, you would have a policymaker making decisions based on weather forecast, I suppose. But it's maybe not as easily the case if we think about financial stability.
Okay, thank you so much. Before entering, I was having a quick chat with Ellen, and we were precisely talking about policy makers and mistakes. So I told her that I was going to ask you in a very journalistic way, if you may me, because you invite me. So this is how I ask questions. If AI or all the machine learning and all the techniques that we have nowadays, or we are starting to deploy, if something like AI could prevent a big mistake as Trichet's interest rate hike in 2011. So if this is something that AI could help to the policymakers to understand better the situation and to avoid these kind of errors, or we are very far from there because maybe Trichet couldn't trust in the AI neither. I think it's the kind of person that maybe who doesn't believe in that kind of thing. So I don't know if any of you, okay.
I mean, the policymaker, I think I have to talk here. Okay, I'm just gonna go with the similarity. I'm a tennis fan. I don't know if you know Sinner, but he said, he answered the question, why did you choose tennis over skiing? Because he was very good at both. And he said, well, skiing, one mistake, you're out. Tennis allows you to do repeated mistakes and you can still win the game. Where do you put policy making in this? You do one mistake and you're out. So to me, it's more like skiing. So yes, this also answered the question, we are late. Yes, maybe we are, but the problem is that in the rest of the profession, in the rest of the world, again, going back to this article yesterday about O1, they said, it's not perfect, but we are putting it out there so that we see the reaction of consumers and we can understand what the market needs best. Can we do that as policymakers? I don't think so. Like we would be, killed. If exactly like once in a while, the macroeconomists, comment on the Fed was late, it was a mistake, or the ECB. But I think it's a slightly different setup. And so I'm with Helen in that I think there is a lot that artificial intelligence can help us with in understanding scenarios, especially when you have a lot of data, it can be helpful, but at the moment, I don't think that I would be comfortable, having a computer decide, you tell me what to do. And I think one experience is exactly what we've had with COVID. I think that, the long and variable legs of monetary policy, we've had a long of conversation. Are they still there? Are they shorter? Are they longer? The economy is different because there is extra saving, because of the mortgage market in the US. It's a situation which is different from the past. And so, yes, we need to get to those models that really understand the current situation or the future situation. As Helen was saying, it's not going to be exactly the same as the past, but we need to get computers there. I think we will, but until then, I think that there is a role for economists and policymakers still.
Okay. Yes.
Just to follow up on that. So if we think about the 2008 crisis and then the euro area crisis, I think definitely we could have done a better job in forecasting. And this we can, in some sense, backtest because we can use out-of-sample forecast, even with vintage data. And it's pretty obvious that there was a lot of historical information, both cross-country and in time series, that was pointing towards systemic financial crisis at this point in time. So I think if we had better early warning indicator tools, and if they had been better used or more systematically used by central banks, I think we could definitely have done a better job. For this type of systemic financial crisis, we have a lot of endogenous risk being built. So I think at least we should have upgraded our early warning tools in order to get some types of signals, which will be, it's always a noisy signal, but that's one of the things I wanted to mention, the beauty of having a bit more systematic modeling, right? And also models that get data from a big, broad amounts of data sets, is that it goes against the status quo. There's too much status quo in policy making. There's too much, we hang on to the way we do things. We hang on to the models that we know. We don't look very broadly. And at least if you have something, even if it's going to be a wrong signal, but you are going to double check, it's going to prompt you into action. It's going to tell you, look, there's a red flag. Not exactly sure, right? But there's a red flag, right? Maybe you want to look. And maybe you will see nothing and you will go as usual, business as usual, but maybe you will see, okay, I'd better be a little bit more careful about these leverage and all that. So I think it's really important to go against the status quo. And in terms of, that goes for, also the type of data that we are going to use. And we cannot aggregate all that data ourselves. So we do need some type of AI to do data aggregation for us. If you look at the finance industry, the people who do stock picking, etc., they spend, I'm not saying we should do the same, but these guys, it's a kind of arms race with data. They spend an insane amount of money in terms of getting all the social media data, essentially all the, of course, the satellite data on parking lots, all the individual data on people. I mean, this is, okay, there's a lot of issue about data privacy, but what they do is pretty insane, right? We are, they are there, and I'm not saying it's a good thing what they do, also because they neutralize each other, because if one guy has all this data, the other guys want to have nearly all the data, so it's very inefficient. So maybe actually that's something regulation also we'd want to look at, because the amount of resources and talent which is put into this is pretty crazy. But compared to this type of data in policy making, we are really not using much. I'm not saying all of that is relevant for macro, so that's the thing to be determined, but I think we haven't explored that much about all this stuff.
Just a small anecdotal comment about the usefulness of AI in deciding whether to kind of what to do with interest rates. So I was visiting a Bank of England, and they told me that they ask ChatGPT by introducing the data whether the interest rate should go up or down. Maybe this is kind of what they found, that it's pretty accurate in telling what is going to happen to interest rate. Okay.
Thanks a lot. So I would like to address another elephant in the room. When I started reading this week about AI and policy, monetary policy, I have my reluctancy, and I'm a bit skeptical about this thing, about AI, helping or deciding monetary policy because it's such important and so on. So when I read Lilia's notes, I was like a little bit like, wow, this is good, because this thing about granularity and trying to remove bias and, scrapping social media and trying to feel the sentiment, because at the end of the day, sentiment is like one of the most important stuff when doing policy making in this area. But then, at the same time, I read that AI is writing addressed totally for an Anglo-Saxon male of 50 years old. So I would like to understand how this policy making could be better if like your colleague in the Federal Reserve, I mean, it's men at the end of the day, no? They are the ones, I think Lilia can help us to understand this, no? How to remove this bias when right now the AI, or at least the ChatGPT, which is the widespread thing, is totally addressed for this and is based on this data, which is a little bit what ECB is, because it's full of men. But in any case, how to address this? Thank you.
So basically, I can only speak what I know, right, from my own research. This is this field of synthetic control analysis, which was popularized in macro with the work of Labadier and et al., right? And so this allows you to study how AI can improve the estimates of policies in observational studies, right? I think AI can be useful in this case in three respects. First, you need to select the right control group to deal with confounding effects. So the right control groups was usually determined using the propensity score methods, but AI has a lot of new ways of creating control groups so that in your model external effects that may influence outcome but are not accounted in the model do not deprove your estimation results. And so this would be one thing. So things like clustering or other methods would be useful in this respect for selecting the correct control groups. The second is estimation of average treatment effects. So after we've selected balanced control group and treatment units, we can estimate those effects, which would tell us how policy affect treatment group versus the control group. And this would involve estimating response function using AI, and AI helps you to kind of to increase accuracy or precision, right? So there is a well-known paper by Bourne et al., which uses method to estimate the impact of Brexit on the performance of the UK economy. And so this shows to be very useful. And finally, the dimension in which AI can help is estimating heterogeneous treatment effects, in which case we are not only interested in how treatment group differs from control group on average, but also we would like to see how policy affect differently different subgroups of population. And so I found in my own research that the method that is useful here is called X-learners. And again, it was shown in different applications that this method could be kind of useful to decide which subgroup gains or loses from a given particular policy. So policies considered in the literature, sometimes they are like micro policy, but it doesn't mean that you cannot do the same for macro, right? For example, the example with Brexit, or there are some other examples about German unification or like macroeconomic issues. So when you really want to know how you should design differently policies for different regions, industries, demographic groups. So at the end, the idea is that you want to move beyond one size fits all policies and tailor some economic policy measures that would be specific for these different groups. And so we can ask then, is it kind of possible to design like policy, tax policy or stimulus programs that would bring more benefits for different subpopulation groups?
Ellen and Chiara, I don't know if you want to address something about balance, gender balance, inequality, and AI, or we can jump to another.
I can just add a couple of things. I agree with everything that she mentioned. I think that, you know, it's a moment of change, and to me, change means also opportunities. And so there is really a risk that we can even get, you know, on a worse place as women, because, I mean, unfortunately, AI is going to help certain sectors, and women possibly could stay behind. So I think this is really the time that we all engage to make sure that we seize the opportunity rather than sit back and relax and see what AI has to do for us.
So another risk is the cyber attacks, the security, you know, that the AI may pose in the policy making. I think Ellen has a good background on this, so maybe you can give us some ideas about how to prevent that.
Well, how to prevent, I don't know. I think it's military grade. Huh? It's, yeah, I worked a little bit on cyber risk. So precisely, actually using natural language processing technique, but very simple ones, precisely because this is one of these risks that is very important, that is growing, and in which there is very little data. And so most of the information we have on this is, you know, in some kind of, you have to look for it in some kind of either reports, but we know it's very widely underreported because of reputational issues. or in other data sources, such as the one we exploited, which is analyst calls, essentially. So analysts calling and asking management about cyber risk. So by analyzing this type of sources, you can get some extra information on the characteristics of cyber risk in terms of a time series, in terms of sectors, in terms of a geographical distribution. So this is something that I've done using very simple NLP. So really kind of, you look for some terms, you need to have dictionaries. So the first the first thing is to set up the right dictionaries. With cyber, etc., you have to, to cover a lot because there's a lot of different possibilities. And then you just look for the specific words, and then you are interested in specific topics linked to cyber in terms of cost, in terms of whether it is insured or not, in terms of whether it's linked to specific types of business, of countries. So you can then look for association and then do statistics essentially on that, construct measures and use these measures to associate them. So in our case with asset prices, to have an idea about the order of magnitudes and to see whether this has any forecasting power on actually at least the reported cyber attack, which are just a subset of what really happens, okay? So this is an example where these additional data sources using some type of NLP techniques, I think does have some information, and this can apply for many different types of risk. So this type of analysis has been done in particular by papers by Tarek Hassan on a number of, and co-authors on a number of new risks, so climate risk, not by him actually, by other people, but on climate risk, on pandemic risk. So the stuff that essentially we don't have really time series, and so we don't exactly know what to do with that. We can learn things. And obviously what we see when we measure these things is that it's increasing massively, right? Since 2016, there's really an upward increase in terms of slope. You can really see it. You can see it affects quite a few different sectors. You can see that the financial sector is becoming a little bit more important in it, including insurance companies, interestingly, which seems to be probably affected quite a lot. And when you look at the effect on the asset prices, which is probably, probably mispriced, etc., but you do find big effects when you do back of the envelope and you scale it up. And most of the papers trying to put some numbers on cyber risk come up with very big numbers. I mean, in the 100 billions a year, right? So, and this is probably, not covering everything. So that's one aspect that if we are going to use more AI-dependent systems, we're also more vulnerable potentially to hacking, because artificial intelligence can also be used to do cyber attacks. And I think the sophisticated hackers are probably using it extensively already. So that's definitely one thing. So if we do policies, and we want, and also on data, also the secrecy of the data, etc., we are more fragile, more vulnerable to this. That's really an important dimension, let alone payment systems and all that. It's literally, I think, defense level. But there's another thing coming, which I think we haven't seen enough yet, but we're going to see a lot more, all the deep fake stuff. Okay, and so the impersonation, there's going to be insider trading. I can see
so like a Christine Lagarde fake saying,
yes, saying
whatever it takes, but in...
Christine Lagarde saying, okay, I am going to increase the, the rate by 200 basis points today. And then you're going to have some trading based on that, I mean, or something like that. We already had the Twitter account of the SEC chair, which was hacked, and it was announced an ETF, Bitcoin ETF, right? Which was, and so I'm sure some people traded on that. So I think that's going to be a lot more prevalent. So what do we do? I don't know, but I think we really have to gear up for these type of things. And it's very important. It's important for the democracy. It's important for the financial world as well. Yeah.
So unless you have any comment on this, we can open the floor.
Just a couple of things, given that we are talking about other areas, where AI can be helpful. Cyber is definitely one of those. At the Bank of Italy, we are actually using AI extensively in many different fields. For example, we have what is called a financial banking arbitrator. sort of a small claim. People that when something happens with banks, they come first to the Bank of Italy. We use AI just to collect all the data and make sure that we treat, similar cases the same. Then we use it to do text mining for complaints that we receive. We use it for the fit and proper assessment, to sort of like navigate the web and find all the information about the people that, are in boards, because we need to give the fit and proper assessment. It's really just like immense the way that we use it, even, to do, I was talking about supervision and regulation. We have several tools that we are using. We are also using in the field of cyber. And related to that, there is also the anti-money laundering, and all of that, where it's really important to be using these new tools. So yes, maybe we are late on the macroeconomic part, according to Ellen, but we are really doing a lot on other fronts. And let me just say, another elephant in the room is climate, because AI is clearly very energy intensive, and so people are pointing their finger toward AI. But I would also try to look at the other side. I know that this is a problem that we need to solve, but AI can also help a lot in dealing with climate-related issues. When it is related to reporting, exactly because some of these reports is just a matter of finding the data and reporting it, but also in trying to figure out what are the risks. You were talking about systemic risks, financial risks, but there are also climate risks, and try to identify areas. It can be used like in many different areas, and I think that around the world, the different central banks or policy institutions are really trying to use all this data and new techniques.
Thank you so much. So we are opening the floor. Anyone would like to have a question? Okay, please go ahead.
No, I agree with that point. And actually, this is an issue even outside of central banking that, we are trying to solve in Europe with DORA, this new regulation, exactly because, when you go and basically, get services from third-party providers, you can bring in additional risk. And yes, I agree with your assessment. I don't think that we are there yet as central banks.
Can I just say?
Yeah, go ahead.
Yeah, but I think it goes back to the point, what do you do with it? If you do it as an advisor, among other things, and actually the AI advisor draws on many, many different models, right? Then you don't have this problem, because in the end, it relies on the judgment of the people. It's just that the people, they have the trust or not the input. And also the advisor may actually be a bit broader than, model with Phillips curves for monetary policy, for example, or may throw in a few more things which would have to do, a little bit more closely with energy prices and stuff like that. So maybe, in the end, we would have not as a predictable type of thinking in terms of monetary policy, for example. But also the multidimensionality of a lot of the things that central banks do, it makes it, besides monetary policy, makes it, we are not going to predict it, even if you But you should not be hostage of a certain provider for sure, yeah.
I have another, I saw Tabitha first and then Evie, please. Thank you.
Thank you very much for this great discussion on artificial intelligence. And I'm thinking of bringing in another dimension on use of artificial intelligence in teaching, and especially coming from the university environment where we have students, doing exams, writing research papers, doctorates, and so on and so forth. And at the end of the day, what we have seen is it's like students have stopped thinking, that what we are actually examining are artificially intelligence generated theses. And at the end of the day, if these are the documents that are going to be used in policy making, we would actually ask what sort of policy is coming from these documents. And so I think there is a lack of preparedness, especially from especially the persons who are teaching in the universities, especially talking from a developing country point of view, that the level of preparedness is not at par with that of developed countries. Number two, of course, now let's bring in the issue of inequality, because we are already behind in terms of digitalization, and here comes artificial intelligence. And our students have actually stopped thinking, and you take them into an exam, and within 1 minute, they have generated an answer to you. And when you put them down and ask them, okay, what does this variable say? How do you generate? What does it tell you? They have no idea. So how do we bridge that gap of stopping thinking and producing documents because the computer is helping you? Because they say that it is a smart way of doing things. Yes, it's smart, but are we also stopping innovation or innovativeness, and what sort of human beings are we bringing up? It's good. It's good because we must move with technology. But then how do we also merge the issue of innovation, the issue of doing smart things, but not well informed by whatever those variables are talking about? Thank you.
It's a super good question. I don't know if Lilia would like to address. Yeah, thank you.
Just can tell how I'm doing this. So first, when I know that this thing happens, I just have this option in like Blackboard or all this software that you can use for teaching. You don't allow them to go anywhere on web, just lock screen, right? I guess this is one small, and then there is software that allows you to check whether the thesis is written by or is helped with ChatGPT or not, right? So you can really recognize where the text was written by a person or not. So I had discovered this year, I always do Macro 1 for first year students, and they write a project where they solve real business cycle model and so on, then they write a paper, right? And then I found that like each fifth paper had the same phrases, right? And it's like, did you say this model delves into? And they say, no, it was mine, right? But you can see the things. And how to, and I agree with you that it's like a tendency, right? You can fight against it. So hopefully when students do this, they become smarter, right? Because they see the answers and they learn something from that. And so we should be conformed with this kind of positive side, I think. I don't know.
I see a lot of hands up, which is great. We started 7 minutes late, so I will ask the organization to take those 7 minutes. If it's super quick, Ellen, you want to reply something quick?
I just wanted to say there's two things: there's the learning and then the student evaluation. In the learning, because it can target the learning and customize it, actually AI can do wonders, right, to help students learn. I mean, the evaluation, I think, yeah, we can.
So Evie was the next hand up. Thank you.
Listening about artificial intelligence, I've heard you saying very many things, but there is one thing that you didn't mention. So like I was reading this summer a novel by a Turkish writer, Livaneli, and he was writing like that What distinguishes the human being from animals is that the human being can love. So sentiment is something very important that, sorry, we can discuss that later. But what I mean is, like, we think about artificial intelligence, we have to think also about sentiment. We have been, like all of us in many classrooms, trying to think about whether rational expectations is the right assumption and like thinking about deviations from rational expectations. And now we are coming to artificial intelligence. Artificial intelligence is going to go for the rational. What they cannot predict is sentiment, probably. So I think that we need to incorporate, of course, artificial intelligence. We should look at that, but we should also think that there is something that we cannot model, we cannot predict, which is like sentiment, and we have to keep it in mind. And I think the point that Tabitha makes is a very important one. And the reason is that we are women and we are forward-looking. Men are not as forward-looking as us. And I think that we have to take into account the fact that artificial intelligence is a danger to the intelligence of the next generation to come. We were raised with hand and pencil, and we were doing everything like deriving equations by hand. I don't see any kid doing that, and they will not do it probably. So maybe we should push for education that kids have to know how to deal with artificial intelligence in the future, because we didn't have to learn that. We adjusted. The next generation doesn't have to adjust. It has it for free. It's like knowledge for free. So I agree that you made a great point.
Ladies who would like to reply or to comment? It's more a comment than a reply.
I can start, but I started my talk today talking about the reasons why, artificial intelligence as of now cannot really include that. And I was giving you the example of, my paper, as well as, this computer program to try and embed humans. And exactly that part, the sentiment part that, at least as of now is still missing. We'll get there, probably, I don't know, maybe. But yes, I agree completely with that.
Yeah, I mean, we don't know where we're going to go. Already, artificial intelligence can manipulate people. So, maybe it's hard to forecast where we will end up. But I mean, on sentiment, AI or machine learning is useful to use sentiment in text to do forecast, right? So, sentiments of humans.
That's another screen. Yeah, Sebnem, please.
A great panel. I want to go back to this issue of when Helen said we need to push back on status quo. And then when Chiara said, she doesn't want to be told by a computer how to decide on monetary policy. I mean, specifically on policy making, but monetary policy. And when you also ask, can we prevented the 2008 mistake? And we could have if we did better forecasting, right? Okay, so COVID is the next example, right? And I want to really understand why this disconnect is there. Exactly, kind of why the policymaker, why the central banker, or when that shock happens, the deciding bodies are reluctant to use the information to do better forecasting. You might still do your decision based on judgment and your model, but why don't you incorporate that information? So we have written these papers on supply chain disruptions, inflation, and output drop. And the first time I presented was January 2021 in WHO. Then I presented IMF, central banks the next month. And we got huge pushback. This is like, February, March 2021. And we were saying like, look, without enough government support, there's going to be like larger drops in output, more increase in unemployment, and there's going to be inflation. We actually predicted supply chain disruption can last much longer than what has been predicted at the time because trade improved, right? This is exactly like what Helen is saying. Everybody look at the trade. Trade improved, we are back to normal by March 2020. Everybody's like, okay, we are recovering, everything good. And then we went from 2% to 9% inflation. So we could have, we did this without AI, just going back what Lilia said, just computational general equilibrium. You take a computational general equilibrium and you put networks in a macro model. And that gives you that, right? I mean, you don't even need AI here. I mean, if you put AI on that, you can do much more because you can process, because data wasn't there, right? We literally did it with a model with the existing supply chain configuration and the COVID deaths, right? That's the only data available at that point. So with AI, you can pull more data, you can even do better. So my question is, but again, even we do this and tell the policymaker, look, this is going to last much longer than you thought, and the effects can be this. So do you think, as you answered, Helen, no, the policymaker is still going to insist in the central bank model, which is going to be based on the Phillips curve and very aggregate? They wouldn't be able to tell you the fact that the used cars and all other things that is going to have a huge impact. There is a sectoral asymmetry. So why do you think that is? Why, and or are we now going to change because we saw COVID? But COVID was very new. The next thing can be cyber, or next thing can be also unknown again. Are we going to go through this kind of, resistance that, yes, I hear what you are saying, but here's my Phillips curve?
So I just want to clarify. I'm sorry if it came across as a resistance. I think that if anything, over the past few years, central bankers around the world really opened up to understand and look at new data, new models, and everything. When I said we are not there yet, it's more that, yes, we can take in all the models and think about them, but we can't just have one model or AI tell us you do that. But I'm with you, that during COVID, for example, institutions around the world, economists, I was at the Fed at the moment, we were looking at any sort of data from, images, credit card data, ships in the, like all this data, exactly because we needed a real time assessment of what was happening and we didn't have the information. And so I think COVID was a push to move toward all of this. And I think that what we're doing, we are academics, what we do is you come to me with a paper, I have to figure out, why your paper is not the right one. I mean, this is what economists do. I mean, not in a bad way, but before I trust your model, so that's always the reaction. But sorry, every referee does that.
So, do you have anything else to add? If not, we are done. I'm sorry, but we are out of time. So it has been a great panel. Thank you so much, Chiara, Lilia, and Ellen. So interesting. I've learned a lot, so I appreciate so much that you share with me this time with a normal person with no paper. But thank you a lot, and thanks to the Bank of Spain.
Okay, if I may just get your attention for 1 second. So, thank you. Just a oh, thank you. Just a quick point on organizational point. We would love to take a group photo with everyone before people start, leaving and going for lunch. So we will do that on the stairs outside the room. So if I could just ask you to please make your way there, and then is lunch.
Okay, so I'll give you an additional 3 minutes because we start late. Okay, ladies, we had a wonderful physical food and intellectual food over lunch, and so now we are going to get some more. And I'm delighted that Shebnem is with us, and she will present now.
Great. The mic is working. Okay, it's working now. All right, great. Okay, thank you so much for inviting me to present at this amazing conference. This is actually my first time here. I go to the one in the US, and I'm very happy to come to the one in Europe. Yeah, no, definitely under the name. Let me tell you, the VR in name is a genius name. Okay, anyway, I'll talk more about that at dinner. Yeah, I heard that actually, amazing. All right, okay. Let me also start by saying this is joint work with Pierre Deleo and Geeta Gopinath. So given Geeta's position, the usual disclaimer applies. These are our views, don't represent views of IMF, its executive board and its management. So what we want to do in the paper is to study monetary policy in emerging economies. And we are going to start from a well-known observation that emerging economies are largely exposed to fluctuations in external financing conditions. So this exposure is going to pose trade-offs and challenges to emerging market central bankers. Trade-off, you can think them as, should an emerging market central banker increase interest rates or decrease interest rates during recessions, if these recessions also happens to coincide with capital outflows and exchange rate depreciation? This is a trade-off. And challenges, of course, broadly, you can think in the framework dilemma, trilemma, going back to Helen's influential 2013 Jackson Hole paper. Now, what we would like to do in the paper is just simply start from the question of what do they do? So we are not going to think about optimal policy, we are not going to think about what they should be doing, but simply what is in the data that characterize emerging market central banks, what do they do? And let me also tell you that the consensus in the literature right now is monetary policy in emerging markets is pro-cyclical. Then we are, after visiting that question, we are going to ask another question, if the exposure to external financing pose challenges to central banks and how that really works. Okay, let me give you just a snapshot of the results. The first result in the paper is something that goes against the consensus, that monetary policy is counter-cyclical. What does it mean? That means central banks in emerging markets lower policy rates during recessions and increase them during periods when the economy is overheating, there is a boom. So we are going to show you this result in 4 building blocks. The first one is going to be just estimating standard central bank reaction functions and show you that emerging market central banks adhere to Taylor type rules exactly as in their advanced economy counterparts. That's the first building block. Then we'll show you dynamic correlations of policy rates with GDP using local projections. They are positively correlated. Then we show you what happens to the emerging market monetary policy rates during the episodes of global distress. You can think events like COVID or global financial crisis. And then fourth, we are going to show you the response of emerging market central banks' policy rates to a well-identified US monetary policy shock, a US monetary policy tighten. So that's the first set of results that's going to tell you monetary policy is counter-cyclical. Then we are going to look at the market rates. If the monetary policy is counter-cyclical, what is going on with the market rates? We are going to focus on the short-term market rates, and we'll show you that these short-term market rates, 3 months to be exact, is going to deviate from the policy rates in many emerging economies. Not in all of them, but in many, enough to have the average result as short-term market rates going to the other direction, giving us what is in the title of the paper, what we call short rate disconnect. So there is going to be this wedge between the market rate and the policy rate, and that wedge is going to be counter-cyclical. So, and in advanced economies, market rates are going to be closely moving with the policy rate, so you are not going to have the same wedge. Then we say, okay, so how can we describe the time series variation and cross-country variation in this wedge? And we show you that the short-term disconnect is going to be related to economies' external exposure and financial conditions. So we'll just full circle back to where we started. and we will be able to explain both the cross-country variation and the time series variation in this wedge, which is the market rate minus the policy rate. Okay, so this is basically what we do in the paper. So let me start with the first part, which is the monetary policy in emerging economies. How do these policy rates behave? What do they do? As I said, I'm going to start showing the Taylor rules. So very standard. We are not doing anything new here, or less estimation of Taylor type rule. Then local projections, dynamic projections for policy rates and GDP growth. For the global distress, what is known as a risk-off shock, we are going to look at global financial crisis and COVID. And then finally, we are going to look at the response to US monetary policy shock, where we identify these using the high-frequency surprises. Here we are going to use the Gertler-Karadi shocks, and we'll also look at taper tantrum. Standard data, very important detail here is we are not going to be looking all emerging markets. We are working with a subsample. Why? Because we are going to not use the fixed exchange rate countries. If you use fixed exchange rate countries, by definition, there is no independent monetary policy. They are just going to do whatever the policy of the country they are fixing to. So we are just going to look at the non-fixed regimes. This is, of course, going to be a time-varying classification going back to Letzke, Reinhard, Rogoff classification. Now their updated version is what we are going to use. So we are going to be working with an unbalanced panel. Argentina, not being in the sample all the time. Okay. The first result, this is the central bank reaction function. It's a panel regression of a policy rate on an autoregressive term. You can see here, the lag, and then the inflation, and then the output gap. Very standard. The first column is going to give you the estimates for emerging economies. The next is going to be the advanced economies, and you see the estimates are very, very similar. So you basically map these to Taylor coefficients, and you are going to get these Taylor coefficients that you see on the slides on the phi pi and phi y. So on the inflation coefficient and the output gap coefficient, they are pretty similar. We do a lot of robustness on this. So we are going to look at, country-specific estimates, specification with GDP growth instead of output gap, specification with exchange rates. That's going to be important because even they don't tell you, they might be implicitly targeting exchange rates. So we put it there. And also we are going to exclude high inflation episodes, crisis, inflation over 40%, all these things that you would think is going to be is going to create a problem to estimate the Taylor rule for emerging markets as opposed to advanced economies. And overall, this result states that emerging market monetary policy is countercyclical, measured with a Taylor rule estimation. Then we do this local projection. So the regression is on the top. Again, it's a panel regression. We are also going to run this country by country. So the policy rates regress on the GDP growth with, of course, lags controlled. So you see that it is the rate is procyclical, which means policy is countercyclical, right? So the policy rate goes up in the good times, both in emerging economies and the advanced economies. That means they are going to go down in bad times. You also see the effect is lower. This is the same y-axis in emerging economies and advanced economies. You might have several explanations for that. It can be problems of supply shocks, as argued by Frankel, or you can think of a fear of floating type of behavior. All those are going to be fine, right? So we don't get into that, but still in terms of the directionality, it still goes in the right direction, meaning this type of estimation also tells you that monetary policy is countercyclical in emerging markets. Then we look at monetary policy rates around episodes of global distress. So the top is global financial crisis. You can see the percentage point change starting August 2008. The left is emerging economies, the right is advanced economies. You can see that in both sets of countries, median and the mean is, cut the policy rate, right? Of course, there are outliers. In emerging markets, you can see Russia and Hungary. In advanced economies, that blue line that goes the other way is Iceland. So, but overall, the average behavior is going to be one that is easing the policy around the episode of a global distress. Another one is COVID. Of course, COVID has many, many things in it. It's a multidimensional shock. But if you just look at the first instance, February, March 2020, when it started, which was more of a uncertainty shock, risk off because we didn't know enough, you can again see that policy rates ease across the board, both in emerging economies and advanced economies. Finally, we are going to look at as a response to US monetary policy tightening. So what is the monetary policy tightening here? So it is the impulse is 1 percentage point exogenous increase in the Fed's fund rate, instrumented with Gertler-Crady. So we are following Sylvia's and Helen's work on this. There are other papers, you know, the Dola de Gaspari. I have another paper with Phyllis Insel on this. But basically, everything you see here is shown in other papers. So there is nothing new here except the policy rate results. So what we are saying is all these bad outcomes we know from the work of others, like GDP growth goes down, inflation goes up and down, capital flows out when US tightens. It's an exogenous tightening of the US policy. All these things happens in spite of the fact that policy rate is eased. Okay, so that is the new thing, the new result in our paper. And all the other results are consistent with, as I told you, many other papers, including Sylvia's and Helen's work. Okay, so this is what happens with the policy rates, with 4 building blocks, 4 different exercises. I show you that monetary policy stance is countercyclical in emerging economies, not that different from the advanced economies in this sample of non-fixed exchange rates. Okay. Now the short-term market rates. What is going on with the short-term market rates? Let's start with the definition. The definition of a policy rate is the target interest rate set by central banks in their efforts to influence short-term interest rate as part of their monetary policy strategy. So you expect, if this is an effective monetary policy, short-term interest rate is going to behave exactly as the target interest rate, the policy interest rate. So the relevant short-term market rate here is, of course, the treasury rate. The shortest maturity, so we are going to use 3-month treasury rates, the rate on the government bonds, 3-month bonds, both in advanced economies and emerging markets, widely available, and something used synonymously with a policy rate in United States and also all other advanced economies. Okay, so remember the figure I showed you on the dynamic correlation of the policy rate with GDP, the local projection. That figure I showed you, the blue line, you see that again, right? Remember, when the economy is growing, the policy rate is increasing in emerging markets and in advanced economies. Now, the market rate is the red line. You see that it's exactly the same in advanced economies. So there is no difference between the blue and the red in advanced economies, right? Policy rate and the market rate, 3-month treasury rate follows exactly the same pattern. This is a 2-year time dimension here, 8 quarters. In emerging markets, you can see that they go obviously in different directions, right? So the market rates and the policy rate, they have very different cyclicality in emerging markets, whereas in advanced economies, this is not the case. Now, this result itself is very important because depending on what you use, if you use a policy rate versus the market rates, you are going to end up with different conclusions for the monetary policy, cyclical stance of the monetary policy in emerging markets. This is our short-term disconnect wedge, right? So it's literally market interest rate minus the policy rate. And you can see this is counter-cyclical, right? There is no such wedge and counter-cyclicality in advanced economies on the right. But on the left, in emerging economies, you can see that when economy is doing well, this wedge is negative, goes down. Why? Because, of course, policy rate is increases, market rate is not. So you have this counter-cyclicality in this short-term wedge between market rate and the policy rate. Now, you might ask, well, okay, but what is really, I mean, we have a good framework we understand in advanced economies. We know what the policy rate is in US, ECB, and how do I, kind of pin this down in emerging economies? Because I might see a publicly announced policy rate, but then maybe that is really not what they use. So we did a lot of work on that too. We look at the countries, they define themselves as interest rate policy framework, inflation targeting, and others. And you see that no matter what we do, we have the wedge, countercyclical short-term wedge. In fact, if you look at the inflation targeters in blue, the wedge becomes even more countercyclical, right? Because an inflation targeter, of course, has to, to be a good inflation target, to be credible, you have to run counter-cyclical policy, and the wedge becomes even more negative because the market rate is going to go to the other direction. Okay. Finally, the US monetary policy tightening again. Here we use the Gertler-Crady shock to instrument 1 percentage point increase in the Fed funds rate. So again, you see that the first figure here is what I showed you, policy rate going down. GDP growth goes down with US monetary policy tightening, capital flows out. This is all consistent with other work, and where market rates are increasing after US monetary policy tightening. Actually, this is the market rate increasing result is what I showed in my Jackson Hole paper in 2019. And Helen was my discussant, and she asked, what about policy rates? So we decided we should work on that. So yeah, Helen is, the godmother of this paper, basically. No, it is definitely not. That's you ask, and we started working on it. Yeah. So that, but this is again, this is just, I'm showing you the same thing over and over, but so that, because I don't want you to think this is just as a response to US monetary policy, or this is just like a domestic thing. So no matter how you do, you are going to have this behavior, okay? All right. And this is the final thing I'm going to show you here. You might have questions exactly what I just said. Well, okay, are we really defining the exogenous US monetary policy shock, or is GDP growth a good variable to get at the cyclicality and all that? So I'm just going to give you one, to me, a very natural experiment, right? This is by consensus accepted as a purely exogenous outside shock. It's a US monetary policy shock, but it's a really exogenous external shock to the emerging markets, taper tantrum, known as taper tantrum. It was the speech of Ben Bernanke in May 2013. US monetary policy didn't adjust. There was no action on the US monetary policy, but it was a signaling in that speech that they might move earlier, and it created all these capital outflows, exchange rate depreciations, which is known as taper tantrum in emerging markets. And here you can see how policy rates in blue and the market rates in red went into opposite direction during that purely exogenous US tightening or tightening of global financial conditions. And the wedge, you can see all positive because this is the tightening of the financial conditions, and with one outlier country. Same with the policy rate. There were countries increasing the policy rate. Actually, that's Indonesia and Brazil. They were on the record to say that they're increasing the policy rate because they don't want their exchange rate to depreciate. They come on the record to say that, but overall, they were the outliers, and the typical behavior and the average behavior is reacting as decreasing the policy rate, whereas market rates, of course, went up. Okay. The final piece in the paper is going to be, okay, now, how do we connect this short-term disconnect wedge that I showed you counter-cyclical using 4 different exercises? How do we connect this to external financing conditions? We are going to have 2 measures of external financing conditions. One quantitative measure, one price measure. So the first one is domestic banks' external liability share. Why do we use that? Because simply by talking emerging market central bankers. If you talk to emerging market central bankers, each one of them is going to tell you that domestic banks are the market makers. Domestic banks are the ones pricing the government bonds, and they have a large holding of government holding. So we are going to start from that, and we also know from the literature, domestic banks are relevant gateway to external financing in emerging markets. They bring the dollars and they intermediate. So we are going to look at their external liability share directly in their entire liability. And then our price measure is just going to be MB spread. Now, we of course want the spread on the banks. So the closest counterpart to this will be SEMB, but SEMB is mixing firms and the banks, and also it is very, very limited. So we are going to go with MB. What is MB? It is a difference between the return on the emerging markets long-term dollar government bonds minus the US Treasury bills. Okay, but the good thing with this is it is widely available across our countries. And we have a lot of data in the paper. If there are questions afterwards on the bond holdings of domestic banks and so forth that I can show. Okay. Now, we group the countries below and above exposure, median exposure. So on the left, you see that countries that are below median level of external exposure in blue, the exposure measure here is that country's domestic intermediary sector's external liability. And the red is if they are above this level exposure. On the right, we do the same thing above, below median. Now we use as the MB spread as the external exposure measure. And you see actually what I have showed you so far, the disconnect wedge, the counter-cyclical short-term wedge, the black, it is more driven by the countries that really have large external exposure and subject to volatile external conditions. Okay, that both type of measures is going to give you that is red. In fact, the blue, the countries with lower external exposures and less volatile behave more like advanced countries, as you can see. Okay, we also run a regression for this. So we just regress our short-term wage, the market rate minus the policy rate on the external premium, the MB spread, and external exposure, domestic banks, external liability, and they both come strongly significant, even when we control the month fixed effects, which is of course important because we would like to say this is an important channel, even you account the variation coming from global financial cycle, which is of course very much working in the same direction, as you can see in the last column here. We have both country and month fixed effects, and both measures are very strong determinants of the time variation in the short-term wage. Okay, final 4 minutes maybe, very good summary of the, very short summary of the model we have. So once we have these results where, okay, we see the monetary policy is counter-cyclical, then we look at the short-term market rates, they definitely behave exactly the opposite, and we can look at this wage and then we can link it to these external financing conditions. What is the model we can write down that can, justify these findings? So we want to write down the simplest model possible. It's going to be a partial equilibrium model of the domestic banking sector in emerging economies. Home banks are going to operate in the home currency bond market. So think this is Mexico, this is the peso bond market, they are risk neutral. On the asset side, they are going to hold these peso bonds at the market, they are pricing them at the market rate RM. On the liability side, they are going to fund themselves, of course, with the deposits, with the Mexican household deposits, but also, and they are going to pay policy rate to those deposits, but they're also going to fund themselves with the dollar funding in the international capital markets, and they are going to, so they have D star, but they are going to pay a funding rate of R star hat on it. So there is this safe rate on the US Treasury, R star, so the Mexican banks are going to be paying R star hat, okay? And that's difference we take at exogenous. Bianchi and Lorenzoni has worked on endogenizing that and actually link it to risk sentiment fluctuations, as in Helen's work. So, but we take that as given, and our data proxy for that is going to be the MB spread, okay? Then hedging, because these are emerging market banks, emerging markets have regulation that rolled over after each one went through crisis, that they have to hedge their foreign currency liability position. So we are going to assume it is completely hedged, right? So when the Mexican bank borrows in dollars and then lends in pesos, so they are going to buy the derivative contract that they are going to hedge that position at forward exchange rate at F. And this is a partial equilibrium model, so the Mexican banks are going to take the policy rate, dollar funding rate, R star hat, and spot and the forward exchange rate as all given. What you get out of this simple model is like very intuitive equations. You see the bank balance sheet on the top, bank profits, the second line, where this omega C term in red is going to be simply the share of the domestic bank's dollar liabilities to outside, expressed in peso terms. Then you have the equilibrium condition from, these are zero profit banks, and that's how you get these market rate RM in red. And you can see that that rate is a combination of the policy rate and also the covered dollar funding rate, right? The covered through the F over S, and then depending on the share they borrow, that is the omega. And then we assume CIP holds in these deposit rates. Now, this is going to give us, with a first degree approximation, the short-term wage, the equation here, the market rate minus the policy rate as a function of the average, the dollar liability to the rest of the world multiplied by the time varying the dollar funding rate plus the average dollar funding rate times the time varying borrowing of the domestic banks dollar borrowing. Okay, so it is increasing with external premium and also external exposure, and that is the equation exactly mapped to the regression. Remember when I regress that wedge on the domestic bank's external liability shares and also the MB spread, right? That's the equation that gives you that regression. Okay, let me just conclude. So exposure to global financial conditions poses trade-off and challenges to emerging market central banks. Well, this is to all central banks, but there is this additional dimension in the case of emerging market central banks where they have to deal with a lot of issues from exchange rate depreciation to capital outflows, but still their monetary policy stance is predominantly counter-cyclical. Challenges to monetary policy manifest itself in this time-varying short-term wage between the policy rate and the market rate,
And this is relevant for the countries with large and volatile external exposure. Remember that red line versus the blue line when I separate the countries by their exposure below and above medium. So that's basically what we have. Of course, you can think an interesting general economic extension where these foreign funding conditions in terms of how much domestic banks bring in terms of dollar funding and what is the spread they pay on that, that can of course be endogenous to counter fundamentals, including things like monetary policy credit. Thank you very much.
Excellent. Thank you so much. Great timing as well. And now we have a discussant, Luciana. Yeah.
Thank you. So thank you to the organizers for having me here. It's my favorite conference. I wonder why. And you know, it's a pleasure to discuss this paper by Shebnem, Pierre, and Gita. And as a reminder, the usual disclaimer applies. So let me start first with a brief summary of what I see as the main contributions of this paper. So as Shebnem described, this paper documents that central banks in emerging economies follow a counter-cyclical monetary policy. This goes in the same way as in advanced economies. This is a new result because earlier literature, as Shebnem explained, typically pointed at procyclicality. Now, the issue is that short-term market rates in emerging markets behave in a procyclical way. And this is essentially different from what happens in advanced economies. And they call this difference, this lack of sync between the two rates as the short rate disconnect. The paper goes a long way towards explaining this disconnect and then builds an intuitive model where basically the disconnect is related to the external premium that is proxied by the MB spread and backed external exposure. So I think this paper has very important implications for analyzing the effectiveness of monetary policy in emerging economies, and as Shebnem hinted, also for assessing the monetary policy stance, like which rate should I use? So in that regard, I think that this paper is going to have us thinking for a very long time about these matters. Now, to start on a positive note, I really like this paper, and I think it makes a very, very important point. And my comments are going to mainly focus about understanding the role of the disconnect in the presence of other shocks. My goal here would try to essentially bring the empirics closer to the storyline of the paper and the model. And I'm going to show you some results that I basically obtained for that. I'm going to make some suggestions on potential sources of heterogeneity that the authors could analyze. And then I'm going to make some remarks about the possibilities for some extensions and other potential mechanisms that could be playing a role as well. So my discussion is going to basically be very much anchored on these two main results. The first one is the chart with the impulse responses from the local projections. These are in response to a US monetary policy tightening. And the other is the regression analysis on explaining the short-term wedge. So my first comment has to do with how does the disconnect vary with other shocks. Now, why this matters? Well, because the cyclicality between the policy rates and GDP is going to be obviously shock dependent. And the unconditional correlations basically are going to depend on the incidence of the shocks that are hitting the economy. And in this way, the conditional correlations can look very different from the unconditional ones. And I see that there is a lot of value in analyzing the effects of other shocks, because in a way it can provide further hints of where the transmission mechanism is actually coming from. So in that regard, what I have in mind is the analysis of global shocks related to the global financial cycle. As it was analyzed in earlier literature, the global financial cycle is typically linked to shifts in US monetary policy and changes in global risk appetite. So the paper has a very nice descriptive analysis to episodes of financial distress But I see a case for, a benefit from analyzing this shock as well as the US monetary policy shock. And the results that I'm going to show you actually point in the right direction. So I think that they actually strengthen the storyline of the paper of the mechanism going through banks. And then because it's me discussing this paper, I cannot help but thinking of other global shocks that matter a lot for emerging economies that are commodity-specific shocks, idiosyncratic to commodity markets, so think not related to the state of the global economy or the business cycle. And why is this can be relevant? Well, because in the way that I think about these shocks, it's very clear that the ones in bullet one are very much going to be financial sector attached, big deal. While the other shocks may have different channels of transmission. And I'm going to show you with some results that actually what I get is quite interesting. Then, of course, there could be domestic shocks, domestic monetary policy, but I'm going to focus on bullets 1 and bullets 2. So what I did is to dig some data. I didn't have the market rate, but I'm going to show you basically the effects of global shocks. So I'm going to use essentially the BAA spread as an indicator of the global financial cycle. And I'm going to use a US monetary policy proxy and risk shocks proxies. So the measure of Biffer and Podolsky is based on the variation in the price of gold around uncertainty events. And then the other is basically based on US financial uncertainty. And then I'm going to use export price booms resulting from idiosyncratic commodity shocks from a recent paper with Ivan that basically looks at events that have major effects in commodity prices that are idiosyncratic to these markets. Think about weather events, natural disasters, weather shocks, nothing to do with the state of the global economy. And what do I get? So I'm team expansion. So I'm going to use the effect of an accommodative US monetary policy. I get the same result as you do. I didn't have the market rates, but your paper hints a lot that the MB spread and the market rates would be very correlated. So first things first, the results are very robust because I have about 54 countries and this is annual data. So we start in a high note. And then this is a reduction in the global risk appetite. I guess there is no surprise here. You get basically that the policy rates behaves counter-cyclically and the MB spread instead goes down. Now, what is interesting here is that the positive commodity shock, think of this as a positive terms of trade shock, looks actually quite different. So here the policy rate actually goes down. And the response of the MB spread compared to the previous shocks is quite muted. And here we have an expansion and the exchange rate is appreciating. So the exchange rate was appreciated also in the previous shocks as the result of the dollar weakening. So this is more the effects of a terms of trade shock. And you see that actually here, the policy rate behaves in a pro-cyclical way. So which hints you that in the unconditional correlation, maybe this shock is not playing that much of a role. But when I saw these results, actually, I became more convinced of the storyline of the model going through banks. So this is what it helped me to kind of come to terms with in the paper. Okay, so then I have a suggestion for exploring the channels of transmission. So the paper presents average results on the impact of the MB spread and external exposure. And it does that in figures 7 and the table 2 that I showed you before. So the issue here is that this is very much consistent with the model. And in the model, the external exposure, for instance, is treated as exogenous. I'm not entirely sure how that plays in practice, but as I'm hinting you, I see a lot of value from analyzing shock-specific channels of transmission. And with the local projections, actually, you can analyze this very nicely because you can ask the question essentially, how are the effects of the intervention, that's the shock, mediated by movements in the MB spread or the external exposure? And then the paper by Cloyne, Jorda, and Taylor can, propose a method where you can basically use the local projections, you augment it, to include a term that will be basically the interaction between the mediating variable and the intervention. And you can compute this elasticity in a model consistent way. And then you can generate the hypothetical scenarios. So you could say, okay, if the MB spread deviates 1 standard deviation with respect to the average, what's going to happen to the wedge? And it can give you nice results. So I made some calculations for the policy rate, which is not really your topic, and it's quite promising what I obtained. Then I was wondering whether you may have considered some sources of heterogeneity. So in the literature that is very nicely described in the paper, sometimes they speak about the countries that graduated, others are back to school, others are still in school. And while the paper does a very nice cross-country comparison, perhaps splitting by time periods allows us to learn something else. In this literature, as well, the role of institutional quality or level of financial development has also been analyzed as the determinant of the pro or counter cyclicality of policies. And finally, it could be interesting as an extension, obviously, to see if there are asymmetric effects depending on whether you have an expansionary shock or a contractionary shock. Sometimes countries, when they face a contraction, are maybe close to a crisis. They may do things a bit differently. Now, in terms of the model as a summary, I think that the weight of the model in the paper is not at the center stage, but still it's a very neat model of banks in emerging economies, where banks rely on deposits and foreign borrowing, and I see this as the main equation that the paper, the model yields, that is basically the short-term wedge. Now, in the model, nothing is telling me what causes what, so I wonder if you would write the equation differently. There is nothing in the model that essentially tells you the direction of the causality. Clearly, there's a lot of work that the MB is largely driven by global factors. I'm not entirely sure about the wedge. I'll come into that in the next slide. So my suggestion is, that it could be interesting to expand a bit the model to analyze the effects of different shocks, like what happens to the wedge. And for doing this, I think it would make total sense to treat the omega as endogenous. But well, so that would be my suggestions in terms of extension. Now, when I was, thinking about the mechanisms and so on, when I saw how different the commodity shock was, I kind of was myself convincing of the mechanism that is explained on the paper. But there could be other mechanisms playing a role. So for instance, the role of sovereign risk is one of them. In emerging economies, it could be, they have issues with debt sustainability, and this can be important for influencing the interest rates through risk premia. Could be nice if we could see if this is playing a role. Maybe for some countries, yes, for some not. And then, because we're talking about the banks and the financial sector in emerging economies, I wonder if the shocks related to the global financial cycle may also propagate through financial frictions. And this would be a really big difference with respect to the financial sector in advanced economies and could potentially lead to movement, say, in spreads. Yeah, so that's all.
Perfect, very nice, thank you. So both of you, so I'm sure we'll have questions. Shabnam, I'll give you a tiny bit to reply, and then we take.
Yeah, no, this is great. Thank you so much for this great discussion. I pretty much agree with everything. We can do a lot more on heterogeneity and time periods and other variables and all that. Let me just clarify one thing. So the reason why we went with the 3-month rate is exactly, it's supposed to be, there's like no default risk. This is the kind of closest you can come to a safe rate, right? Of course, you can have the, attitude that there is no such thing in emerging markets, sure, but it is a 3-month rate, and it is monthly frequency, where we try to take a lot of global things through that month fixed effect. So, but I fully agree, because of all those things that we know about emerging markets, it can still go through this, time variation, which is kind of part of the story, right? So the story is, it is clearly about the financial channel. As you said, commodity can be something else. And, this, I skipped that slide of the literatures we are contributing, but it's clear, global financial cycle literature, but also business cycles in emerging market literature. And that literature says, think about papers like Martin Rubin, most of the things in business cycle is about financial and external. So that's kind of how we see this, but there can be the other shocks important, other channels important. I fully agree with everything that, and we can do more. This is a very good suggestion to doing the local projections and try to do the definitive. Yeah, very good suggestion. Thank you so much. Very good.
Questions? Yes, Evi.
Yeah, so
You have a microphone.
I think everybody can listen to me now. Okay, anyways. So yeah, I was listening to your presentation and I thought Luciana did an excellent work discussing. But I was thinking, if you go back and look at the paper by Neumayer and Perry that they was talking about GDP growth against nominal interest rates, etc. There was a little bit of that, but they were not concentrated on financial friction. So what you do here is this. But you do something more, and I think I liked it a lot. So one thing that you do is that you are looking at how the central bank reacts to the shock versus just looking at the markets. So I would like to see a very nice counterfactual exercise that you can do to see how the business cycle would change if the central bank wouldn't react countercyclically. So how much the central bank contributes to reducing the cycle in emerging markets. And this is something that we don't know and we haven't seen. So it would be very nice that you do this kind of exercise. And the other thing is that I saw recently a paper in which they were showing that central banks are much more in place to react during recessions versus expansions. So there's a lot of inertia during expansions. And we know that in emerging markets, we have recessions that they are sharp and kind of persistent. So one thing that you might want to look is to look at the recessions versus expansions to see whether you will find differences in emerging markets versus developed economies. Otherwise, thank you very much.
Should I collect an answer? Should I answer that? If you want. Okay. Yeah. No, I mean, it's exactly what, we are exactly thinking ourselves contributing to that literature, started with Neumayer Perry paper, and, the global financial cycle literature started with Helen, and it is very important. So we are not saying there is any friction or nothing. So there is actually a very key market segmentation here, right? So the market segmentation is that foreigners cannot undo what the domestic banks do, right? And otherwise, you wouldn't have any problem. The CIP, holds in deposit rates, but not in that red RM, right? It doesn't hold. Why? Because the foreigners cannot come back and reprice that RM. So that is the market segmentation, which is you can see as a financial friction. That's for sure. And that's exactly why also we don't use the word monetary policy transmission, but monetary policy effectiveness, right? Exactly because of what you just said and what Luci said, because for monetary policy transmission, you really want an exogenous Mexican monetary policy shock, right? Which we don't do. Clearly, they are responding to this effect. So that's why we see more monetary policy effectiveness in the line of dilemma, trilemma work by Helen, right? So they are trying, but it is not effective because of their large exposure to this external condition. But that would be super, super useful. So, but to be able to do that, how much they can do, right? Obviously, it is not a full offset. It is part, but doing that for sure. But I think we also need to compare this type of endogenous response and a pure exogenous monetary policy transmission. Yeah, no, very, very good point.
I saw just one question because it reminds me. So I wonder whether you can go back to what is the optimal monetary policy, conditional and unconditional on the shock, okay? Going back to the Caballero Krishnamurthy kind of paper where you have a vertical supply of funds from the rest of the world or otherwise a flat horizontal line. And that creates, which is the distinction between advanced countries and emerging markets countries, okay? They face this different supply of external money and make a nice point regarding what is optimal ex ante, what is optimal ex post. So whether you can say whether counter-cyclical or pro-cyclical is optimal or not optimal, conditional on possible shocks. So you can do this kind of link. We got a huge, nice literature there. You can add to it also.
Right. So this is the new. So we don't do this, but there is a new literature looking at optimal monetary policy and also exchange rate policies in emerging markets. So if you start with the Gallo-Monticelli world, right, and then you say, you do the, monetary policy for domestic stuff and exchange rate will take care of everything. So now we are in a world, we understand that exchange rate is not going to take care of everything. And starting from that, which is of course, again, goes back to one paper, this literature, so Gita has a paper, Integrated Policy Framework, Oleg and Dima has another paper. So these papers exactly trying to identify the optimal monetary policy, but what they are finding is you cannot just do with monetary policy, right? And they are kind of coming to a conclusion still, you do monetary policy for the domestic things, right? So meaning you do countercyclical, that's your optimum, but then to be able to deal with these external things, you do other policies. And they are debating about other policies because they can be macroprudential, capital controls, exchange rate, FX interventions. So different papers look at different policies. So again, this is the very active literature right now. So what we are actually trying not to do that because, but let me say, we are consistent with that literature because it seems like that literature is coming to a consensus that at least with the policy interest rates, the monetary policy interest rate, you don't use it to deal with the external shock. That we are consistent with what that literature is saying. But that literature is now debating, okay, what is the other tool? Is it FX? Is it capital control? Is it macro? What is it that we deal with the other stuff, right? But so in that sense, we are consistent. But we want to take a step, okay, let's document what they do and let's try to understand why market rates is exactly opposite. Because, to us, this is a very, very interesting result. And because, in advanced economies, you don't even think, we don't even, when we do these things, go and look at the Fed fund rate, right? We look at the 3-month rate, and we don't even think twice. So what we are saying is like, well, you cannot do that in emerging markets, and that's really has a lot to do with these external financial conditions. But everything's exogenous, as Lucia said. So that's why an extension with how those conditions endogenize, which will endogenize the bank's problem. Right now, that we don't have the bank's portfolio problem, right? We have that share. We calibrate everything with the data, right? It's not that we are throwing numbers there, but yes, you can definitely think of a much richer model.
Very short last question by Fiorella.
To ask how much, you mentioned the possibility of endogenizing also the dollar funding rate. And I was wondering how much of these varying wedges that could explain, if you think of a US monetary policy tightening, it changes a lot whether this is in reaction to a supply shock where probably the spread on bonds would increase, or whether it's a demand and then the spread will fall down. And so that could play an important role in these wedges, I think.
No, exactly. This goes back to also Luci's point, and a kind of a important shock for emerging markets is the commodity shock. You can think also that as a supply shock to an extent. In fact, the papers we cite on that, frankly, is exactly arguing, you might get a lower response, not necessarily only because of fear floating, but there's like more prevalent supply shock. Now, what the monetary policy should be doing in that context, even we don't agree on that for advanced economies, right? Let alone emerging market. What I would say here is like, okay, so what are difficulties for advanced economies? Emerging markets had it hard because they also have to think about all these things, supply shocks, demand shocks, and on top of that, these external conditions that really affects and really limit the effectiveness of their monetary policy. Yep.
Excellent. Well, I think we should thank really
of trying to explain exchange rates, we ended up explaining global stock markets. So let me tell you what we do. So what is the main contribution of this paper? So essentially we introduce a novel decomposition of equity price growth rates in terms of equilibrium equity holdings, which is based on market clearing conditions. So we are going to essentially show you and try to persuade you that asset managers are like elephants in equity markets. So more specifically, with only 5% coverage in our sample. So essentially we observe only 5% of the holdings relative to the market caps of the stocks in our sample on average. Our reconstructed equilibrium holdings account for, on average, 89% of the 89% of the monthly variation in equity price growth rates for over 20,000 individual stocks and 96% of the fluctuations for 33 aggregate stock markets. So what do we do? So essentially this decomposition is going to express individual level and aggregate stock market price growth rates in terms of equilibrium equity holdings and its subcomponents. So it's quite an intuitive decomposition because the subcomponents have an economic interpretation. So the first term is exchange rate valuation effects. So this captures the fact that, for example, US investors buy Brazilian stocks and hold Brazilian stocks. The second component is the net portfolio return. So this is essentially the profits or the essentially wealth effects associated with the profits that funds make on their portfolios. The portfolio weight changes, so this is linked to the change in the portfolios in the weights, and final fund flows. Now, once we have this decomposition, we're going to persuade you that indeed we can account for almost all of the stock price variations, but moreover, we're going to use it to document a lot of novel facts about the importance of the equity holdings subcomponents for equity price determination, with the goal being to inform asset pricing models. And granted that, of course, the exchange rate will play a key role in equilibrating stock markets, there'll be a lot of implications for international finance as well. So in the interest of time, I'll skip the literature, but you are probably familiar that there is, of course, vast literature using mutual funds data, in particular the most closely related literature being papers that estimate mutual funds demand elasticities. I want to be very clear, we are not estimating the slope of the demand curve. This is going to be endogenous variables, and we'll be very clear what we do. And then, of course, papers studying asset managers more broadly, very related to our work. All right, so we'll start with the stock market price growth rate decomposition and then some stylized facts. So we start with a very simple accounting identity, which is just the market clearing condition for asset J. So here we're going to use ISIN level information, which is denominated in currency CJ, which will be the same as currency L. So on the left-hand side, here you have nominal holdings. So omega IJ is the holdings of fund I of ISIN J. So this is the, omega IJ is the weight fund I places on ISIN J. WI is the assets under management of fund I denominated in the currency of investor I. And then SLCI is the exchange rate defined as how many units of currency L do you need to purchase 1 unit of currency CI. So effectively you're translating the fact that you have US investors buying Brazilian stocks, right? So you need to convert their currency of operation into Brazilian real. And then P is, the right-hand side is the nominal supply. So PJ is the price of stock J, and QTJ is essentially the shares that are issued of ISIN J. So we use another accounting identity, which is essentially telling us that we can decompose the growth rates of the assets under management of fund I as the net of fee return. So this is the gross net of fee return to the portfolio of the fund, -1, right? So it's the net one, plus scaled flows, final inflows and outflows from the fund. Right, so once you have these two equations and you linearize effectively the market clearing condition, you get the following expression. So you can express the growth rate of the price of ISIN J as a function of 4 subcomponents of equity holdings that are appropriately scaled by the importance of fund I for ISIN J. So this is the weight, I cannot point, or maybe I can point. So this is this weight here. So effectively, this is the sample average holding of stock J by fund I relative to the sample average market cap of stock J. And now, effectively, the different components is, again, the exchange rate valuation effect, the portfolio weight change, the net of fee returns, and the final flows. So
Immediately, you might be wondering, you have only 5% coverage. Your decomposition requires that you observe every single holder of this particular ISIN, which clearly we don't have. So this is the beauty of this paper, and this is the contribution. What do we do? So essentially, we have to circumvent that problem. And what we do is we aggregate our observed holdings in the Morningstar Direct Mutual Funds data as if we have a representative sample of equity investors. So we're going to be very specific about what we mean by the fact that we use representativeness assumptions. So we're going to spell them out in a second. So the first assumption that we make is the following. So we're going to decompose the scaled portfolio weight changes for a given ISIN by fund I into unweighted average within a type of funds and a residual. So you take this portfolio weight change that you observe for every single stock, for every single fund, you group by funds, the funds by type, right? So you have, for example, here we're using broad investment strategy. Definitely we have fixed income, equity, allocation, etc. Then we have another characteristics. Are they active, passive? How active they are, frequency of rebalancing, and whether they're local funds and foreign funds. So within the bucket, you take the average, which is the first component, and then the residual, right? This is, again, you can decompose any variable in this way. And then what does this essentially variable look like? So the dots here are the actual portfolio weight changes. And here we've split the sample into index funds and active funds. So the blue is active funds and the red is index funds. And then you have in green your average scaled change of the active, of the weights for active funds, and in yellow for the index funds. So in our decomposition, we're going to be using this average, only this line, right? So effectively, the difference between the dots and the line will be this essentially residual or idiosyncratic component of weight changes, which is going to be a residual. We cannot observe that, right? Because effectively, we do not have the full coverage. What will be interesting is that we'll show you that this massive cloud is going to be irrelevant, and only this line here is going to be enough for you to understand the dynamics of equity prices. Now, you can do the same for the flows and the net of your returns. You decompose them into the average within even more narrowly defined bucket of funds here, and then a residual. And again, the assumption here, the underlying assumption is these funds behave in a similar way, right? So if you're, in this case, emerging market fund, etc., you rebalance in similar way, and you have observed similar inflows, etc. So what is step 2? This is effectively our aggregation methodology. So we're going to assume the following 2 representativeness assumptions. So we are going to assume that the sample average portfolio weight changes, flows, and net of returns for all investors that belong to a certain type, in which we observe in the Morningstar data capture well the population average. So we're going to assume that this line that I showed you, which is based on our sample average, is the same as the population average for this type of funds, right? And the second thing that we need to assume, we call it representative holdings ratio. And the only thing that this means is that if you take essentially the holdings of a particular type of fund of ISIN J observed in our sample relative to the holdings of the same type of funds in the population, this ratio is the same across all types, right? So this is kind of our representativeness holdings ratio assumption. If those 2 assumptions hold, then we can further decompose the growth rate of the price of every single stock into these 4 common components of holdings. So first we have the exchange rate valuation effect, which of course there we don't need to take an average because we just observe the exchange rate change. So this is the first. The second one is the common component of holdings due to final fund flows, then the common component of holdings due to portfolio weight changes, and the net of returns. Now, this residual here, which will be backed out as a residual, is going to be this idiosyncratic component of weight changes, net of returns, and flows, which we're going to show you pretty much doesn't matter at all, right? This will be a result. And then this is the new issuance, which also is not going to matter at all. Right. The data, we're going to use Morningstar data. We start with 36,000 funds, which includes equity, fixed income, everything. Then we're going to supplement our data with information from Refinitiv Icon. The assets under management at quarterly frequency is 50 trillion, at monthly 25 trillion. We're going to show you the results at monthly frequency, 33 stock markets. The data is from January 2008 until December 2021. And we cross-check that effectively the size-weighted stock market growth rate, which we aggregate from the bottom up, correlates well with the stock market indices that you can just download from Global Financial Data. Okay, So let's look at the fit, right? This is Toyota. This is just one firm where we have an average coverage of 5%, average number of funds holding the ISIN per month for about 450. So what you have in red is the stock price growth rate of Toyota, right? So this is the actual price. In blue, you have what we call the total component of holdings. This is literally the sum of these four components which we can directly observe and measure in the data. Notice we're not doing any estimation, right? We don't need to worry about instruments, et cetera, et cetera. The only thing we did is we made these two assumptions on representativeness. If they hold, the fit will be perfect. If they don't, our sample is not representative, and as we're going to give you examples of when it doesn't hold. Clearly, for Toyota, the fit is perfect. The second thing to notice is we want to persuade you that actually adding up all the components in this particular way matters, right? So let me decompose this example for Toyota further. So here I'm plotting in blue just the essentially common component of holdings, which is due to the portfolio weight changes, right, on its own, and then the stock price growth rate. So you can see that already gives you most of the action. The fit is already pretty good. Here I'm adding on top of it the exchange rate component, so it starts to improve even more. Then you add the flows component and you get the net of fee return, you add the net of fee returns component, and this is kind of the total that I showed you before. So you can see that adding each one of the subcomponents keeps improving the fit until you get this perfect fit. Now, it's not just Toyota. This is Apple. This is LVMH, and we can show you hundreds of ISINs. We have 20,000, and we've stared at them. One day, we spent the whole day doing that, and we're amazed ourselves. All right, so now let's do it in a systematic way. So how can you do that systematically for all the 20,000 ISINs that we have? We can do variance-covariance decomposition, right? We can calculate what fraction of the variance of essentially these stock price growth rates are explained by these common observed components of demand. So this is the sum of these four common components. And then we are going to plot that in a histogram. So this is what we are presenting here on the left-hand side. And on the right-hand side is the share explained by new issuance. You can see it's close to zero, so we are going to just ignore it for the rest of the presentation. So focus on the chart on the left-hand side. So what you see here is that we can explain 89% on average of the variation for all these 20,378 ISINs, right? And you can see that actually the peak is very close to 1. So for quite a lot of this ISIN, we have almost perfect fit. This is also telling you that this residual, which captures the cloud, the idiosyncratic component, is irrelevant, right? That's another result. Right, so let me show you when it doesn't work, because people didn't believe us. It looks like magic. You're doing something shady. So let me show you when actually the decomposition doesn't work. Well, China. So Industrial and Commercial Bank of China, as you can imagine, our coverage is not amazing for the Chinese stocks. You can see that in the beginning of the sample, we barely have any dots. Then a bunch of index funds start to trade this particular ISIN for China, and we start to get more funds. So what does the fit look like? Well, in the beginning of the sample, the fit is quite poor. Notice we have 0.1% coverage. We don't even have 1% coverage for this particular ISIN, and 37 funds on average per month hold the ISIN. And still, you can see that when our coverage improves, actually the fit starts to improve, right? You just need the representativeness assumptions to hold. Right? So how can we test that more systematically? Here on the left-hand side, we are showing you how important it is to have a lot of funds in our sample in order to get a better fit. So this is your average number of fund holdings, the ISIN per month, and then if this number is close to 0, you have a perfect fit. So this is just the absolute value of 1 minus the share explained by the common components. You can see that clearly more funds in the sample helps. You're gonna get, a mass here close to 0, but it's not the only story. Clearly, for some ISINs, you don't have that many funds, but the fit is still pretty good simply because the funds you observe are representative, right? And then on the right-hand side, we do the same with, do you get a better fit with higher coverage? So this is the median coverage per ISIN over the sample. Yes, if you have a better coverage, you're gonna do better, but again, even if you have low coverage, representativeness assumptions hold, you're still gonna get a good fit. Right. Now let's take this and aggregate up to the stock market level, right? So we're gonna weight each ISIN based on the size of the ISIN relative to the size of the stock market. And then you're gonna see that on average, we're gonna explain about 96% of the variation across all stock markets. So this works not only for the US and emerging and advanced economies, emerging market economies. For China, indeed, it's only 70%. We would claim 70% is still pretty good with the low coverage we have. Now, what does the perfect look like? So here we are effectively overlaying the actual growth rate of the stock market price relative to the common components aggregated up to the stock level. The lines are just on top of each other. Now, the results are robust to performing the decomposition at quarterly frequency, where we have more data and using only the holdings of the marginal traders, so funds that change the shares held. Now, what are the facts? There are two main facts I'm going to briefly discuss in this presentation. First most important fact is we show that micro is not like macro. What does this mean? So we find that portfolio weight changes explain most of the variation of individual stock prices, and I'll show you the results in a second. However, aggregate wealth effects are relatively more important for the overall stock market, but there's significant cross-country heterogeneity. And the explanation that we propose is heterogeneous within and cross-currency border rebalancing across advanced economies and emerging markets. And the second key fact, which is linked to international finance, is that exchange rates play a key role in equilibrating all stock markets. So what is happening here, right? So high equity holdings by US investors of Brazilian stocks is associated with the Brazilian stock market appreciating in local currency, but also the Brazilian real appreciating, right? Because the market can clear in two ways. Either the stock market price increases in local currency or the exchange rate appreciates. So if the exchange rate appreciates, the local stock market doesn't need to appreciate that much. So this exchange rate movement actually is dampening the volatility of the local stock market pretty much for every single country besides the dollar, Japanese yen, and a few countries pegged to the US dollar. So this is effectively the covariance decomposition that I showed you before, but at the aggregated stock market level. In red, you have how important the portfolio weight change component is, and you can see, as promised, most of the variation of the aggregate, sorry, this is not the aggregate stock market. This is the panel regressions of the ISIN level results. So I'm showing you essentially using individual ISIN level data and the panel regressions. You can see that the weight changes plays the most important role in red, followed by the net fee returns. You can see in blue that the exchange rate scaled covariance is negative. So this is what I explained. Effectively, exchange rates dampen the volatility of the local stock market, and the residual is in purple. Now, of course, we have very rich data. We can split our funds in any way possible to tell you which funds truly matter. So here we do an important split based on index funds versus active funds. So you can see that, yes, index funds are important. So for the US, they explain about 20% of the variation, but still active funds are more important. For the US, they explain 40% of the variation of the weight changes. And then in general, active funds tend to be more important. Now, when we do the same variance covariance decomposition, this time at the aggregate stock market level, you see a very different picture, right? So in red, you still have the portfolio weight changes, and they're still very important for quite a lot of countries, primarily emerging market economies. So these are the countries on this side of the graph. On the left, you have advanced economies with Swiss franc, Japanese yen, US dollar. Here, the stock markets associated with these currencies being truly on the left. And for those countries, it's the net fee return. So it's the wealth effects that matter the most. If anything, the change in the weights actually is slightly negative for those three countries, right? Now, the flows, I forgot to mention, they always have the right sign and they're statistically significant, even though they explain a small fraction of the variation. So how do we explain this result? Well, the beauty of our decomposition is we can, since we have the ISIN level variance covariance decomposition and the aggregate stock market, we can connect them, right? So we can decompose the stock market level decomposition, so the covariance between the aggregate stock market price growth rate and the weight changes aggregated to the stock market into these same covariances at ISIN level. So how do we do that, right? So we are trying to understand why we see this drastic difference at the aggregate level and the micro level. So this is equal to a term which captures what we call owned covariances and another term which captures cross covariances. So once you sum up the different ICEs and you weigh them appropriately based on how important the stocks are, what's happening is now the cross covariances start to matter, right? For this overall importance of the weight changes. So these cross covariances capture what is the effectively the covariance between the changing the holdings of ISIN J and the change of the price of ISIN K, right? So the bigger the stock market, the more ICEs you have, the more these cross covariances are going to matter, right? So what we find is that why do we see now that for Switzerland, Japan, and US, all of a sudden is the net of fee returns, so the wealth effects that dominate the weight changes, well, these cross covariances are actually negative, right? So what's happening, and they are quite positive actually for emerging market economies, and the own covariances are always positive. What's happening is that funds are rebalancing their portfolios very differently with respect to advanced economies and emerging market. When you're buying a stock in the US, you're selling another stock in the US, which is giving you this negative scaled covariances. When you're buying a Brazilian stock, you're selling a Turkish stock. So you're going across borders, right? So that's why actually you need very different type of models for emerging markets versus advanced economy, as Shebnem has been telling us for a while. Right, now let us advertise the paper we intended to write, which we did, and it's posted on my website, which is about exchange rate. So you can take the same decomposition and now learn a lot about exchange rates, right? So in this follow-up paper, we decompose exchange rate changes in terms of currency-specific equity net supply, which is the growth rate of the stock market capitalization less the change in equilibrium holdings denominated in the investors' currencies, scaled by observed elasticities which capture the investors' currency centrality. So it's another decomposition based on same market clearing conditions. We show that the observed components account for most of the variation, 95% of variation of 28 currencies against the dollar base, and 95 and 98 against the euro base. So then we use our decomposition to explain the striking movement between the dollar, global equity markets, and the global financial cycle as captured by US macro news and risk aversion news. And just to show you the beautiful fit, so our observed components, which are just function of the holdings and the growth rate of the local stock markets, can fit perfectly the euro dollar, the pound dollar, and the Swedish koruna. We were talking about it yesterday. So essentially, we argue that indeed, this is a very useful decomposition. So let me, everyone, 28.
Works for everyone.
Works for everyone. Conclusion, we develop a novel decomposition of equity price growth rate based on market clearing condition, linearization and representativeness assumption. The fit of the data for individual and aggregate stock market price growth is exceptional. We argue mutual funds are elephants in equity markets. Given the minimal number of assumptions, we literally estimate nothing and we use an accounting identity, right? The novel stylized facts we provide should motivate all theories because they all should have a market clearing condition in them, and essentially that is the contribution of this paper. Thank you.
Thank you, and you are 1 minute early.
Oh, wow. How is that possible? Would you like to sit here if it's easier?
Nina is going to be discussing.
Great. Thanks for having me. As Lucia said, it's very nice to come back year after year to this conference. It's always a lot of fun, and I learn a lot. We are in FOMC blackout, so I have a much longer disclaimer than usual. And in particular, besides not reflecting the views of the bank or of the system, I'm also going to abstain from commenting on current monetary policy. Anyway, thankfully, I was not asked to discuss a monetary policy paper, so hopefully I should be able to avoid those issues. So just very quickly, from my perspective, what does the paper do? So the paper provides a variance decomposition of stock level price changes into fund flows, fund returns, allocations, and exchange rate movements. I mean, Vanya showed a lot of these results. So for example, at an individual level, for most ISINs, so for most individual stocks, this decomposition can explain between 50 and 150% of the price variation. That winds up averaging to roughly 89% of the variation across stocks and countries. At the individual level, the largest contribution tends to be the portfolio rebalancing. Again, you're going to have a range across different countries, different currencies. One thing that to me was kind of interesting was that for the US, you actually to some extent get the smallest contribution of the portfolio rebalancing channel. And so in terms of the different currencies, you go from roughly 60% coming from this portfolio rebalancing channel to 81% for Korea. And then the second, again, at the individual stock level is going to be the net of fees fund returns, which is the thing that to a large extent is going to generate the growth in fund sizes over time. One thing that, again, Vanya also talked about is that demand changes due to exchange rates are going to be mostly negatively correlated with the stock price changes. Again, with the safe currencies kind of being the exceptions. So I think overall it's a very interesting way of thinking about individual stocks and how different institutions actually contribute to stock price variation. And so what I want to do in my discussion is first compare a little bit to the other literature that has thought about the contributions of individual portfolio investors to stock prices, then think a little bit about what are we assuming when we assume representativeness assumptions, because those really are the meat of the paper as well as the associated exchange rate paper. And then I am going to advocate for thinking about other moments besides just thinking about how prices vary over time. Okay, so in terms of their relation to this literature, I think it's pretty clear that this approach is essentially an accounting exercise. That's kind of the very nice part of what this paper is doing. And so again, just to remind you, we're essentially going to take month-on-month changes in nominal holdings by each fund. Those are going to get decomposed into changes due to exchange rates, changes due to what I'm going to call growth in fund size, and then changes in allocations. We're going to group funds according to some characteristics into fund types, compute within each fund type how each of those four pieces tend to look like, and then we're going to scale up to the full amount outstanding, so to the full market capitalization of an individual stock based on coverage shares. Now, I think that kind of the closest competing way of doing this is what in asset pricing now gets called demand system asset pricing. The way that I think about demand system asset pricing is that it's, again, you're still trying to do market clearing, but you're trying to actually model what each individual fund is doing with their portfolio allocation, essentially based on a hedonic representation, where of course the price of the stock is one of the characteristics you care about, but then you also care about a bunch of other things like a value index, and again, all the things that asset pricing has thought about in terms of what generates returns. Now, aside from the fact that kind of by definition, the demand system asset pricing approach is it relies on a specific formula for how you're representing the fund allocations. The other difference relative to the exercise in this paper is that the demand system approach, for the most part, there are a couple of exceptions in the literature, is a static representation. So meaning at each point in time, for each fund, you represent that month's portfolio allocation with time varying loadings on the characteristics that you're thinking about, without anything linking how those allocations are going to change from month to month, month to quarter. So at the end of the day, both this paper and the demand system asset pricing literature is going to try to think about how much price or return variation can be explained by changes in allocations. So in this particular paper, the demand system tends to actually do that exercise thinking about the predictable variation in those allocations. What do I mean by predictable variation? I mean the variation that you can actually explain by observed characteristics. One thing that I thought was kind of interesting is that at the end of the day, if we add up the components that determine the shares allocated in the demand system and look at how much of that piece explains the overall, again, stock level variation of stock returns in the US, we kind of get to a very similar number. So the Cohen and Yoga paper finds an 80% explained by these allocation factors rather than fund size factors. So I thought from that perspective, it was kind of a very nice outside verification of the numbers that we get from the exercise in this paper. Okay, so in terms of the assumptions that we need to make to get there, again, Vanya showed us that one of the things they emphasize in this paper is that in general, you tend to have relatively low coverage, but accounting for a large percentage, of the variation in equity price growth rates. So again, in practice, what we're going to do is we're going to infer the average contribution of each of these components to the stock price variation based on what we can observe. So again, for example, in terms of the portfolio allocation share, we're going to look at the portfolio allocation changes that we observe in practice, extract the average for that particular fund type, and say that all portfolio weight changes can be represented as an average plus an idiosyncratic term. And then we're going to scale up that average to market clearing using the average importance of that particular fund type for that particular stock on average in the sample. Now, there are a few implicit assumptions or explicit in some cases, that go into this. The kind of one thing is that the observed funds of a given type that you see in Morningstar are representative of all funds of the same type. I'm not going to spend too much time talking about this. We all know that there are various biases in mutual fund databases. So for example, very small funds or very large funds being outside of Morningstar, there's potentially survivorship biases, but et cetera. We all know exactly what these types of data sets have and the potential issues they have. Now, I think what's a little bit more interesting to think about is the question of whether just by covering mutual funds and covering, let's say, all types of mutual funds, whether we're actually absorbing all types of investors relevant for the security. And here I'm kind of thinking, so in the stock market space, I guess the institutions I would be worried about are things like hedge funds, potentially pension funds to the extent that they're investing on their own without going through a mutual fund, and again, sovereign wealth funds. And it would be, I mean, obviously there's nothing you can do about the investor types you're missing, but it would be nice to think about whether in some of those cases for which even though you have, let's say, decent coverage of the mutual fund types, you're still not getting a good fit, whether some of that is because those are the stocks which you would expect to be held by these alternative investor types. The other thing that I think it would be good to be a little bit more careful with is the fact that we are using constant scalings to scale back up to the overall market cap level. Now, in a way, that's very attractive because you're basically saying, you know, I think on average, I don't know, I think on average, Prudential is responsible for 10% of Apple, so that's the weight that I'm going to use. I'm a little bit worried that you're leaving variation on the table, for example, due to stocks entering or leaving stock market indices, you can definitely imagine other reasons why a particular investor type becomes more or less relevant for a particular stock over time. That may be important here. In the last couple of minutes, I want to think a little bit about what else can we get out of this decomposition. So yes, the paper finishes by thinking about the aggregate stock market. But I think there's more you can do in terms of thinking about what the decomposition implies for, let's say, movement across stocks. So one of the interesting parts of the decomposition is that we do have a piece that is going to be common to all securities that is held by a given type. So that piece is the piece that's coming from net of fee fund returns and net flows into the fund. Now, of course, in terms of the overall decomposition that is going to be potentially differentially scaled across different securities, but I think it still has implications for the movement. And again, just to conclude, I think it's a very interesting alternative approach to thinking about why equity price changes over time. And I would just encourage Vanya and Ellen to think about what else we can learn from this decomposition.
Okay, thank you so much, Nina. So Vanya, I'll give you a couple of minutes and then some questions.
Thank you so much for reading the paper. I know it's a lot to go through, and thank you for the thoughtful discussion. So yeah, I mean, I'm on board with absolutely everything you said. Let me just maybe mention a bit more about the type of investors we might not observe, because we've thought about it. And in particular, indeed, pension funds, sovereign debt funds, the important players. So interestingly enough, a lot of pension funds do fund of funds, and they go through mutual funds to invest. And when we talk to practitioners, that happens much more for their equity investment than fixed income. So when I've talked to some of the really big funds and fund managers, for some reason, the pension funds are internally managing like their fixed income portfolio, but they're outsourcing the equity to mutual funds where they just create a new share class for them and they're just a client. So indirectly, we observe essentially what they do. Sovereign wealth funds, yes, we don't observe, but essentially what we know about mutual funds is they use very similar factor models. So to the extent the sovereign wealth funds use very similar factor models in investment strategies and stock picking, actually we argue that it's stock picking particularly. You read the balance sheet, and we have actually follow-up work studying how IBS news and other firm-specific news propagate through the network and how important they are. But to the extent that they use the same investment strategies to the funds that we observe, you can kind of assign them in a bucket if they specialize in a particular way, and they're part of the funds we don't observe, right? You can just classify them as funds. So clearly, we start in 2008, where the coverage improves over time. Retail investors used to be much more important back in time. Interestingly enough, I tried, oh my God, Elon Musk, right? So where you have more kind of fat investing kind of stocks. So Tesla, right? So with Tesla, despite the fact that we have a lot of funds, I mean, the fit is still pretty good, right? But it's not like Apple. So there we're missing the retail investors, right? That behave slightly different. So there's definitely the point that you made is valid. So just to maybe speed up a little bit. In terms of, we haven't even started exploring the heterogeneity properly. As you can imagine, there's a lot of papers that we're currently working on. Studying more carefully the propagation of news is one of them. So stocks entering and exiting. So I did try the decomposition also with time varying weights, and the whole thing just goes through, and it's just cleaner to have the constant, but it doesn't really change anything. But yeah, thank you so much for the discussion. So, questions?
Thank you. And any questions? Silvia? And then Kendra.
Thank you. Just one clarification is, I mean, in some of the cases, the share becomes over 100%. And I was wondering, how do you think about that? And more to the point, I guess, do we learn anything from the stocks for which the decomposition is overfitting? Because, I mean, the way I think about it is that the forecast is going to be a bit more volatile than the actual data in that case. And maybe there's something to learn in those particular stocks. I wonder whether you've, there's something there. And then another thing, I don't know how fair it is, so tell me to stop if it's the wrong way of thinking.
You know,
about
I can
this.
handle it.
I mean, like the way I understand, I mean, it's a decomposition that explains the stock market with the portfolio weights, but can I think of it the other way around as well? Like, wouldn't the weights, like, are the weights a function of prices, and is there any dynamic that it's interesting there that might be explored? Thank you.
No, this was I expected something, Okay, thank you so much, Sylvia. So let me start with the second question. Yes, I mean, of course, these are endogenous variables, right? We make it very clear this is a variance-covariance decomposition. There's absolutely no causality in what we do. We still find it very interesting to document these stylized facts because we just don't know about it. For us, this micro to macro was a big surprise, even documenting the negative covariance of the exchange rate, the importance of the weight. Essentially, any model that you write, any asset pricing model, usually you make some assumptions that are going to give you certain dynamics, right? It's gonna imply how important this weight changes are, how important the wealth effects are. Often models even shut down completely the wealth effects and they don't even bother with the exchange rates, right? So we are telling people that the moment you go outside of the US, you have to incorporate exchange rates because most of the investors are US investors. Even for the US, you have to incorporate them because US funds are holding global portfolios. So the net of your returns, once you endogenously solve out for the prices, clearly you need to solve out for the net of your returns, which are themselves function of the price, right? Which is the next, one of the next papers. So yeah, of course, these are endogenous variables, and this is just the first step to document novel patterns to be matched by theory and just to introduce the decomposition. Now, the share over 100%. So these are scaled covariances. So what we are missing is the residual term. So this is the idiosyncratic change in holdings and the new issuance. So if it's above 100, it's telling you that this covariance between the residual term and the price is negative, right? That's it, right? Now, this residual term is interesting because this is not, you are not averaging the idiosyncratic components. You're scaling the idiosyncratic components based on the importance of these funds for ICNJ. So this has the flavor of granular. We're going to talk about it later if you want to say more than that. But this is your granular, shock. That's it. So there's interpretation, but not for this paper. Not for this paper. Yeah.
Thank you, very interesting. Can you maybe explain why we should think of equity in these markets as nominal assets? Because I don't understand really the relation with the exchange rate, right? Why is the exchange rate part of the decomposition that you have? Because in a sense, why should I think of LVMH as a euro asset? Is that what you assume?
Euro asset? I didn't understand the last part.
Why?
LVMH. Why is a euro asset? Okay. How do I define the? So I think those are
what's
two
the
questions.
relation with the exchange rate?
So maybe the first question is how am I classifying firms as belonging to different countries? So there is of course the price at which the stock is traded. And then what we do, we overlap that with the main region of operation of the firm. So effectively, we say this is US stock if their price is issued in dollars and their main region of operation is the US. So ADRs are not included in what we do because we want to call a stock market, we want to essentially the currency to be the same as the stock market in what we do. Why do we have exchange rates, right? So this is just your market clearing equations in nominal terms. So most of the global assets under management are in dollars, right? And then there are stocks of Brazilian firms that are denominated in Brazilian real, of European firms that are denominated in euro. So if a US investor is buying the euro stock, they need to translate their dollars, so their assets under management and funds are in dollars, into euro. So they do this exchange rate transaction to buy the euro stock. So remember, so our W was assets under management denominated in the currency of the investor, right? So we need to take the step of translating. So we take the network very seriously, particularly in the exchange rate follow-up paper, right? And because it's quite important for exchange rates.
Okay, so the very last two questions. So
Okay, Shebnem and Tabitha, and then, yeah. Okay, so I fully on board with what you just said, right? I mean, so because you guys are now doing stock price, but if the, you know, the JP Morgans, BlackRocks of the world want to get a Brazilian stock, they have to convert the dollar to real and like it full cost. Okay. Now, when you go to the exchange rate, because the whole theme of the paper is about the large guys, elephants, and the granularity, right? So that's why you do so much with 5%, and you get the same result. But Nina said is very interesting to the demand guys, right? Demand system guys, which is about demand, where you have this portfolio rebalancing. When you go to the exchange rate, I might be
not presented here.
Okay, but then it is not just the stocks. Then you want to have, you know, the dollars exchange for reals to not only all Brazilian stocks, but also bonds, you know, not just the sovereign, the corporate, the credit, all the dollars goes to the Brazilian, right? So then, is it still going to be the case mutual fund price the entire thing? Or now I have to think about now the local investors, you know, the other type of foreign investors. Now that whole issue of, do you think who am I missing is going to be important? Because now you are thinking about the dollar conversion to real for everything, everything that goes into that country. Okay. So how do you think that? Yeah.
I have the answer. So answer on number one, actually, I have a bit disagree in the comparison because they do ex-ante decomposition. We do ex-post, right? It's contemporaneous changes. So we argue that between TNT plus one price change, we correlate with between TNT plus one change in holdings, etc. What they do is change between TNT plus one in the future and period T.
No, not with the variance.
Not in the variance decomposition? Okay. And also the latent is not observed, right? The 80%. Anyway, we can chat later.
No, but that's why it's the right comparison to the portfolio changes, is to do
Okay.
not just the part that's explained by the...
You want to call that? Okay, so maybe you can explain to me later that. Okay, going back to your question. No, so you can take the same market clearing condition for equities, right? You remember how the exchange rate entered there? And now you can flip it. Now I can solve for the exchange rate just from this market clearing. There is market clearing for fixed income, right? For government debt, for corporate debt, for spot markets, everything. The exchange rate equilibrates every single one of those markets, right? But it still enters the way it does in my equity market clearing condition. So I'm just taking this equity market clearing condition and you're flipping it. The exchange rate goes on the left-hand side, and on the right-hand side, you have the growth rate of the local stock market minus the change in holdings denominated in the investor's currency. That's your excess supply, right? So the exchange rate needs to move to equilibrate, and then all the net supplies matter, and you multiply them by the elasticities. So again, clearly, you are still going to be the same market clearing. Oh, it's a different decomposition. Different investors in different markets. Yes. All the net supplies matter. It's a system of equations that you solve. It's a, yeah.
Last question was with Tabitha.
Yes, I think my question has already been answered because I wanted to an explanation of the whole analogy of credit funds in the equity market.
Sorry, which funds? Fed fund?
Yes, I mean the whole analogy of elephants in the
Elephants. Okay.
Yes.
Okay, so the elephants in the sense that their behavior is representative of everyone in the market. We're not saying that there are no, sovereign wealth funds don't matter or pension funds. It's just that they behave in a similar way. That's what we mean by elephants, right? We have 5% coverage on average. But again, if they all behave in a similar way and,
So, okay, wonderful. So let's thank also the speaker. Thank you very much, and we have a coffee break, right?
But I thought that they're when they're saying what fraction of the ratio they can explain, it's ex-ante decomposition, right? It's based on period T.
So you are really not saying.
Or maybe which paper is that?
Mutual
They have
funds
a
price.
The one that
No,
is
mutual funds are going to be.
No, but they do the variance decomposition.
Yes, because in the emerging market, it can still be the local guys' pricing.
Yes,
right?
yes. There's no causality.
You don't take it standard.
But somehow, for some reason that would be the structure in the law, when we change from
Do you represent for the exchange rate? Because again,
when we start writing
Yeah, because actually it's true that it's their demand impurity, it's a function of expectations impurity, and then they used to effectively.
No, but expected return, but if we can learn, but that's what they're saying. They might be doing that, but we can learn from foreign because they keep on so you're not having the data comparable to the
So,
yes,
but keep on a bit more question, because
no, exactly.
to identify the channels to like the price
Yes, because you need to model that exactly. Even different investors hold different things, and it will still be local guys hold most of the bonds. Yes. Because the action depends on local guys action exactly.
So it's
That's how I was
that's interesting. So
Similar to the later, which they don't know what the later is.
maybe to do some forecasting. And we haven't done any contribution. Thank you. Thank you very much.
Thanks.
So yeah, the Valentin variable is essentially, we don't know how to explain the price movement, and the Valentin variable might be picking up a lot of these, now they kind of put some structure with what they call the attributes paper. Essentially, they're putting some structure on these unexplained components. And in effect, the structure they put comes from the holdings data, which is curiously enough, the holdings data what we use. So essentially, this is the same information. We just, then try to, so that's kind of interesting, no? Yeah.
But yeah, thanks so much. Yeah, thank you.
Vale. Ya lo tendrías.
Es más
Si quieres.
¿Aló?
Qué bien.
¿Cómo va? Tiene un... No tiene un eco. Tiene un eco.
Voy a buscarlos en la cabina para porque estaba escuchando algo así. Y te pongo la presentación, ¿vale?
Sí, gracias.
So just a second, while everyone is sitting down, let me remind you the plan for today. So after the session, there is a guided tour to Banco de España. So for those of you that haven't done it, I really encourage you to do it. So it's not just walking around as we've been doing the whole morning. They're going to explain to you about the history of the building. You're going to enter to like secret rooms with like super nice paintings. So I really encourage you to do it. Also afterwards, you will have like some time for resting, going to the hotel or just whatever you want. And then dinner is at 8:30. Okay, so just for you to have these logistical details into account. So okay, now without after the tour, you can go to the hotel. Yeah, yeah.
You have to come back. I don't know where.
To the dinner directly. We'll send you an email. Or I'll give you details later. Yeah.
De la mañana es español.
So let's start the third session of today. So we're going to start with Laura Alfaro telling us about supply chains and rare earth elements. Thank you.
Thank you to the organizers for bringing me back to Madrid. I'm gonna do this standing up because I'm very jet lagged. And I thought I would start by mentioning that Madrid has very much been in our thoughts in my house all over the summer, but I realized this is a joke that only people from Madrid may get and Swiftie fans. So in the US for the Olympics, they played this Swiftie song that says, "Let the game begins, are you ready?" But there's a part in that song that says, in the middle of the night, in my dreams, but when she played in Madrid, people changed it to, in the middle of the night, in Madrid. So every time they played that song in the Olympics in my house, we were like, in Madrid. But anyways. Yes. So that is to wake me up. And now we change topics and we talk about industrial policy, trade policy in rare elements. So I think perhaps the motivation is not very needed. There seems to be this renewed interest in trade policy, industrial policy, and in particular in strategic sectors and their effects on global value chains. This is a mixture of the interest in the green transformation, but it's also due to national security concerns and the new, if you want, Cold War, until they come up with a better name, between China and the US. To the point that there is risk that these tensions create new forms of trade restrictions, and that has already been the case several times, but more recently in 2003, China limited the exports of gallium and germanium, which are used in semiconductors. But what we argue is that in a world of very fragmented global value chains, actually the effects could be a little bit more complex, and that is what we're trying to study in this paper. So why study rare elements? Turns out, and I'll explain a little bit more, I don't know about you, last time I studied chemistry was in high school, and so this has been a very nice refresher. So, rare elements, there are 17 elements, and I'll go a little bit more over them. It turns out that they're not rare geologically, it's just they're very complex to mine, and in particular, they're very hard to substitute. They are also used in very critical uses, as I mentioned, green transformation, but also medicine, military, and so it's these permanent magnets. If you start working in this topic, you're going to become obsessed, as I am, on permanent magnets, because there's a magnet that uses one rare element, and it's in absolutely everything you can think of. And so I've been taking now all computers and all phones, and I'm looking for this. but it's also in catalyst. So again, you see it in many uses. And in particular, they have become relevant because for historical reasons and geological reasons, they are mostly processed in China, and they're very hard to substitute. They're very inelastic in the short run. So the big picture is that these can potentially have big effects in the global value chains, downstream and upstream. We're going to focus downstream. I'm going to explain why. But also potentially create a lot of incentives to innovate. To give you a preview of a very preliminary paper, and apologies to the discussant because the word preliminary doesn't end to describe what we sent.
Very preliminary discussion.
We find that the policy that targets, we're going to exploit the 210 event. This policy, what ended up doing, and perhaps inadvertently, was to increase output, efficiency, and innovation abroad. And how on earth are we going to come with this finding? The first thing we do in this paper is we have to construct an input-output of rare elements, because if you go to the most disaggregated BA input-output, they're very hard to find. They're in others. And so we have to construct an input-output to be able to estimate the effects of the policy. The second thing we have to do is look at patents and classify rare earth innovations. So as you know, there is no standard matching from patents to sectorial industries. People have done it, and there are classifications out there, but those classifications do not include rare elements. So we had to go, and for this, we look at all the patents, and we use ChatGPT to help us find key words. Then we're going to exploit the event into 10, and I'll go into more details in a little while, when China restricted rare elements, and we're going to look at the effects and sustainability of the usage depending on these input-output needs. And we're going to find that this actually led to increasing export TFP and innovation in downstream sectors outside of China. And then we're going to try to rationalize this with a model of direct technical change. We have a model that has trade, IO relations, and direct change. And we're going to look at reallocation and innovation, the effect of shocks in this model. We want to do this a little bit more. The discussion got many pages of algebra, but we have some results that are consistent with this direct technical change. There are a lot of literatures. Again, we're starting this work. It does relate to the work on supply chains. Camelia is going to present some work that we're doing on this reallocation. There is a lot of work on industrial policy. And Harrison and Rodriguez-Clare had a previous handbook on this, but this has been reviving new reviews of the literature. And of course, there is the literature on direct technical change that has not only looked at it in general, but also has looked at different examples of this phenomenon, and in particular, in climate-related technologies. So this is how the paper will one day look, Laura. So if you have a lot of imagination, this is what it should have looked and will look one day. So let me give you a little bit of background on rare elements. This actually turned to be a lot of fun. It's a lot of fun, and this is the problem. It is indeed a lot of fun. So what are these rare elements? The rare elements are the lanthines, scandium, and yttrium, and the ones that I put there. Why they have become so interesting is because they have unique electric, optical, magnetic, and mechanical properties. So it makes everything more magnetic, lighter, more luminescent, and conduces more. There is a nickname in a book that we read that says it makes everything faster, lighter, and stronger. This is what rare elements do. And in the world where we like things to be very little, That's why they have become very important. And it's interesting because in the 80s used to be you wanted that big radio and you went with the big radio and you wanted that big TV and you look now the kids are watching on a phone Netflix. So again, it's a movement for lighter, faster, stronger. There's actually a very good factoid that if you had used one of these rare elements to do the Tour Eiffel, you would have needed 30% steel. Yes, it is addictive. It is addictive, especially if you didn't know a lot, like my case. So they have broad and diverse applications. You tend to use very little, but that very little is very hard to substitute. It's relatively inelastic in supply and is very highly concentrated in mining and processing. And Isabel has seen a version of this. So because of what I said of the characteristics of these rare elements, they have very broad applications. So in that paper, we're going to focus on just the ones that I mentioned there, because they tend to be the ones that are used the most, and also where we found better scientific data on uses. So we're going to focus on those ones. They're often needed very little, and is very hard to substitute. So a very good example is this magnet that is everywhere. So some of these magnets are also used in wind turbines and so on and so forth. If you use the normal magnet that has cobalt, things become 30% heavier. So if you think about anything about climate change, you want to make it lighter so it uses less energy. So again, it can be substituted, but it's not so easy and it's costly. And we're going to exploit some scientific analysis, and I'll go more into this, on this substitution of the elements. They're relatively inelastic in supply, but not because they're rare. They're actually in vast amounts. So if you go and bomb the Rocky Mountains, you'll have infinite amounts. They're everywhere. One reason why they're so complicated is that they tend to be a byproduct, and thus the Greek. The name, lanthine, which is the first one found 1857, the name actually means to lie hidden, because you had to first get cerium, process it again, and then you will find the next one. So this is like bread pudding. To get bread pudding, you first need to do bread. But if everyone eats the bread, there is no more bread pudding. But it is a little bit like that. And the process, in fact, there's one that is neobidium, the one that goes in the magnet, it has the neo, because they first found another one, and then they processed it again and again and again, and they found the next one. And the processing is not trivial at all. Is high heat or many complex things. Many are toxic. And so this is the other reason why geologically, a country that had initially a lot, which was China, also eventually concentrated a lot because it's over environmental standards. And thus highly concentrated. In production per se, not as much, but it's the processing, huge economies of scale eventually in all of these. It turns out, again, random comments, there are very few mining processing outside China. We actually talked to a couple of them. We had to sign NDs. So we thought that was the way we were going to go, like go and talk to the companies. But to learn a lot from the companies, we had to do NDs. Again, and that's two. That's it. Like there's no, and the other one is China, which we don't have access. So what we do then is we construct an input-output of rare elements. We start with BH to 12 for a couple of reasons. Our event is to 10, so this will be the closest. It turns out also it's a classification that has the most disaggregated, closest to the event that we use. Then we use geological surveys. The US has all these very nice documents where they go deep into use. And so we go and read all of these things, and we start filling the gaps in terms of the input-output. We need prices, so we use there are prices of these products. In Asian Metal, there's another one that tracks this, so we use that. We also complement with unit prices from trade data. It turns out that the trade data has the same problem. There's some that you can find, like uranium, which is not a rare element, but uranium has its own trade code. The others are just combined, which is kind of interesting because if you look at trade data, every possible form of textile has a code, but not rare elements. And again, this is the outcome of trade restrictions in textiles. And I believe that someone doing this in a decade or so, they're going to have individual trade codes because that's how this trade code evolved. And we use industry reports. And again, one of my co-authors, brothers, is a physicist from a German institution. So we have a backup in terms of actual knowledge. So again, one day in the paper, we're not describing more detail how we're doing this. But again, so we start with the input-output. Some, again, if there's a general application, we'll start dividing into the different nice descriptions. Sometimes you start getting these other basic inorganic chemical. And so those are the ones that we're trying to split a little bit into different things, looking at the definitions. We use unit prices, as I mentioned, and then we use inverse to convert some of these things. So just to give you an idea, this is sort of what we're getting. This is 10 to the power of 3. Again, just to convey that they're used in very little. It's just like a dot what you use. But again, the problem is that they're very hard to substitute. But usually you tend to use very little of them. So all the commotion on rare elements, it's a little. So we exploit the event in 2010. So China had an industrial policy in limiting the export of rare elements. They had started to reduce the quota, so they had becoming more flexible. It could be correlated with many things. 2010 also, this is also after they joined the WTO, so there was a lot of process of trying to reduce some of the restrictions. But then there is a problem in the oceans nearby between China and Japan, and then China gets a little bit nervous with some Japanese boats, and then this creates a problem. And so what China does is it restricts the exports of rare elements to Japan. Japan is the main user of magnets at that time, and a lot of these products, in fact, this famous magnet was invented by someone in the US, but also at the same time, someone in Japan, and the person in Japan is the one that exploded the use. Then there's increase in taxes, and then there's export quota. So we argue that this is more related to geopolitical conflict than per se something more strategic. And so as a first look, we look at prices. And again, a lot of these prices are very liquid, but you can see the spike around the conflicts. We also look at earning calls, and we start looking at mentions of firms trying to expand, innovate, substitute, or produce rare elements related products. And we do find, again, a spike in cold earnings, again, suggestive that something was happening. I have no clue where I'm in time, how much I have. Okay. So we do a little bit of empirics to try to put a little bit more structure. So what we try to do is we want to look at the effect of this shock on manufacturing sectors outside China, inside of China. We use different outcome variables. We use export growth from UN Comtrade. We use also as proxy of this theoretical technical change, these patents that we're getting from the Google patent data set, and also classifying, and I'll explain a little bit more. And we also use different proxies of TFP and productivity growth. Then we construct this IO table, including the rare elements, and we have a sample of the 50 largest economies, and we look from 2002 to 2018. And so the way we do this is we're going to look again at different outcomes, and we're going to look at the sensibility of use of rare elements, and I'll explain it in a second. And we look after 2010, before and after 2010, different fixed effects. So the way we measure the sensibility is, so we use our input-output total requirement coefficients, and we weight by the complementarity or lack of complementarity of these rare elements, and these we're taking from science. So we go and look at these cool papers, and you sort of like get this feeling that yes, scientists are better than us. And so they went and started documenting the different uses of the different rare elements, and they tried to look at the application and how it can be substituted and what percentage, and with this they construct an index. As I said, this is used, it's done more for just a subset. This is likely, of course, to be endogenous. We're using, this was done at a date around our time, but then we're using, if you want, physical and chemical properties of how substitutable these rare elements are in the production of these different products. And so, no, return. No, it's not returning.
You got lost in the appendix.
Yeah. Okay. So we look at export growth of rare elements, and we try to use different measures. Here I'm presenting relative to China, and we do find that there is growth in downstream industries. And again, we find significant effects. In the paper, we're constructing different proxy measures for how we're doing this growth rate, but we're also using different proxies for the use and the complementarity. So the main specification uses this scientific, if you want, physical, chemical, but we also use changes in the prices, the spike in the prices as a measure of how substitutable they could have been in economic terms. And also we use the import shares pre-shock. And they all give us this consistent result that in general, you do find an increase in downstream exports, an increase in the exports of products downstream that use rare elements. And again, here we're just trying to get a sense of the effects. And here we're just looking at the exports outside of China during this period. The global financial crisis had an effect, but you do see that there was an increase after the shock. We look at patents, and again, first we find the patents, and then we have to classify the patents to match the different industries. But the other thing that we do with ChatGTP is to try to classify in patents that are trying to really enhance the use of rare elements. So there's some that use the rare elements, but then we try to find out, are they just making these more efficient in the use of rare element? And indeed, a little bit of that happened in the magnet, for example. Now the magnet uses a little bit less of that rare element. Turns out what happened is that now we use infinite more of these magnets. So the actual use at the end is higher, but each magnet is now more efficient. And again, we find evidence that there was more use of, we find more patents that mention rare elements, and we also find more patents that use rare elements, but are about enhancing the usage of rare elements. And we look at different proxies of TFP. We find evidence of TFP. We use labor TFP. For the US, actually, we can do better than industry because there's better data. Well, we had access to better data. And so we do find that there was increase in the exports of goods that use rare elements, increasing patenting, and evidence of increasing productivity. So we build a model of direct technical change that is basically based on Danone's work. And we have 4 layers. So we have the final good that is either consumption or the input to try to pay for innovation. This becomes an industry that is a bundle of different goods that use that have different substitution. Then we have the use of either labor or elements to produce this. I'll be China. This is the lack of humidity in Spain. And this bundle uses labor and rare elements, and we can solve it. We decided that this is probably a better explanation of the model just to see the different layers of the model. So we can mix inputs and rare elements to produce these tradable goods that go into a bundle that becomes a final good, and the final good is either consumed or used to pay the innovation. And so this model, for you to get the results that we need these goods to be gross complements. Usually one can get these elasticities from expenditure shares, but we couldn't, they don't exist anywhere, and or attempt to get them from farms has an ND, so we cannot get them from anywhere. But the model suggests a way to calculate them. So we look at the change in the relative innovation with the different weights. And so we can estimate these using patents, relative unit values, and unit prices. And our estimates so far actually do suggest that these estimates are consistent with the predictions of the model. What we want to do next is do counterfactuals and look at the effects. But to conclude, we look at the industrial policy. We do find that this shock actually had some interesting effects downstream, which, by the way, people do mention now that they're trying to limit China's access to semiconductors. Everyone says, well, the only thing you're going to get is that China's going to innovate in semiconductors. In the meantime, people are just putting semiconductors in their bags and taking to China. And then we want to look at the shock. Thanks.
Thank you, Laura. Perfect timing. Now, we have Laura Bottazzi to discuss the paper.
May I move? Possible to move? I don't know it. What do you use it? I use it this way. It's much better. Oh. It's nice. It's difficult to find a Laura. Now we have Laura, Gegen Laura.
I told her mother had great taste.
Yeah, we had great mothers. So let me start here. First of all, let me start by saying that I didn't know anything regarding rare earth elements, zero, not even the consultancy or the brother or your ghost from Germany. So nobody was telling me anything. And also was really preliminary, but that is nice because I've learned a lot in general, okay? And that is what research is. So, okay. Now, shall I have to move by hands? Yes, I think you prefer. So, I'm not going to give you the summary of the whole paper, but you know that we show empirically both through a quantitative model and also empirically how protectionist policy can really have effects, okay, in general, in a situation which have fragmented global value chains. So, and they concentrate on rare earth element also because there's been all discussion every year between China and US regarding this kind of restriction. So you use the natural experiment. 2010, China was accused of increasing restriction on the export of REE to the rest of the world, okay? So that is a negative supply shock that increases, of course, prices and, of course, creating also uncertainty. And then there's been a fight and China relaxes the export restriction on REE in 2015, okay? That's the story. So let me concentrate a little bit because it's relevant again. To look at the characteristic of REE. So they have diverse application really strategically, especially when we look at defense, okay, use. So they are highly relevant. They're not rare at all, but they are difficult to substitute, as she was saying. And also, when you mine and you use them as a byproduct, they are highly toxic processes. Okay, and that is also highly relevant what happens and why China concentrated, but not only. So China also controls 60% on the mining, 90% of the post-mine processing. They are the one that creates a lot of pollution too. Okay. So relevant, incredibly relevant, I must say. So the construction of the input-output table, I'm not going into it because it's highly complicated, and you can imagine. So I would like to have somebody that creates the input-output tables, and they did. So they use quantity information, and they use also price information. So I don't have anything to say. I didn't even get into it, how to construct those, of course. But I might have also only some element, question regarding price, because if you have a lot of fluctuation of price, and if you see that they're going to use less of it, so input-output table might change through the shock afterwards. However, the effort has been incredible, I must say. And also highlights an important topic, an issue, since we have also in 2023 the discussion on limiting imports of IEE. So, and it's strategic also for the military production, you can imagine. So here's Acemoglu. I think I made a mistake, was not 2018, but 1988. In any case, leave aside, it's preliminary also discussion. So, but that's the idea. Okay, of the Acemoglu model, okay? I translated Acemoglu model with IE price and shifting relative supply. Okay, let's suppose that you have supply, relative supply, which is fixed, which is the second supply, which is vertical, okay, because in fixed supply, and you have a demand, which is, as usual, downward sloping. And the equilibrium is at point A. Okay, that's the equilibrium price. Now, suppose that you have a shock to the supply. So Daron was looking at positive shock, we look at negative shock, so supply moves on the left-hand side, but the same demand, you're gonna have, okay, in point B, the new equilibrium, okay? But then exactly this effect determines a shift in relative demand due to direct technical change, and demand at the end moves down, okay, because you are substituting and you also direct a technical change, and you end up being point C, okay, where the price is below the initial price, which is exactly what you see. So that's the idea that you have of the Acemoglu paper, okay? So I wanted to show you, because this nice because there are many equations, also some suggestions. So they also leave some suggestions and say, check whether it's right. It was not for me, but I didn't do it. The check is right, no way. I'm not gonna check all these models, but it was nice in any case. Now, what I had to do is to try to learn something, to understand something, okay? So I said, what are the IEE, okay? What are they? And it happens, I might introduce the MIT Tech Review. It happens to me to find the MIT Tech Review. I don't know whether you know what it is, but it is a review that MIT print every month, okay? And being an alumni, they send to everybody. And I really suggest the best reading ever, okay? I really suggest to you because you see all the biotech news and innovations, and it's unbelievable what they do. Okay, so I like, and I did find MIT Tech. They were discussing the issue. The MIT Tech of 2014 has an issue on IEE and exactly on that, okay? But to tell the truth, the story is slightly different. So my point is the story is there, is different though, okay? And 2010, so the idea is the US Department envisioned a policy about critical shortages. Remember, Xiaoping decided to concentrate on that rare events, rare earth elements. In 1987, okay, they thought that they had to concentrate on that because they became powerful and understood it was highly relevant. Afterwards, okay, they imposed really a quota. Quota were there since a long time, like 2004, 2005, there was a quota. The quota was never really binding. And what happened that the Western country, exactly because the production of this stuff, so was creating a lot of negative environment effect. They were moving to China. Western countries, they were moving, producing in China because the lower cost and all negative effects were done in China. And at a certain point, the Chinese decided to put some quota, okay, on that. And quota were there since 2004, 2005, okay, were there. Never really binding. Then what we have seen is that we have seen the shock in demand due to the crisis. Okay, they went to zero mainly. And afterwards, you see instead an increase. And of course, as all the increase that we have seen in supply chain, that puts the price up in general. So, and in fact, MIT says that prices of REE came down after spiking mid-2011 and went up quite rapidly. And you know, they're not substitutable, couldn't go down so easily. Okay, and also, and let me say also something regarding productivity also there. And they say, in reality, shortages never materialized. And I found at least 4 or 5 sources that said that in reality, shortages never materialized in 2010. That was largely due because world demand decreased, okay? Decreased why? Because companies stockpiled this material in anticipation of the shortages. They didn't understand something was going on, okay? And also because, remember at the beginning was US mining a lot. They stopped also exactly because of the environmental stuff and the cost of mining everything. And these mines, they were there, including Molycorp, and also mining in Australia started to mine again, okay, immediately. That was a justification, okay. And in reality, it was not really, this discussion is not really Japan, the fight against Japan, but the fact that the environment issue were there, and they started to say, why are you going to produce here? So it is in reality, it was not really a shortages materializes, but in reality, so the story is there, but slightly different what is presented in the paper. But was the fact that people understood, the rest of the world understood, okay, how relevant and how strong was the position of China if they were really to cut down these resources. In fact, price goes up and then goes down afterward. 1 minute, no, I cannot do it. So, and also regarding patenting and innovation, remember, something happens in the year 2010. What you should see is not a spike in patenting, no way. How come? You should see a spike in R&D expenditure on that sector. And then you have to develop the innovation. And then you have to ask for a patent. And then between the finding of a patent and when they give you a patent, at least 2-3 years passes. In Europe, in US, everywhere. So you cannot see a time 10 at 2010, oh my God. Okay, a spike. Even when you look at patenting, you don't see in reality anything in 2010. In reality, everybody was discussing then all the innovation were in 2013 and 14. Okay, so the mean something has happened in 2010. Yes, it was more an expectation element, not a decrease in and not a shortages. And of course, that has boosted even further something that you see from before. They started to think, what if China decided to close down? That's the way in which people discuss, okay? And in reality, I also impose here FT, say exactly the same story, Financial Times report, okay? And there is a link there, but also CEPR has a paper there on Vox, on revisiting China-Japan rare event dispute in 2010. They say exactly the same. So there was not a shortage, it was expectation on something. Okay, so if you want to look at a Semoglu model, the supply really didn't move, but through time the demand has shifted, but really through time, not immediately. And it's something that started before. So my point is not technical, okay? Because it's a wonderful paper, IO, the model is great. So the elasticity they were computing, although I didn't check. So it's great because you can do a lot of simulation there and trying to understand what happens if I move something. But I got the impression, although I'm ignorant, but I can have to rely on what I've learned in these days, that the story is slightly different, okay? And it was not really the story that is in the paper, but I might be wrong, okay? And 2010 could be relevant. So it's not the date that I would take. It's not the, the story that is there. So, but.
No, thank you very much.
No, because I think there's been a huge discussion. No. Maybe by presenting that, people might yell on you.
And go beavers. My daughter is a beaver. So, but let me show you. So these two prices came down, but it's, if I find it, so let me find it. The China got rid of the restriction also.
Yeah. And they accused China of getting rid of it to flood with lower prices.
Yes. So eventually, China got rid of the quota in part also because it went to the WTO, and probably was one of the last times the WTO was effective. And indeed, you do see the prices do come down. I take well the point on when we're doing the input output, there is this that they move a lot, and so we're playing with mid ranges.
Yeah. It was a miracle of this.
But production did increase, but production increased later. And so you can see that there is indeed an increase in the US and Australia in particular, but it doesn't over, like that, those are.
So people say the stockpile before.
No, and that they. No, and I'm going to read this because I talked to the Japanese companies that were doing this. This shock was unexpected. And so it is possible that someone stockpiled, but the industry in Japan that year hurt. And again, a lot was happening in Japan, and you do see it in the data, but points were taken. We need to work a little bit more on this.
Because I don't want anybody jump on you because
no.
It's a natural experiment. Maybe it's not 2010 the right one, and it's more an expectation more than the decrease. So check, because that's been a huge discussion into the literature.
No.
So I was a little, myself.
The one that patents don't jump. Like, it's impossible.
No, exactly. And it takes a lot of time. So you cannot see it.
Yeah.
It's like 2010.
No, that's why we use a long run. Because patents, if you see a jump in patent, like, that's not how patents work. Like, you have to go through the process. But it's also, what is interesting is that we're doing different elements. Like, it's not, and it works for the different elements. What you mentioned about that lead Bud Light was something we found. When you go and look at all the reports this time mentioned in a lot of use of rare elements in lighting, and we had no clue what it was. We were like, lamps. You see lamps a lot, and lamps unlikely. But then there was this innovation that happened that you just now don't use those lamps, and it collapsed.
The FT and the other I'm gonna send to you, so you see all alternative story that you have to fight against, because otherwise.
But the quantity, we have it here. The quantity didn't improve as much that quick. That, I mean, MIT Tech Review may say it, but this is the actual data.
Let's collect a couple of questions, okay? Let's try to be brief. So there's Cristina there and Isabel, and please keep it brief because we're like doing very bad with time. Thanks.
It's mostly actually curiosity. You have looked into this. Since it is such an environmental polluting process, I wonder whether you see an increase in patents to try to innovate in a way that you use less of those materials, just to maybe over time to kind of reduce the environmental impact. Because even China, we want them to contribute.
So as I said, that is happening. That is happening, but we're having the outcome that in each magnet, for example, we use less, but now we use 1,000 magnets. So in total, we're using more.
Nothing has really changed.
Listening to you, I was just thinking about the type of normative questions that are surrounding those debates. And in particular here, because we're talking about something that, as you said, is very important in value chains, but in the meantime, you use very little of it. It seems that among the many instruments that we could use to deal with these problems, there is potentially industrial policy, but there are also a lot of other policies like stockpiling that could be a better way of dealing with this type of risk. So I understand that this is not directly what the paper is about, but I think it's interesting to think about these more normative questions as well, because in this particular instance, maybe we should just have like a small stock of those in every country, and then the risk would be largely mitigated.
So for example, the military use of some of these rare elements are not enough to fill the production process of one of these firms. So one could think that then military could do it. But there is this view that stockpiling is costless. These things have environmental also, like if you put it in a storage room in some place, you need to check that it doesn't decompose, whatever that means in these products. Like it's not that you just, oil is relatively easier. I mean, it has, but once you put it in a can and put it there, the oil's not gonna change. These ones start mixing again. Like it's not trivial. The process, I mean, that is the thing, that they don't exist on their own. And so if you put them here, they will start mixing with oxygen, with the other one, with the other one. And then, so physically, chemically, it's not that easy.
Yeah. One last question from...
They can invent places where then they're stable, but...
Yeah, once they are in the form, they're stable.
No, but for example, the silicon used to do semiconductors, you know, it has to be purified and it's hardcore. And then after that, that is why the semiconductor factories are so expensive. It cannot touch anything because the silicon wants to very quickly mix. And so that's why a semiconductor facility is cleaner than a hospital. And you see all these people with all of these, you cannot put dust. Like they're very reactive. So the storing is not so trivial.
So yeah, I would like to add something that maybe it could be your next paper or somebody in the room. Like together with what happens in China with respect to the REE, we have China also getting into Africa. I'm next to Tabitha here and I cannot keep thinking about that. And then Africa is the second bigger producer of REE. So like if you look at the trends, like this is something that I don't know if you want to incorporate in your model.
No, but it depends. Africa has cobalt.
But I am not an expert.
Not these rare elements. Not REE.
Not REE.
The thing is, people tend to use REE and they add the strategic minerals and they include silicon and then include lithium and then include cobalt and then they continue nickel and whatever, but not rare elements. They're everywhere. They're everywhere. It depends. Everyone has rare elements. Rare elements are not rare. Everyone has them. The US, in fact, is in reserves is infinite. It's the processing that is complicated.
Okay, let's close it. Well, sorry, because we're so let's go to the
I'm
next.
analyzing my own paper, so I should stop.
Thank you. Thank you. And just to remind you, so the microphones are needed because this is live stream on YouTube. So that's why you need to use the microphones because otherwise people on YouTube are not going to understand what's going on. Thanks. Are you okay?
All right, well, thank you so much for inviting the paper to the program. It's a pleasure being here, and I'm a little bit jet lagged, so my accent gets a lot more Romanian when I'm jet lagged, so welcome to this peculiar accent. So I'm gonna motivate this work, which is joined with Laura and Maria Brusevic and Andrea Presbitero from the IMF. This work is on bank financing of global supply chains by highlighting a very important event, which is essentially the start of the US-China trade war, and an event that basically is part of a number of developments globally, which have led to increased tensions of geopolitical nature with a lot of economic implications. And the pandemic is also another such event. So we have seen over the last couple of decades several phenomena that have led to important shifts in commercial trade flows. US firms, in response to these trends, have started to relocate their production, and they have started to change the geographic footprint of foreign input sourcing. This is illustrated in the chart on the right-hand side, where we show import shares from China, Asia outside China, and the rest of the world of US importers. These are aggregate data. And what we see is that these import shares show a reallocation of the portfolio of inputs geographically of US importers. We see that the import share from China has declined, and mirroring that, the import share from Asia outside China and the rest of the world has increased. These phenomena, as you can see, has happened not only in the short run as the trade war started, but also continued throughout the pandemic. That yellow rectangle shows the before and after very short time period over which we're going to focus our analysis just for tighter identification. After that, we run into COVID, which is a substantial confounding event. So I'm already giving you a sense of what we're going to do. We're going to do a diff in diff to look at the short-run effects of the trade war on US firms' location decisions, as well as how they financed the increasing cost they faced because of the trade war. We're examining supply chain disruptions because they have important macroeconomic costs. There are estimates out there suggesting that about 0.5 percentage point of GDP growth was shaved off because of the trade war in the short run. So two ingredients by way of motivation to this project. The first one is to highlight the stickiness of trade relationships. And interestingly, trade relationships, as we approach this literature, me coming a little bit more from the banking perspective, they're very similar to banking relationships. So there are important search costs involved, and as a result, relationships tend to be very sticky. So search costs, which are the costs of finding new suppliers for a particular product in a particular location, generate sticky relationships because they are non-trivial quantitatively, and they're often governed by incomplete contracts. So to get a sense of the stickiness of relationships, we use the measure from Martin and our discussant Isabel's work, which develop a product-level relationship stickiness measure to convey this idea that some products will innately generate very durable relationships between suppliers and between firms, suppliers and importers. And this measure, just to give you a sense of the intuition, is that if you, for products that are traded in spot markets, there's no stickiness. That's a very low stickiness relationship. You can easily find alternative suppliers for a product that's so, easily to find. Whereas at the other end of the spectrum, a product that would be very highly customizable, think about, the elements of a car parts, for a luxury car, those would be, so such highly customizable products would generate very sticky relationships. And those relationships are very hard to substitute. When you lose a supplier that is providing customized, Tesla Roadster car doors, it takes time to find another supplier that's going to give you that kind of product. So the tariffs, the way we think about, and now on top of this, so on top of the innate stickiness of trade relationships, US importers are incredibly undiversified. And I think this is a little appreciated fact in international economics, which is because we get the sense that over time, because of technology and innovation, it should have become less costly to diversify. And it turns out that if we look at how diversified US importers are, over time they haven't gotten. Within product and across countries, they are incredibly undiversified. They actually have only one supplier. Almost the entire distribution of importers has only one supplier for a particular 6-digit product HS code. And over time, that number has not increased. It's only the very, very large multinationals that have multiple suppliers across countries for a particular product. So we're talking about like the top 5% of the distribution that are diversified, but the vast majority are not. And again, this trend has stuck over time. So the way we think about tariffs is as a large input cost shock that has hit US importers and has induced this reallocation of patterns, of supplier patterns. And we want to ask, how did firms respond? How did the US importers respond in terms of looking for alternatives when their Chinese suppliers became more expensive? And what is the role of financial constraints? And as we look for the role of financial constraints, we're going to focus on banking relationships. And the reason why we do so is because we want to look at the vast majority of importers in the US, not just the largest publicly listed firms, but also private firms, which are very heavily bank dependent. On average, in the credit registry for the US, the typical US importer has about 40% of its liabilities in bank debt. So the reason why we want to look at bank financing, the way we want to look at that, is to look at relationship banking. Relationship banking is important because banks tend to help their borrowers during bad times. They do so because they are concerned about reputational risk, because they want to extract rents from their borrowers during good times, so they don't want to lose them. They don't want to lose profitable bank relationships, and they also want to limit balance sheet losses. Now, specialized banks, the banks with large exposures to their borrowers, will have such incentives multiplied. And so we do expect that specialized banks would be particularly incentivized to help affected US importers to weather through this shock. The reason is that they have informational advantages compared to other banks. Through repeated interactions with those borrowers, they extract private signals about their creditworthiness, about their business, about the prospects of the industry. And so they know more than other banks, and therefore they can work with their borrowers better. They can assist them perhaps with cheaper credit. They can negotiate, they are more willing to negotiate and see them through such shocks. Okay, so let me put a little bit of meat on this idea of a specialized lender in our data. These are just screenshots from the websites of a couple of global banks that highlight, I'm going to highlight here Wells Fargo. Wells Fargo has a huge trade finance business with borrowers in Asia. And the other bank here is BNY Mellon. And so what does it mean to be a specialized bank? A specialized bank is a bank, in the way we're going to define it, is a bank with positive cross-border trade finance claims. So a bank that actually engages and offers specialized services to trade-oriented borrowers. And such services may include typical trade finance, so like letters of credit and loan performance guarantees, pre-import, pre-export loans, working capital loans, which are backed by accounts receivables. But at the same time, they also offer bundles of services such as Forex payments, assistance with payment services. They offer other types of financing, and they can even help you underwrite issuances of bonds or equity in foreign markets, in Asia in this case. So this kind of bank will also typically be present locally in that market. So all the banks that are specialized in our context will see that actually they have local offices on the ground, and they have specialized loan officers that work in trade financing. So putting all of these elements together, we're going to ask, how does bank financing help firms reconfigure supply chains in response to a large input cost shock? And what role do specialized banks play? And by way of a preview of the results, we're going to show, first, we're going to replicate what has been shown already in the literature, including in Laura's previous work on the great reallocation of supply chains, that affected importers engage in significant supply chain realignment or reallocation of input sourcing. So this is like a real effects type of result. And then on top of that, affected importers increase their demand for bank credit. So they deal with this temporary, hopefully temporary, although it's not clear because we have seen more recently there are other plans for trade tariffs. They deal with this shock by increasing their demand for bank credit and perhaps taking out more loans. And specialized banks, importantly, reduce credit frictions for affected importers, making it easier for them to find new suppliers outside the affected market. And I'm going to try to impress upon you that these financial frictions are not the only way by which specialized banks help, but they also help by alleviating information frictions. So the key takeaway is that bank financing is critical for supply chain realignment. And you can already see that an interpretation of this work, sort of stepping back, is that it's important to have healthy banks. Because only against the backdrop of a healthy banking sector, the banks will be able to buffer some of the real shock that from time to time the economy is facing. So we're going to put together some data sources, and here we're trying to really move the literature a little bit forward and learn some new things that we haven't known before. So first, we're going to use the shipment level data from S&P Panjiva Supply Chain Intelligence. This is the universe of shipments that arrive at US ports. And we have information that is quite detailed on the shipments. We see the firm that is importing, the firm that is sending the shipment to the US, and we have the volume of the containers at the HS6 product level. Then we also have the US credit registry, which is bank firm loan level data from the supervisory Y14 data set of the Fed. In addition, we have the data on tariffs, which is quite standard in the literature. And the bulk of the work is to match the importers that we see in the shipment level data with the credit registry. And we do that matching very, very conservatively. So we're as sure as possible that we're capturing accurate matches on exact matching on names. So this is going to give us an opportunity for the first time to understand who are the US importers and what kind of banking relationships do they have. And I can tell you that they tend to be larger firms, very, very much expected, but actually on a lot of financial metrics, they're not better than other firms. They, in fact, are less leveraged. They have less cash. They tend to have the same ratings from banks, so not riskier, and they have lower sales growth, which we may think of as a proxy for the investment opportunity set of these firms. In addition, we're going to observe their borrowing activities from individual banks. They also tend to be concentrating in manufacturing and wholesale trade a little bit more than the typical bank borrower. And the typical bank borrower, of course, is concentrated here because in these two sectors, because these are bank-dependent firms. They need a lot of fixed assets and tangible assets more generally to pledge as collateral at banks. So I'm going to focus on two sets of outcomes, trade and bank lending. So I'm going to have real effects regressions and credit regressions, and then I'm going to kind of marry them together at the very end to show that banks matter. And we're going to look at first supply chain participation at the firm product tier level in two markets. We're going to examine the exit from China and the entry into the rest of Asia for affected importers. With a number of outcome variables, and then we're going to look at lending outcomes on the extensive and intensive margins. So by way of how we set up the diff in diff, the treatment will be firms' exposure to the tariffs. So a treated firm will be a firm that had a Chinese supplier before the trade war and was importing at least one product that was affected by the tariffs during the trade war. And then for specialized banks, like I mentioned, our baseline measure will be a very simple dummy for whether the bank has cross-border trade finance claims. And keep that in mind that that bank also is very likely to have local presence in Asia. So the empirics will be very standard diff in diff. And because we are among friends, I'm going to jump over something so obvious and show you the results in three parts. Supply chain realignment regressions, bank credit regressions separately, and then I'm going to bring them together to show that specialized banks matter for the real adjustment, and that in addition to supplying credit, they also help affected borrowers with information. So the first set of results is to show that there has been supply chain realignment of affected US importers during the trade war. So on the left-hand side, we have the shift away from China. On the right-hand side, the shift toward Asia. And what we see is consistently across the board, the tariff-hit importers were more likely to exit from China and increase the number of suppliers lost from China and decrease their import share from China. And they were more likely to enter Asia. They gained suppliers in Asia and they increased their import share from Asia. And all of these coefficients are statistically significant and actually quite sizable. So this is a very granular within product, within HS6 code product. Okay. So let's go to credit regressions. How did they achieve all this? At least in part with the help of banks. So here we're going to look at lending outcomes, and we're going to try to control for credit supply effects with bank quarter fixed effects. Yeah, maybe not perfectly. Yeah, there still may be some endogeneity, or some contamination of these effects by supply forces, but they are very consistent with the demand side story. We see in particular that tariffs affected importers increased their credit line utilization rates, which is a very strong indicator that their demand for credit increased, because these are pre-committed lines. So this dependent variable is not affected contemporaneously by the bank's decision to offer credit. The bank has to disperse has to allow the drawdown on the credit line, because that credit line is pre-committed typically. They were more likely to take out new loans, and when they took out new loans, they took them out at slightly higher interest rates. So in the outstanding stock of loans, we see that interest rates increased by 3.6 basis points, which is little, relatively little. We're talking during this period of average interest rates on loans of 3-4%, but in new loans, the increase is of 17 basis points, and at slightly higher loan amounts. So all of these together suggest that there was an increase in bank credit demand from affected importers. Okay? And now let's decompose this effect by specialized versus other banks. So now we're going to compare importers that were banking prior to the trade war with specialized banks versus other banks. And the first three columns focus on our baseline measure, and we see that indeed the affected importers with specialized banks are more likely to improve their, enhance their reallocation. They are more likely to enter into Asia, to gain suppliers into Asia, and to increase their import share. And on the right-hand side here, we have a placebo test for banks specialized in Europe. We should not see any effects, and indeed, we see absolutely no statistically significant difference between the effects. So banks specialized in Europe are not helping with the reallocation in Asia. This is sort of a test to kind of put at ease any concerns that we're picking up something else than specialization in Asia. Okay? So let me just switch gears for just a second and kind of change the setup of the regressions to look at something different. A very interesting outcome is the speed with which affected importers found new suppliers. And I want to focus here on the last column, because then I want to show you some evidence that banks helped not only with credit, but also with information. In the last column, we see that firms with specialized banks were 9%, almost 10% more likely to find new suppliers outside Asia during the post-trade war period. And that coefficient is statistically significant. So let's start working off of this coefficient and pin down the information effects. So it is very clear from here that if you work with a specialized bank, you adjusted faster. We already showed that if you work with a specialized bank, you also got better lending terms. So let's see if we can pin down an information effect. So I'm going to think about this in two ways, and I'm going to present two tests. The first one is, how did these banks, how could they have possibly helped with information? And one reasoning is that maybe they had information about the existing network of suppliers in the area. If those suppliers were already banking with US banks, or if they were previously supplying inputs to US firms, then they were good candidates to be a new match. So the first test will test if US importers are likely to match with new suppliers in Asia who are also pre-existing clients of US banks, or who had previously supplied inputs to other US firms. And then the second, let me go to the second test after that. So let me show you now evidence for the first test. And indeed, we see that such firms with specialized banks are faster, 12% faster, 29% faster, depending on the set of controls. They are faster at finding new suppliers as long as those new suppliers are existing clients of US banks, or they are pre-war suppliers of inputs to other US firms. So this is suggestive of network effects. So now the second test, and the last one, is to test what is one that kind of is based on the idea of financial constraints. And here we're going to focus our attention on unconstrained firms. Those unconstrained firms shouldn't really have that much of a demand for credit because they are unconstrained. We're going to measure them as like very large firms, or firms with very high sales growth. Yeah. So those firms don't really have much demand for credit, but even so, I'm going to control for, I'm going to have a proxy for the demand for credit, and then I'm also going to show that they don't get better lending terms from specialized banks. So I'm going to try to shut down that credit channel as well as possible. And at the same time, I'm going to test whether they find the new suppliers faster if they are with specialized banks. So here's the evidence. In the subsample of firms that are unconstrained, controlling for loan demand, and I don't have time to show, but also without any evidence that they have differentially better lending terms, we see that those with specialized banks adjust faster. It takes them 8% less time to find a new supplier. So I'm hoping that the totality of this evidence suggests that there's an information channel that specialized banks help not only with credit, but also with information. So to wrap up, in summary, we have shown that there has been significant supply chain realignment at the firm level to bolster and increase our confidence in and replicate also some of the powerful existing results in the literature. US importers have shifted and diversified trade away from China. In fact, I haven't given you statistics, but about 70% of the affected importers from China decided to add a new supplier from abroad. So they did look outside of China, and the other 30% kind of churned suppliers within China. So we have large-scale reallocation across borders. Tariffs hit importers also increase their demand for credit because of the costs innate in the search process. And those with specialized banks obtained credit on relatively better terms, adjusted faster, and were more likely to find suppliers outside China. And so the key takeaway is that banks are critical in this process. They help with mitigating some of the switching costs related to large trade disruptions. And I'm hoping that our results shed some light on how this adjustment happened very quickly. The great reallocation of global supply chains was pretty speedy, and it also sheds light on what's to come, given ongoing plans to continue tariffs.
Great, thank you very much, Camelia. Perfect timing, and 1 minute before time. So now we have Isabelle Mijan that's going to do the discussion. So the floor is yours.
Okay, good. Thanks very much. Thanks for having me. It's a pleasure to attend this conference, as it was last year. And it's been a pleasure to read this paper, which is very much related to some of my own research, but also adding a lot to things that I've been thinking about the last few years. So first, I need to apologize. I find that my slides are a bit messy, so maybe you don't want to stick too much to what I've been writing and just listen to why I think it's an exciting paper, a very interesting topic. So this paper is bringing great data and a rich empirical strategy to contribute to this fast expanding literature, digging into the consequences of the US-China trade war. So as you know, there is already a lot of literature on the topic, but until now, I would say that most of the literature has been focusing on the kind of short-run impact of the trade war, of the Trump tariffs, looking at the transmission of those tariffs to prices in the US and the resilience of US firms to this important shock. Now it's kind of clear today that these are not Trump tariffs. This is something that is saying something about the new international environment. So the Biden administration has maintained those tariffs. So this is something that is going to stay there for quite a bit of time. And so maybe we can start thinking about the more long-run consequences of this important change in the relationship between US and China. And this is really what the paper is doing, digging into more long-run consequences and how firms not only resist to the shock, but also adapt to the shock. And so one dimension that a lot of people have in mind, that actually a lot of journalists ask us about, us trade economists, is about the impact that this type of shock is going to have on the geography of supply chain, which is always a very difficult question, because empirically it's extremely difficult to look at the data and say something about the change in the geography of supply chains. Why is it the case? Because supply chains are extremely sticky. And so you need a lot of time to see something going on in aggregate data, and a clever empirical strategy to be able to identify causally the impact of a shock like the Trump tariffs on the geography of supply chain. So I think a very important contribution of this paper is to come up with an identification strategy to dig into this causal impact. And then on top of this, the paper also had this role for the financial sector. And here as well, this is a very important topic. We're talking about a very important change in the international environment. Firms need to adapt. And how do they adapt? They adapt through with the help of the financial sector. So the two contributions, I think, are very original and very exciting. So I don't think I need to spend too much time explaining what type of natural experiment we're talking about. Everybody in the room has heard about these so-called Trump tariffs. So starting from early 2018, Trump has decided to put these tariffs on very specific products imported from China. And from there has been escalation, as you can see here. Something that I was not completely aware of, maybe it's a shame for a trade economist, is that if you look at the data in early 2020, almost all products that the US is importing from China are concerned by one of those tariffs. And so what this means is that once you start digging into the long-run consequences of this US-China trade war, there is no way you can use the staggered implementation or the specific targeted of products. What you need to do is to use identification from the cross-section of firms, comparing firms that were exposed to China at the time of the shock with firms that were not. And of course, then the referee, which I'm not going to enter into this, is going to bother you with the control group and stuff like this. But that's a fact in life, that if you want to think about the long-run consequence of this, you need to compare across firms that were importing from China and firms that were not. So that's the natural experiment setting. Now, I don't know if it's a good idea, but given the paper has a lot of different results, I thought that maybe it might be useful for the audience in this room to organize these results in terms of a very simple conceptual framework. So the conceptual framework that I have in mind is, I take a firm located in the US, a firm I, which early on in 2018 is endowed with a number of supply chain relationships, some with Chinese suppliers and some with not. And I can think of the problem of a firm starting early on in the trade war as trying to maximize the value of existing matches. And the value of these matches in this equation is going to be this VP function. And this value is a function of the instantaneous profit that the firm is going to recover from its suppliers. And then the continuation value that depends on the likelihood that in the future I'm going to keep on interacting with this supplier, or instead the likelihood that I'm going to decide to switch away from this supplier. And this probability depends on various things that here I'm summarizing with two parameters. One is the probability that in the future I'm going to match with alternative suppliers, and we just talked a lot about rare earth elements. If today I'm linked with a supplier of rare elements in China, it's fairly unlikely that tomorrow I'm going to meet with an alternative supplier. Why is it the case? Because this is a market that is extremely concentrated. Most of the suppliers are located in China. And so I'm kind of stuck with these suppliers for the very reason that the market is highly frictional. And then there is a second reason why eventually I might stick with my existing suppliers, is because the cost of switching across suppliers might be high, say because there is some kind of input-specific investment that I've spent, and thus I want to stick with this supplier. So what this means is that there are various reasons why a firm starting in early 2018 might be stuck with the Chinese suppliers, and this stickiness is really the reason why the question that thereafter is complicated. So now in this very simple model, what is the impact of a trade war? Instantaneously, at the moment when Trump is introducing those new tariffs, there is a drop in the profit flow associated with Chinese suppliers, targeted Chinese suppliers, which means that in the future, it's more likely that I'm going to decide to switch away from China, and this is exactly what the paper is about. This drop in the, or this increase in the probability of firms switching away from China is confined to targeted relationships. So if I have some relationship with either Chinese suppliers or non-Chinese suppliers that are not targeted by the tariffs, then the probability of a switch is unchanged, and thus I can use this in different settings. And on top of this, there is this systematic reshuffling of value chains that the paper is about. Suddenly, the value of Chinese suppliers is reduced, and thus everybody is avoiding to establish new relationship with Chinese suppliers, and this is true for treated relationships, but also for everybody else. So there is a bit of contamination to everybody else. And finally, I can use this very simple framework to think about the role of banks in this setting. And here, banks can be thought as doing two things. They're going to provide liquidity for firms that are exposed to a drop in their profitability. And the second thing that they can do is to finance or help finance those new investments that are needed if I want to switch. So this is the F parameter in my model. So that's a bit the conceptual framework that I have in mind. And you can think of the different results in the paper as fitting this framework. So the first result is about like this portfolio realignment. So how the firms that were exposed to the tariffs have been modifying the geography of their supply chain. And this is tested in this equation here. That indeed is a standard difference in difference equation that Camelia just went very fast on, but I wanted to come back on this. So the equation is fairly standard. So on the left-hand side, you have a trade outcome at the firm, product, and yearly level. Then you have a bunch of fixed effects. And then this interaction terms being between exposure to one of the Trump tariffs and the post-variable standard difference in difference. Importantly, among the many fixed effects that the equation has, there are a firm times product fixed effect, meaning that the identification is achieved from variation over time within a particular product line. So there are a lot of issues in this type of settings regarding how you want to balance the panel and stuff like this. But again, this is a question for Grumpy referees. I'm not one of those. Maybe I wanted to just like point out, but I think it's a bit what you're doing, but basically a lot of the trade outcomes that are used in this equation are count variables, the number of entries, the number of exits. But as we saw, or as the paper show, and that is true, that is typical of firm-to-firm trade data, most of these outcome variables are either 0 or 1s. Why is it the case? Because firms typically have just one supplier for a given input. And so what this means is that the equation is mostly exploiting changes from 0 to 1 or 1 to 0. So that's why I think it would maybe be more natural to think about this in the context of a model estimating switching probabilities as you do at the end of the presentation. Then maybe one of the main suggestions I would have is to maybe dig a bit more into the heterogeneity analysis. I'm going to go quickly on the rest. The first heterogeneity analysis that I think is very important is to differentiate between manufacturing firms and wholesalers. My model is about manufacturing firms, but we know that wholesalers are very important in trade. Wholesalers have much more diversified portfolios, and because the equation has number of entries on the left-hand side, they're going to help a lot. Yeah, I mean, they're going to matter a lot for identification in the rest. I think it's because I'm late, so still I wanted to say something about the second result on the role of banks here. Yeah, just change it here and explain it. Okay, anyway, it's not very important. I think maybe my main insights are as a trade economist regarding the first empirical result regarding firms have been reshuffling their value chains during or after the implementation of those tariffs. Still, an important part, and maybe where Camelia is really like adding a lot of her background regarding financial intermediation, is regarding the role of banks. And here I was a bit surprised because remember in my model, there are two ways firms can help. There is an issue with profitability. We are talking about firms that are facing an important negative shock. And so those firms are in need of liquidity. And so maybe this might explain why they are increasing their use of credit lines. Credit lines are providing this liquidity, while instead the interpretation that you have is really in terms of new investment that are needed to restructure global value chains. And maybe there are variables that are better suited than credit lines to capture this idea. Anyway, it's late. We are all very happy to go to this nice visit of the Bank of Spain. So I just wanted to say again that this is a very interesting paper. It has a lot of data, and I think this data could be used further to really like dig into how firms adjust their value chains.
Well, thank you, Isabel, for your discussion. We are going to take like a couple of questions from the audience. So please raise your hand. We have one question here. And another one there. Thank you.
So great paper. So overall, I mean, the picture is that relationship banking kind of helps firms overcome this shock. But I mean, there might be a fine line between this positive angle and a more negative angle about evergreening, zombie lending, right? And firms being faced with this shock, the banks might be somehow giving this credit, more credit, and in better terms because they're somehow trying to make the firms remain alive so that they don't record losses. And you mentioned several times that it's important to have a healthy banking system. So I imagine this is in the back of your mind, but I would still like to see if you have thoughts about this.
Let's collect first the questions and then you can reply to all of them. So there was...
Sorry.
I don't know whether it's a question, but and I have to apologize because it's me that I'm sleeping, but I'm trying to understand whether we could think that firms that are able to find new partners, okay, in China, get better funding, and not the other way around. The banks are getting more funding to those in order to help them find a new guy, okay? Maybe it's exactly reverse. Since you're sufficiently good to find another one, you're considered less risky, I'm going to give you more money. So it's not an information helping, but it's because the quality of the firm that is finding somebody there is going to exploit this possibility to get more funding from the bank. Okay, so reverse causality there. Could we think in this way, or maybe it's me? Maybe it's me.
Okay, so please, we can reply.
Well, thank you so much. I really don't want to be the one thing keeping us all from having fun. So let me go in reverse order. That's a great observation. We try to go at length to show that the firms, the unconstrained firms that borrow from specialized banks actually do not get better terms from those compared to other banks. So in other words, we try to rule out the fact that specialized banks will be cherry picking their least risky, bestest of all customers to give better lending terms. We try to shut down that channel by showing that there's no differential lending effects. And so we isolate to the extent possible the information channel. I completely agree. Evergreening, the way we look at evergreening here is like an innate feature of financial intermediation where banks make the decision to evergreen, so to speak, for a while, under the presumption that the realignment is going to take place and these firms are going to stay profitable. So far, we don't see evidence that any of the affected firms become economically unviable, like proper zombies, and we don't see any evidence of subsidized credit just yet in the data. And thank you so much, Isabel. Fantastic questions and suggestions. And I want to clarify that we don't believe that the firms are taking out loans in order to finance new investments to like kind of improve their productive capacity. Rather, they try to tap relatively more into their existing credit lines. Of all loans, about 3/4 of loans are existing credit lines. And the advantage of doing that, like you hinted, is that those credit lines are pre-committed at pre-committed interest rates. So the new financing they get is not at higher interest rates, but on completely new loans that they take out for the first time, they do pay higher interest rates, consistent with this idea that they increase their demand for loans. So specialized banks don't give them higher interest rates, but other banks do. So on average, they do pay more for new credit. Thank you so much.
Thank you very much for the presenters of this last session. Thank you everyone for being here until the last session. And so the guides are already at the door. So yeah, the guided tour is going to be around 1 hour and a half. Then you will have time to go back to the hotel, change, relax for a little bit, and then dinner is at 8:30. And so yeah, if you have any doubts, please let me know.